As an auditor, we are expected to provide only an opinion. As an auditor, we are expected to provide only an opinion. Auditor cannot give any guarantee. Auditor cannot give any guarantee, or auditor cannot give any certificate. We cannot give any guarantee that financial statements are reflecting a true and fair view. We cannot give any certificate saying that financial statements are not reflecting a true and fair view. We can only express an opinion. Please listen the point carefully. This is a very important point. This is the base on which I am going to explain some other questions in chapter number 1, unit number 2. As an auditor, we need to express only an opinion. We are not here to give a guarantee or certificate as to the truthness and fairness of the financial statements. Auditor shall express only an opinion on the truthness and fairness of the financial statements. Auditor cannot give any guarantee as to the truthness and fairness of financial statements, or cannot provide any certificate as to the truthness and fairness of the financial statements. Do you understand this point? Auditor cannot give any guarantee. Even though you have performed an audit, you cannot give any guarantee. You cannot give a certificate that these financial statements are reflecting a true and fair view. You can merely express an opinion. You can merely express your opinion on such financial statements. You cannot give any guarantee or certificate with regard to the truthness and fairness of the financial statements. Now the question is a big why. Why? Why auditor cannot give a guarantee? You have performed audit. You have gone through all the books and other related records. You have gone through financial statements. You checked every item with the help of supporting documentary evidence. Even after doing all these things, can't you give a guarantee or certificate as to the truthness and fairness of the financial statements? The answer is no. No. As an auditor, we cannot give any guarantee. We cannot give any certificate to you with regard to the truthness and fairness of the financial statements. We can only give some opinion. Now the point is, while I am explaining you the concept called as internal control, I said to you that management is made responsible to introduce internal controls. Internal, simply speaking, segregation of duties or division of responsibilities between or among more than one person in such a manner that the work done by one person is automatically verified by another person is called as internal control. If you are able to segregate the duties in such a fashion, every employee knows very well that the work carried out by him will be verified by another person at a later point of time. That will create a fear of being caught in the mind of the employee. Hence, it will act as a moral check on the employee. Then the possibility of involvement of employee in fraud would get reduced. On that day, I also specified to you that if management established internal controls will certainly minimize. Internal controls will certainly minimize the occurrence of frauds and errors, but they cannot eliminate the possibility of occurrence of frauds. Why? Internal control can only minimize the occurrence of fraud, and why it cannot eliminate the possibility of fraud? Why? Because sometimes employees who are involved in the internal control systems may collude with outsiders, or sometimes employees may collude with one another. For these two, I have given two examples. In the first case, I was the purchase manager. I colluded with a supplier. Supplier is a third party. I am the employee of the organization. Employee of the organization colludes with a supplier to involve in fraud. In the second case, these four are my helpers. and I have divided the responsibilities or duties between among these four in such a manner that the work done by one person is automatically verified by another person. Unfortunately, all the employees who were involved in the internal control system colludes with one another, and hence they were involved in fraud. That means because of collusion only, internal control systems can be defeated. Yes or no? Even if you establish very good systems of internal, even if the management established very good and effective internal control systems, employees may defeat such internal controls through collusion. That collusion may be either between or among employees, or sometimes the collusion may be between employees and third parties. So, even if you establish internal controls, there is no guarantee that all frauds are eliminated. Yes or no? So, there are very good and effective internal control systems in the organization. There are very good and effective internal control systems in the organization. However, unfortunately, some of the employees were involved in collusion. Some of the employees were involved in collusion. That collusion is either between or among employees, or collusion may be between employees and outsiders. Because of that, such internal control systems are not operating. They are very good systems of internal controls, but because of collusion between or among the employees, the internal controls are not operating effectively, and employees were finally able to involve in fraud. Although there are internal controls, through the process of collusion, employees were involved in a fraud. What happens when an employee involves in a fraud? What happens when an employee involves in a fraud? The financial statements in such a case may contain mistakes or misstatements. And if such mistakes or misstatements are material in nature, if such mistakes or misstatements are material in nature, as an auditor, you are required to issue a dash report. Very good. Modified report. Very good. When the auditor finds material misstatements in the financial statements, if the financial statements are free from material misstatements, issue an unmodified opinion. If they contain material misstatements, you need to issue a modified opinion. That modified opinion may be either dash or dash or dash. Qualified opinion, adverse opinion, or a disclaimer of opinion. Are you getting my point? Right. So, when very good systems of internal controls have been established in the organization, there is every possibility that some of the employees of the organization may have colluded in between themselves or may have colluded with outsiders. In that case, all the internal controls established by the entity are very good systems. They are not operated effectively, and hence employees were involved in fraud. When employees were involved in fraud, such financial statements could contain misstatements, and such misstatements may be material misstatements. And sometimes it may not be possible for you as an auditor to detect. Sometimes it may not be possible for the auditor to detect all the material misstatements. Financial statements contains material misstatements. It is our responsibility as an auditor to identify all such material misstatements. But sometimes it may so happen that auditor may fail to detect all material misstatements in the financial statements. So auditor is supposed to detect frauds. Auditor is supposed to detect frauds. Auditor is supposed to detect errors. When you are able to detect frauds, when you are able to detect errors, it is said that you are able to detect material misstatements in the financial statements. But sometimes it may so happen that despite of the best efforts of the auditor. What is that? Despite of the best efforts of the auditor would not be in a position to detect frauds. The auditor would not be in a position to detect errors, because the auditor may fail to detect frauds or errors. The auditor may also fail in detecting all material misstatements in financial statements. Are you following my discussion? Please say yes or no. Should it be repeated? I will repeat it, no problem, because you are in the early stages of the subject. It is quite difficult for you to understand this subject. I know the difficulty in understanding this subject. I am teaching this subject for the past 25 years, and I know the difficulty in teaching the subject as well as in understanding the subject, particularly students at inter level. You are after all 18 years of age. That's it, or less than 18 years. And it is quite difficult for you people to understand the terminology and the importance of each and every topic or concept in auditing. Right? No problem at all. I will try to repeat it. Management, what we started having a discussion after completion of types of opinion. I said to you that as an auditor, you are supposed to express only an opinion. Auditor is not expected to give any dash or dash with regard to dash. Auditor is not supposed to provide any guarantee or certificate as to the truthness and fairness of the financial statements. Why auditor is expected to provide only an opinion, and why not the auditor can give a guarantee or certificate? As an auditor, we cannot give any guarantee. We cannot give any certificate as to the truthness and fairness of the financial statements. Why? Because sometimes management would have established very good systems of internal controls in order to prevent as well as to detect frauds and errors. But unfortunately, employees who are involved in internal controls, who are expected to follow such controls, may have colluded in between themselves or may have colluded with outsiders. When employees collude with others, then employees may be in a position to defeat internal controls. When employees defeated internal controls, they would certainly involve in dash. Despite of existence of internal controls, employees defeated internal controls and were involved in fraud. When employees were involved in fraud, obviously financial statements will contain some material misstatements. And unfortunately, despite of his best efforts, the auditor may fail to detect all the material misstatements in the financial statements. Why the auditor may fail? Sometimes you may fail in detecting all material misstatements. There are 1,000 material misstatements. You would have identified only 200 material misstatements, and the auditor may have failed in detecting other material misstatements despite of his best efforts. Why the auditor may fail in detecting all material misstatements in the financial statements? I can give you 1,000 reasons for that, but you cannot understand them. For that purpose, I am giving you only one answer for this. That is because of the existence of inherent. Very good. That is because of the existence of inherent limitations in the process of audit. In the process of audit, there are some limitations. Those limitations are technically called as inherent limitations. We know that there are limitations, but you cannot overcome it. That is the nature of inherent limitations. You know that there is a limitation, but you cannot overcome it. Those limitations are technically called as inherent limitations. So there are some limitations in the process of audit. Because of such limitations in the process of audit, such limitations are technically called as inherent limitations. Because of such limitations in the process of audit, as an auditor, you cannot give any guarantee or certificate as to the truthness and fairness of the financial statements. You can merely express an opinion on the financial statements. Those limitations are technically called as dash, inherent limitations. And you know that there is a limitation, but you cannot overcome it. That is the nature of inherent limitations. To have a better understanding of this point, I would like to provide you with two examples. Both are general examples, but you will certainly be able to understand the exact meaning of the term inherent limitations by listening to those two examples. In the previous class itself, I asked you a question about what is a normal loss and what is an abnormal loss. Fortunately, we have given a correct answer saying that if the loss is a normal loss, you know that there is a loss, but you cannot avoid it. Whereas in case of an abnormal loss, you know that there was a loss and you can by taking some precautionary measures, you can certainly avoid it. So avoidable loss is abnormal. Unavoidable loss is normal. You know that there is a loss, but you cannot do anything. You cannot limit or restrict that loss. For example, just now you have opened the cap of the petrol tank of your vehicle. When you open the cap of the petrol tank of the vehicle, what happens? Petrol will slowly get evaporated. And evaporation of petrol is nothing but a loss. Yes or no? Evaporation of petrol is nothing but a loss. Could you stop that loss? Yes. If you close the cap of the petrol tank, you could stop that. I know very well that you will give an answer saying that it is not possible to stop it. But if you close the cap of the petrol tank, you could certainly stop that evaporation. That means there was a loss and you are able to avoid it. When you are able to avoid the loss, that loss is called as dash. Abnormal loss. Even if you close your cap of your petrol tank, there will certainly be some evaporation of petrol when the petrol is traveling from the tank to the engine. Could you stop that? No, you cannot do that. So when you are able to stop a loss, it is called as abnormal. When you are unable to stop the loss, it is called as dash. Normal. Normal loss cannot be avoided. I'll try to provide you with another example. My height is 6 feet 1 inch. And I'm of the opinion that 5 feet 11 inch is a correct height. So I want to reduce my height from 6 feet 1 inch to 5 feet 11 inch. And for that purpose, I have three options available. Please tell me about which option is preferable. Option number 1, I need to cut 2 inches of my head. Option number 2, I need to cut I need to cut 2 inches of my legs. And option number 3, I want to cut 1 inch of my head and 1 inch of my foot. No alternative is preferable. Why? Because I cannot achieve that objective with these three things. I know that there is a limitation, but I cannot overcome it. Those limitations are technically called as inherent limitations. Such limitations do exist in the process of audit also. Because of such, auditor knows that there are some problems in conducting audit. There are some limitations while he is conducting the audit. But unfortunately, auditor cannot overcome it. Because of such limitations, although the audit is perfectly performed by the auditor could not be able to detect. Auditor could not be able to detect all the material misstatements in the financial statements. Auditor may be able to detect all material misstatements, may not be able to detect all the material misstatements. That is the reason why you cannot say with certainty, as an auditor, you cannot say with certainty that I am giving a guarantee, I am giving a certificate that these financial statements are reflecting a true and fair view. Never do that. Why? Because the process that you have carried out is subjected to some limitations. That is the reason why you cannot give any guarantee or certificate. You can only give an opinion about the truthness and fairness of the financial statements. Now you may be puzzled to understand the difference between the terms opinion and a certificate. Once you give an opinion, opinion can be changed at any point of time. But once you give a certificate, it cannot be changed. A certificate cannot be changed, but an opinion can be changed based on circumstances. That is the reason why don't try to give a dash or a dash. A guarantee or certificate as to the truthness and fairness of the financial statements. Okay, I'll try to provide you with another example so that you will have better understanding of why auditor can give only an opinion and why not a guarantee or certificate. That is an advanced concept, but I'm having a dare to discuss the same with you. Okay. Generally speaking, as an auditor, we are expected. Generally speaking, as an auditor, we are expected to verify each and every transaction. The auditor is required to verify each and every transaction entered by the organization in detail. So auditor is expected to verify each and every transaction entered by the organization in detail. In other words, if an entity enters into, say, 1 lakh transactions, it is our duty as an auditor to verify all 1 lakh transactions thoroughly. Are you able to follow this? When the entity under your audit, the organization under your audit enters into, say, 1 lakh transactions, generally speaking, it is our responsibility as an auditor to verify each and every transaction entered by the organization in detail. Usually we do that also. If the auditor verifies each and every transaction entered by the organization in detail, then it is technically called as full checking. What is that? It is technically called as full checking, otherwise called as routine checking. You can call it in either way. These terms are very, very important. I appeal to all of you to listen these terms carefully and more importantly, try to remember the discussion for a long period of time. These are very much important for you to have a better understanding of the subject in future. This is technically called as what? Full checking, otherwise called as routine checking. You can call it in either way. If every transaction entered by the organization has been verified by the auditor without any exception, then it is said that the auditor adopted a method called as full checking, otherwise called as routine checking. But sometimes the auditor may not have adequate time. The auditor may not have adequate time to check each and every transaction in detail. That means the auditor may not have adequate time at his disposal to carry out routine checking. If adequate time is available, we will always try to verify each and every transaction in detail. That means we try to follow routine checking. But sometimes because of time constraints, what is that? Because of time constraints. What is meant by time constraint? Sufficient time is not available to the auditor for carrying out audit of each and every transaction. That is technically called as time constraint. In that case, the auditor may try to check only part of the transactions. If you try to check only part of the transactions, then it is technically called as part checking, otherwise called as test checking, part checking, otherwise called as test checking, part checking, otherwise called as test checking, and popularly known as audit sampling. What is that? Popularly known as audit sampling. So, as an auditor, you can follow two approaches. The first one is called as routine checking. The next one is called as audit sampling. This audit sampling can also be called as part checking, otherwise called as test checking. By listening to this discussion, you may get surprised that why the auditor should not verify all the transactions and why auditor may resort to a technique called as audit sampling. Generally speaking, you are supposed to verify all the transactions. When you are supposed to verify all the transactions, why the auditor is following another approach called as part checking or test checking or audit sampling? You are forced to do that because of dash constraints, time constraints, and unfortunately, you may have faced this situation in your student life also. Yes or no? There are only 10 days left for the examinations. Just now you have opened your book and you find that there are 200 questions in the book. Every question has been marked with the terms very important, very important, most important, very, very important, etc. And you find questions of such type having 200 in number. The number of days left for the examination is 10 days. You are supposed to prepare for 200 questions. Is it practically possible for a student to prepare for 200 questions with the limited time available to him? Certainly not. In that case, if you were the student, what will you do? By making some thorough analysis of the past question papers, you will certainly try to select few questions out of 200. If I were the student, I would try to select 10 questions out of 200. One question per day, not more than that. So I am supposed to prepare for 200 questions, but I am preparing only for 10 questions. Similar to that, as an auditor also, we need to follow sometimes because of time constraints. It may be necessary for us as an auditor to follow an approach called as part checking, otherwise called as test checking, otherwise called as audit sampling. So we need to perform audit of each and every transaction in detail, but sometimes we may be forced to perform audit of only few transactions. Assume that because of the time constraint, as an auditor, I have to check 1 lakh transactions, but I have selected and verified only 5,000 transactions out of it. I have selected and verified only 5,000 out of it. How many transactions are required to be checked by the auditor? 1 lakh. How many transactions were selected and verified by the auditor? 5,000. And the auditor made a thorough verification of these 5,000 transactions. The auditor do not find. The auditor, all 5,000 transactions have been thoroughly verified by the auditor by following all the available auditing techniques, auditing procedures, etc. But auditor is unable to find any material misstatement in the selected and verified 5,000 transactions. I repeat, auditor is supposed to verify 1 lakh transactions, but because of the time constraint, the auditor decides to follow audit sampling. Hence, the auditor selected only 5,000 out of 1 lakh transactions. and all those selected 5,000 transactions have been thoroughly verified by the auditor, and the auditor do not find any material misstatements in the selected and verified 5,000 transactions. If you were the auditor in that scenario, what conclusion would you reach by this? If you were the auditor in this scenario, what conclusion would you reach as an auditor by this? Since selected and verified 5,000 transactions do not contain any material misstatements, the remaining 95,000 transactions which were not selected and not verified by the auditor may also not contain any material misstatements. That would be the conclusion that you will reach as an auditor. Yes or no? Are you able to follow the discussion? How many transactions are expected to be checked by the auditor? 1 lakh. In that case, it is called as routine checking. But because of the time constraints, what the auditor did, auditor selected only 5,000 out of 1 lakh, thoroughly verified all the selected 5,000 transactions. The auditor do not find any mistakes or misstatements in the selected and verified 5,000 transactions, and hence the auditor concluded that since the selected and verified 5,000 transactions do not contain any material misstatements, the remaining transactions may also not contain any material misstatements. When I observe this person, I observed that he is listening to the class. Actually, I am not checking him whether he is listening to the class or not throughout my class. Just now I observed him and I found that he is listening to the class. In that case, what assumption would I make? Since it appears that the person is listening the class, when I see him, I will make an assumption that the person may be listening the class even though I am not checking him. Yes or no? Similar to that, here I have selected and verified only 5,000 transactions. I do not find any material misstatements in the selected and verified 5,000 transactions. Hence, I made an assumption that the remaining 95,000 transactions may also not contain any material misstatements. So, auditor now concluded that financial statements are very good, are free from material misstatements, and hence they are reflecting a true and fair view. Therefore, the auditor has given a clean opinion. Now, I want to ask you a question. Is this opinion given by the auditor in the given case a correct opinion, an appropriate opinion? Yes or no? Is that opinion given by you as an auditor an appropriate opinion, a right opinion, a correct opinion? You may say it right, but there is every possibility. That the transactions which were not selected and verified by the auditor may have contained material misstatements. Only selected transactions do not contain any material misstatements. Remaining 95,000 transactions which were not selected and verified by the auditor may have contained several mistakes or misstatements. And unfortunately, you failed to find them. Unfortunately, the auditor failed to detect. Unfortunately, the auditor failed to detect material misstatements in the financial statements. In the given example, why the auditor failed to detect material misstatements? Why the auditor have failed in detecting material misstatements? Please tell me the answer. Because the auditor followed a technique called as audit sampling, and because the auditor has not verified all the transactions, the transactions which were not verified by the auditor may contain several material misstatements which could not have been detected by the auditor. Now tell me, are the financial statements reflecting a true and fair view? Yes or no? No. But what was the opinion given by the auditor? Clean opinion. So what is the opinion to be given by the auditor and what was the opinion given by the auditor? What is the opinion to be given by the auditor and what was the opinion given by the auditor? Auditor must have to give, very good, a modified opinion. But in the given case, what was the opinion given by the auditor? Unmodified opinion. Very good, very good. The auditor has given an unmodified opinion in a situation where auditor is required to give a modified opinion. Yes or no? Now, do you agree that in the given example, the auditor have failed? Do you agree that in the given example, the auditor failed in detecting all material misstatements? Why the auditor failed to detect all material misstatements? Because the auditor is forced to follow audit sampling. And after listening to this, some of you people may be of the opinion that had the auditor verified all 1 lakh, had the auditor verified all 1 lakh transactions, he could have identified all material misstatements in the financial statements. Since the auditor had verified only part of the transactions, the auditor failed to detect material misstatements. Maybe your opinion after listening to this. Even if you verify all the transactions, is there any guarantee? Even if you, very good, very good. Even if you verify all the transactions entered by the organization, will there be any guarantee that the auditor would be able to detect all material misstatements, all frauds? Why? Why? Because a person who is perpetrating the fraud will always try to conceal the fraud cleverly. People with fraudulent mentality are more cleverer than the auditor. So naturally, they will try to conceal the fraud. They will try to conceal the fraud. As an auditor, we put our best efforts to identify frauds. But at times, it may so happen, that by mistake, the auditor would not be able to detect such frauds. And hence, the auditor would fail to detect material misstatements. These things can happen. Because of this, as an auditor, don't try to say that I am giving a dash, a guarantee. I am giving a dash, certificate, as to dash, as to truthness and fairness of the financial statements. We merely express an opinion. You have listened to the classes very well. You have prepared for the subject very well. You have written the exams very well. Is there any guarantee that you will pass the exam? Why? Why? There is always some risk. There is always some risk of failure. Similar to that, even when the auditor performed the audit with the utmost skill, care, caution, competence, without negligence, still there is a possibility that sometimes the auditor could fail in detecting frauds. One reason is because the auditor may have followed audit sampling. The second reason is even if you verify all the transactions, frauds perpetrated by employees or management could have been cleverly concealed. When clever concealment is there, despite of the best efforts of the auditor may not be able to detect frauds. That is the reason why, as an auditor, don't try to give dash or dash, but try to give only dash. Try to give only an opinion. Don't try to give any guarantee or a certificate. If you are able to give a guarantee or a certificate, it is said that you are giving an absolute assurance. What is that? If you are able to provide a guarantee or certificate, it is said that you are giving an absolute assurance. To whom and about what? Absolute assurance to whom and about what? Very good, very good. So, if you are able to give a guarantee or certificate, it is said that you are giving an absolute assurance to whom? To the users of ఆయన వచ్చిన అదేగా చేసేది. I will decide whether to give a break or not. Don't insist me, okay? Right. So, to whom? To the users of the financial statements. About what? About the truthness and fairness of the financial statements. So, don't try to give a dash assurance. Try to provide only an opinion. Try to provide only an opinion. When you give an opinion, it is said that you are not giving an absolute assurance, but you are giving a reasonable assurance. What is that? You are giving only a reasonable assurance. As an auditor, we cannot give an absolute assurance. We can give only a reasonable assurance. Do you find any difference between the terms absolute assurance and reasonable assurance? Which is high and which is low? Absolute assurance is the highest level of assurance that we cannot give as an auditor because of the existence of inherent limitations in the process of audit. We are expected to provide only a reasonable assurance. If you give an assurance, it will enhance the confidence of dash. Very good. If the auditor gives an assurance that we checked these financial statements thoroughly and we find that these financial statements are free from material misstatements and hence they are reflecting a true and fair view, it certainly enhances the degree of confidence of the users about the financial statements, about the way in which financial statements are prepared. So auditor's opinion will enhance dash of dash. Auditor's opinion will enhance dash of dash, will enhance the confidence, will boost the confidence of the users of the financial statements. Why? Because we are competent, we are having qualification, we are having experience, and hence we are able to form a correct opinion to the extent possible, and we are expressing that opinion. So as an auditor, don't try to give a dash assurance, but always try to give a dash assurance. Don't try to provide an absolute assurance. Try to provide only a reasonable assurance. Understood? If you give an absolute assurance, it is said that you are giving dash, a guarantee or a certificate that you cannot give. Why? Because of existence of inherent limitations of audit. That is the reason why as an auditor you are always expected to give a dash opinion, a dash assurance, reasonable assurance, and not an absolute assurance. Remember, not reasonable assurance is an assurance which is lesser than the absolute assurance, but reasonable assurance is also a high level of assurance. Reasonable assurance is also a high level of assurance, but not as high as dash. Very good, very good. The things that are required to be explained to you after 1.5 to 2 months are being explained to you now, and I am fortunate enough that you are able to follow them. This question is very, very important for you to understand the term reasonable assurance in a better way. So write a short note on inherent limitations of audit. This question is important for you to have a better understanding of the term reasonable assurance. As already said to you, as an auditor, we cannot provide an absolute assurance. We can provide only a reasonable assurance. Why? Why? Because of the existence of some inherent limitations in the process of audit, as well as inherent limitations in internal controls. This point is not new to you. A point related to this has already been explained under the heading Audit Engagement Letter. I will try to show you that particular point where the auditor declared to the management that Even though the audit is properly planned and properly performed, even though the audit is properly planned and properly performed, there is always a possibility that some of the material misstatements in the financial statements cannot be detected by the auditor due to the existence of inherent limitations of audit and inherent limitations of internal control. This is what I explained to you under the heading audit engagement letter. These are all nothing but contents of audit engagement letter. That means auditor made it clear to the management. Auditor made it clear to the management that he is not able to identify every misstatement that is appearing in the financial statements. To the extent possible, the auditor will always try to identify misstatements, but there is no guarantee that the auditor will be able to identify all material misstatements. Few may be identified by the auditor, few may not be identified by the auditor. When the auditor is unable to identify the material misstatements in the financial statements, then what is the need of audit? Because of the existence of inherent limitations of audit and inherent limitations of internal controls, it is quite impossible for us as an auditors to provide a guarantee or certificate. And I compared this inherent limitations of audit with the normal loss which is known to you. What is a normal loss and what is an abnormal loss? This is not the first time I am asking you this question. This question was already asked. You have provided an answer for this question, but because we are going to have a discussion on the concept of inherent limitations of audit, I am trying to repeat the question. What is the difference between a normal loss and an abnormal loss? Normal loss is unavoidable. You know that there is a loss, but you cannot avoid it. That type of loss is technically called as normal loss. Then what is abnormal loss? A loss which can be avoided is technically called as an abnormal loss. To have a better understanding of this, I have explained you an example for this also. Just now, you have opened the cap of the petrol tank of your vehicle. When you open the cap of the petrol tank of the vehicle, you can observe the loss of petrol. Petrol will get evaporated. In that case, evaporation of petrol is nothing but a loss. Can you stop that loss? Was the question that I asked you. And some of you people said that it is not possible. Then I said that when you close the cap of the petrol tank, you would be able to stop that loss. Evaporation can be stopped. Evaporation is there because you opened the cap of the petrol tank. If you shut down the cap of the petrol tank, then you can stop that evaporation. A loss which you can stop is technically called as dash. Abnormal loss. Then what is a normal loss? Even if you close the cap of the petrol tank, still there will be some evaporation of petrol. How it is possible? How evaporation is possible when you close the cap of the petrol tank? The logic is so simple. Petrol shall have to travel from the tank to the engine. There will be several wires through which petrol will travel from the tank to engine. In that process, sometimes there may be some evaporation of petrol that you cannot stop. What cannot be stopped is called as normal loss. What can be stopped is called as abnormal loss. And this inherent limitations of audit and inherent limitations of internal controls are compared with normal loss. You know that there are limitations, but you cannot overcome it. You know that there are some limitations, but you cannot overcome it. My height is 6 feet 1 inch. And I am of the opinion that ideal height is 5 feet 11 inch. And hence, I want to reduce my height by 2 inches. I want to reduce my height by 2 inches. Now, I want to give you 3 options. Please select one of those 3 options to reduce. That is what I told you. So the first alternative is I can cut my head for 2 inches. The second option is I can cut 2 inches of my legs. And the third option is 1 inch of head and 1 inch of foot. Is there any option or alternative available to achieve my objective? No. Certain. No. It is not you, it is me. That is the reason why I am saying it as no. If it is you, I can say as yes. Okay. So, I know that there is a limitation, but I cannot overcome it. I cannot avoid it. That type of limitation is technically called as dash. Inherent limitation. The process of audit itself contains some limitations. Because of such limitations, you cannot give an absolute assurance. You can give only a reasonable assurance. You cannot give any guarantee or certificate. You can give only an opinion. Okay, right. Then what are the inherent limitations of audit? Some of these points are very easy to understand. Some are very difficult to understand. Be careful. Distinguish between absolute assurance and reasonable assurance. Identify the types of assurance that is expected in an audit of financial statements. In an audit, we give only a dash assurance, a reasonable assurance, clearly outlining the reasons to justify your point of view. Or the process of auditing is such that it suffers from certain limitations which cannot be overcome irrespective of the nature and extent of audit procedures. You cannot overcome these limitations, whatever be the nature of procedures that you have followed, or whatever be the extent of audit procedures that you have followed. That is the reason why they are being called as dash. Inherent limitations of audit. So simply speaking, the following are said to be the inherent limitations of audit. First of all, they started explaining about the difference between the absolute assurance and reasonable assurance, which are very well known to you. Then they started explaining about the inherent limitations of an audit. Now, go through the first point. Nothing to explain under point number 1. Absolute versus reasonable assurance. The only point that you need to recognize under this heading is reasonable assurance is also a high level of assurance, but it is not as high as an absolute assurance. Don't think that reasonable assurance is a low level of assurance. It is not low. It is also a high level of assurance, but it is not as high as an absolute assurance. The auditor is not expected to and cannot reduce audit risk to zero, and cannot therefore obtain absolute assurance. Do you know what is meant by audit risk? What is audit risk? Audit risk can be defined as the risk arising to the auditor in a situation where the auditor expresses an inappropriate audit opinion when the financial statements are materially misstated. When financial statements are materially misstated, appropriate report to be given by you as an auditor is modified report. So issuing a modified report is appropriate. In such a case, if you have given an unmodified report, it is said that the report given by you is inappropriate. When the report given by the auditor is inappropriate, the risk, if any, arising to the auditor from such a situation is technically called as audit risk. Audit risk cannot be reduced by the auditor to zero. Why? Why? Because even if you perform every audit procedure, is there be any guarantee that you would be able to identify all material misstatements in the financial statements? I repeat the question. Even if you perform every available procedure, will there be any guarantee that you will certainly be able to identify all material misstatements in the financial statements? Even if you thoroughly check each and every transaction, there is no guarantee that some of the misstatements have misstatements that were there in the financial statements may be identified by the auditor. Some may be identified, some may not be identified. In fact, that point has already been included by the auditor in the audit engagement letter itself, saying that even though the audit is properly planned and performed, there is no guarantee that we will be able to identify all material misstatements in the financial statements. So some material misstatements or few material misstatements could not be detected by the auditor. So there is every chance that some material misstatements in the financial statements could not be detected by the auditor, and hence the opinion given by the auditor may become wrong. There are material misstatements. You fail to detect those material misstatements. Therefore, you are of the opinion that financial statements are free from material misstatements, and hence you have given an unmodified opinion. In a situation where you are expected to give a modified opinion, that means there is some sort of risk. Yes or no? Are you able to follow this point or not? There are some material misstatements in the financial statements. Despite of his best efforts, auditor is unable to identify those material misstatements. When you are unable to detect material misstatements, what will be your opinion as an auditor? Misstatements are not there. So you have satisfied that financial statements are free from material misstatements. Hence, had given an unmodified opinion. In a situation where you need to give a modified opinion, that means opinion given by you is inappropriate. Therefore, there is a risk to you called as audit risk. You can have some sort of risk. You cannot reduce your risk to zero. Yes or no? Please say yes or no. So, that is the reason why auditor is giving a reasonable assurance. He cannot give an absolute assurance. And more importantly, sometimes you may have followed only sampling. You may not have verified 100% of the transactions. Even if the auditor verifies 100% of the transactions, there is no guarantee that the auditor would be able to detect all material misstatements in the financial statements. For example, I am the auditee, you are the auditor. You have made 100% verification of the transactions. I entered into a fictitious sale transaction. I entered into a fictitious sale transaction with one of my relatives. Actually, sale has not taken place, but I recorded an entry into my books of account, debiting my relative account and creating sales account with an amount of 1 lakh. Since preparation of sale invoice is in my hands, I prepared a false or fabricated sales invoice. Immediately, I also directed my relative that there is a possibility that our auditor may follow external confirmation with you, and our auditor may ask you saying that the balance in my client's books of account is 1 lakh. Do you agree with this balance? There is no balance in your books. But still you can say that, please say that the balance appearing in your books of account is also 1 lakh. That is the instruction given by me to my relative. So in the given case, what you observed is the entity under your audit had entered into a fake sale transaction. To support that fake sale transaction, they have prepared a fake sale invoice, and they started managing the other party, saying that the other party had to give a confirmation to the auditor that the balance appearing in his books of account is also 1 lakh. Thereafter, you came for audit. During the course of performance of audit, you got a doubt about the balance of that particular debtor. When the auditor got a doubt about the balance of a particular debtor, what the auditor is expected to do? First of all, the auditor is required to check all the debits and all the credits in the debtor account with the help of supporting documentary evidences. You did that, and still you have some doubt about the correctness or otherwise of the balance of that particular debtor. In that case, what can you do as an auditor? You can follow dash with that particular debtor. You can follow external confirmation procedure with that particular debtor. Auditor followed external confirmation procedure. The other party responded saying that the balance in his books of account is also 1 lakh. What else could you do as an auditor? Nothing. Nothing can be done by the auditor. Invoice is provided to the auditor. Auditor followed external confirmation procedure. Everything supports the sale transaction. But in reality, sale transaction is not a real one. It is a fake one. Is it possible for you really to identify that sale transaction as a fake sale transaction? Yes or no? That is the reason why I am telling you from the past several days that even if the auditor checks 100% of the transactions, there is no guarantee. Even if the auditor checks 100% of the transactions, there is no guarantee that auditor would be able to detect material misstatements. Because when a person involves in a fraud, he will certainly try to conceal it. In order to conceal the fraud, he will put every effort, and hence auditor could not be able to detect it. That is the reason why even if the auditor verifies 100% of the transactions, there is no guarantee that the auditor would be able to detect all material misstatements. Few of the misstatements may not be detected by the auditor. That in that case, the opinion given by you will become dash wrong. When the opinion given by you becomes wrong, there will be some sort of risk to you. That risk is technically called as dash audit risk. But remember, you can reduce your audit risk, but you cannot eliminate it by proving yourself that you performed your work with utmost skill, care, caution, competence, and without negligence. It seems I have explained this point to you in the past. Yes or no? Done. Absolute assurance versus reasonable assurance. The auditor is not expected to and cannot reduce audit risk to zero. Actually, this point cannot be explained by a lecturer at this point of time. Why? Because audit risk is having three components. The first one is inherent risk. The second one is control risk. The third one is detection risk. I am going to explain these topics in future in a particular chapter called as risk assessment and internal controls. Under that chapter, this inherent risk and control risk are technically called as risk of material misstatements. And the institute said that risk of material misstatements is equal to inherent risk into control risk. Then the institute defined like this: audit risk is equal to risk of material misstatements into detection risk. Risk of material misstatements means inherent risk into control risk. Simply speaking, audit risk is equal to inherent risk into control risk into detection risk. If you know this, then only you can understand this point. Otherwise, you cannot do that. So this point is not that much easy to understand. In the best possible way, I tried my level best to explain you about the concept of audit risk and to prove that audit risk cannot be reduced lesser than zero. Audit risk cannot be maintained by the auditor at zero level. Always there will be some sort of risk to the auditor. So you cannot make audit risk as zero. That is the most important aspect that you must understand, and you will come to know about this point in future when we start a discussion on a chapter called as risk assessment and internal control. The name of the chapter itself is risk assessment. The auditor is not expected to and cannot reduce audit risk to zero and cannot therefore obtain absolute assurance. This is because there are inherent limitations of an audit which result in most of the audit evidence on which the auditor draws conclusions and bases the auditor's opinion being persuasive rather than conclusive. Persuasive means only primary evidences. You cannot conclude. Even if you verify all the debits and credits, you cannot conclude that the debtor balance is correct. Even if you follow external confirmation procedures, you cannot conclude that the debtor balance is correct. That means you are getting only dash evidence rather than dash evidence. You are getting only a primary evidence. As an auditor, you are able to collect only primary evidence. Primary evidence is technically called as persuasive evidence rather than conclusive evidence. If you are capable of getting conclusive evidence, you are capable of giving an absolute assurance. Since you are getting only a dash evidence, a primary or persuasive evidence, you can give only a dash and not dash. You can give only a reasonable assurance and not an absolute assurance. Read the point again. Point number 1 and 2. The auditor is not expected to and cannot reduce audit risk to zero and cannot therefore obtain absolute assurance. This is because there are inherent limitations of an audit which result in most of the audit evidence on which the auditor draws conclusions and bases the auditor's opinion being, this is nothing but most of audit evidence on which the auditor draws conclusions and bases the auditor's opinion is nothing but the new definition of audit evidence. Have any one of you observed this point? What is the new definition of audit evidence? Audit evidence can be defined as any information used by the auditor in arriving at conclusions. Have you identified the term conclusion here? In arriving at conclusions on which auditor's opinion is based. Have you identified based? So this is nothing but new definition of audit evidence. The third one, because of the inherent limitations of an audit, there is an unavoidable risk that some material misstatements may not be detected even though the audit is properly planned and performed. This term has been written on the screen under the heading disclaimer. Yes or no? Read it. Disclaimer. Although the audit is properly planned and properly performed. So, because of the limitations of an audit, there is an unavoidable risk that some material misstatements of the financial statements may not be detected, even though the audit is properly planned and performed in accordance with standards on auditing. This risk can be called as an audit risk. Okay, done. Now, the inherent limitations of, have you understood this last sentence? This risk is called as audit risk. So you may fail to detect some material misstatements, but you do not know that you failed to detect some material misstatements. In that case, you are of the opinion that financial statements are free from material misstatements. In that case, instead of giving a dash opinion, you would have given a dash opinion. Instead of giving a modified report, you would have given an unmodified report. That report given by you is a wrong report or inappropriate report. Risk arising therefrom is technically called as dash, audit risk. Next. Then what are the inherent limitations of audit? This is very difficult. Be careful. Are you following? Right. Nature of financial reporting. Don't try to understand the heading. It is difficult. Try to understand the content first. If you are able to understand the content, you will automatically understand the heading. Okay? Content. The financial statements preparation of financial statements. Generally, objective behind providing material by the CA Institute to you. Generally, the objective behind providing material by the CA Institute to you is to ensure that every student is having a good understanding of the subject when the student gone through the material, for which the material should be prepared in a lucid way and ensuring that everything is understandable to the student with minimum effort. But unfortunate thing is that the CA Institute is doing it in a reverse way. And if you try to read the institute's material, you will understand that even a point which is known to you is difficult to understand. Even a point which is explained in detail in the classroom is very difficult for you to understand by going through the institute's material. That is the typicality of the wording that has been used in the CA Institute's material. I don't understand. క్లాసులో ఉండగలిగితే ఉండొచ్చు, లేకపోతే వెళ్ళిపోవచ్చు, నాకేం నష్టంలా. But if you are sitting in the class, you must have to listen to it. I don't spare the persons who are not listening to the class. Okay? You'll be kicked away out of the room. No doubt about that. And I won't allow you any time after that. Once I kicked you out of the room, I won't allow you to my class. Okay? Done. ఇంతకన్నా ఎక్కువ చెప్పలేనమ్మా, ఎందుకంటే మీరు తెరిచావదు. మీకు చిన్నపిల్లలు 2 సార్లు ఎగ్జామ్ రాసేప్పటికి 1 year తిరిగిపోతుంది. అంటే ఒక 4 ఏళ్ళు అయిన తర్వాత మనం ఎక్కడున్నామా అని చూస్తే అక్కడే ఉంటాం. అలాంటి దరిద్రపు కోర్స్ ఇది. బీ కేర్ఫుల్. రోజులు తిరిగిపోతూ ఉంటాయి, ఏం చేస్తున్నామో తెలియదు, రోజులు మాత్రం అయిపోతూ ఉంటాయి. అలాంటి కోర్స్ ఇది. కాబట్టి డోంట్ టేక్ ఇట్ లైట్లీ అండ్ డోంట్ టేక్ దిస్ సబ్జెక్ట్ లైట్లీ. ఆఫ్టర్ ఆల్, ఆఫ్టర్ పాసింగ్ CA, you will be called as auditor. Without having knowledge of auditing, how people will call you as auditor? So try to understand the subject. The financial, if you start focusing on the subject, you will start enjoying it. And I'm here to explain the subject for 100 times if you face any problem. That is what I can do. But I can't create interest in the subject because the subject is like that. I cannot play jokes with you and I cannot create interest in you while explaining this subject. The subject is very hard, a crack nut to hard. A hard nut to crack. That is the problem with this subject. And if you read this subject for 100 times, and if you start reading it for one not first time, and you will feel that some of the words are not known to you. That is the difficulty of this subject. Be careful, and it is very difficult for the student to get more marks in this subject as well. Be careful. నాకేం మీ మీద ద్వేషం లేదు. నువ్వు నేను 400 ఏళ్ల క్రితం పుట్ల, నీ మధ్య నా మధ్య వాళ్ళు లేరు ఎవరు. కాబట్టి మీరు వింటే బాగుపడతారు. పిల్లలు మీ బొంద మీకేం తెలియచావదు. మీ కిందకి 18 ఏళ్ళు ఉన్నాయి. దేనికెందుకో నేను చెప్పలేను. The financial statement preparation. The financial statement preparation involves many judgments. The financial statement preparation involves many judgments and assumptions. Many judgments and assumptions made by the management. Many judgments and assumptions made by the management. This is called as assumption number 1. This is called as assumption number 2. These two assumptions have been taken by whom? By the management in identifying provision to be created in respect of warranty claims or guarantee claims, which is to be made part of dash financial statements. So several judgments and assumptions shall be made by dash in preparation of dash, in preparation of financial statements. And even I said to you that sometimes these assumptions made by the management may be either reasonable or are unreasonable. If they are reasonable or are unreasonable. If they are reasonable, there would not be any problem either to the management or to the auditor. If judgments made by the management and assumptions made by the management are unreasonable, then the accounting estimates made by them cannot be relied upon. They may have contained some material misstatements, and such mistakes or misstatements in the estimates may be either intentional or unintentional. To explain you about the term unintentional, I said to you that because of uncertainty, accounting estimate made by the management will become wrong. Example, the lawyer says that this is a unique case in the history of law, and hence lawyer suggested you to create a provision of 5 lakhs. But at the end of the judgment, you recognized that you need to pay an amount of 5 crore rupees. That means instead of creating a provision of 5 crores, you have created a provision of only 5 lakhs. And that has not been done by the management intentionally. It was done unintentionally because of dash associated with item. Uncertainty associated with that item. Sometimes management could have created some accounting estimates intentionally as wrong accounting estimates. Yes or no? Read it. The financial statements preparation involves many judgments and assumptions by management in applying the requirements of AFRF. In addition, many financial statements items involves subjective decisions or assessments or a degree of uncertainty, and there may be a range of acceptable interpretations or judgments that may be made. These assumptions or estimates may go wrong. Why they may go wrong? Either because of uncertainty or because of management involvement in fraud, either intentionally or unintentionally. If there is an uncertainty, what the management could do? If there is an uncertainty, what the management could do? What the auditor could do? Nobody is able to do anything in respect of items having high uncertainty. Yes or no? In that case, management created a provision of 5 lakhs. Later on, the court ordered the organization to pay an amount of 5 crores. Can anybody go to court of law against the auditor stating that auditor failed to identify this provision as unreasonable? No. Why? Why? Because of uncertainty, it is not possible either for dash or for dash to create a reasonable estimate, either for management or for the auditor. Read it. The financial statement preparation involves many judgments and assumptions by management. In addition, many financial statements items involves the same point is repeated in a different way. That's it. It is not a new point at all. In addition, many financial statement items involves subjective decisions or assessments or a degree of uncertainty, and there may be a range of acceptable interpretations or judgments that may be made. These assumptions or estimates may go wrong, which can make the auditor opinion may go wrong, which can make the auditor's opinion wrong. Accounting estimates, only for this I have explained you what is accounting estimate, what is the responsibility of the management, what is the responsibility of the auditor, and every other thing. Okay. Accounting estimates such as life of assets, provision for doubtful debts, net realizable value of inventory, all these things are nothing but assumptions. They may go wrong and they may not be identified by the auditor, so that the auditor's opinion will also become wrong. That is the reason why as an auditor you cannot give an absolute assurance. You can give only a reasonable assurance. One of the premises or premise means basis. Some people call it as premise. Some other people may call it as premise. They both mean one and the same. Base. Premise means a base. One of the base for conducting an audit is that management acknowledges its responsibility of preparation of financial statements in accordance with applicable financial reporting framework and devising suitable internal controls. However, such controls, who is responsible for establishment of internal controls? Management. However, such controls may not have operated to produce reliable financial information due to their own limitations. What is meant by own limitations? Inherent limitations of internal controls. Inherent limitations of, that is the reason why I said to you that mere existence of internal controls will not give any guarantee as to the non-existence of frauds and errors. They merely reduce the possibility of occurrence of frauds. They cannot eliminate the possibility of occurrence of fraud. This is said to be one of the inherent limitations of internal controls. So everything is related to one another. Inherent limitations of internal controls and inherent limitations of audit are having some relationship with one another. So because of this, there is every chance that the auditor may fail in identifying that the assumptions made by the management or estimates made by the management are wrong. That is one of the limitations of internal controls. Why the auditor is unable to judge whether it is reasonable or not? Because of dash attached with an item. Even lawyer do not know how auditor is expected to know it. Even the lawyer do not know, then how the auditor is expected to know it? That is nothing but what the lawyer do not know. Lawyer is of the opinion that this case is unique in the history of law, and hence he is of the opinion that an amount of 5 lakhs may have to be paid. Ultimately, it is decided that the entity has to pay an amount of 5 crores. When the lawyer himself do not know how much is the amount of provision to be created, how the auditor is expected to do that? That is the reason why that is nothing but a limitation of dash, a limitation of audit. Okay, so nature of financial reporting is like that, and hence auditor may fail to identify such misstatements. That is one reason why the auditor could fail. The auditor could fail in identifying every misstatement in the financial statements. Therefore, there is a chance that some material misstatements may not be identified by you as an auditor. In that case, you cannot give an absolute assurance. You can give only a reasonable assurance. Next one. The nature of audit procedures. The auditor carries out his work by obtaining audit evidence through performance of audit procedures. What procedures do you follow as an auditor to obtain sufficient appropriate audit evidence? What procedures do you follow as an auditor to obtain sufficient appropriate audit evidence? Risk assessment procedures, further audit procedures, which includes compliance procedures, substantive procedures. Substantive procedures includes tests of details of transactions and balances and substantive analytical procedures. Unfortunately, I have not explained you some other audit procedures which are there in SA 500, and I felt that these procedures are to be explained or can be better explained while having a discussion on SA 500. But a point comes wherein I need to explain those points without which I cannot move forward. So I will try to explain them briefly again. Okay? There are certain other procedures. There are certain other procedures that the auditor need to follow to obtain sufficient appropriate audit evidence. And fortunately, out of those, some are known to you. When I say a particular procedure and when it is known to you, please say that you know it to you. Okay, that point is known to you. Ready? The first one is inspection. The second one is observation. The third one is inquiry. The fourth one is confirmation. The fifth one is recalculation. And the sixth one is reperformance. These are the other procedures that were mentioned in SA 500, which are to be followed by the auditor to obtain sufficient appropriate audit evidence. Out of these six things, I feel that you are having a knowledge of the terms observation, inquiry, and confirmation. And if you stretch further, you can even understand the term recalculation. What is observation? The point called as observation has been explained to you when I am having an explanation, giving an explanation about visual evidence. Very good, very good. Visual evidence, for which I have given you an example as well. What was the example? I got a doubt about the number of students who are sitting in the class. So I want to ascertain the number of students who are sitting in the class. In that case, I'm having two options. Option number one, I can count the number of students sitting in the class on my own. Yes or no? That means I'm carrying out an inspection on my own. I'm physically inspecting each and every student to identify the number of students who are there in the class. Or else I could ask the coordinator to count the number of students. Then he will start counting the number of students. When the coordinator started counting the number of students, what I do is I will try to observe the process being followed by the coordinator. Even if I observe the process followed by the coordinator, checking whether numbers are correctly being counted by him or not, I can say that the number of students in the classroom are this much. So I can inspect on my own. Or else I could observe. What is meant by observation? I have given you an example for observation also. Observation can be defined as looking at a process. Observation can be defined as looking at a process or operation. When somebody is performing that process or operation. If somebody is doing something and if you start observing him, it is called as dash. Observation. So you can obtain evidence not only by performing inspection, you can even obtain evidence by following a procedure called as dash. Can you define what is observation? Observation can be defined as looking at a process or operation when somebody is performing that process or operation. So out of 6 things, observation is well known to you. Then what is about confirmation? Have I explained you the term direct confirmation procedure or not? Have you identified the term confirmation therein or not? So if you follow direct confirmation procedure, what will you do? You will start making an inquiry. You will start making an inquiry with a third party about the correctness of a particular information. Yes or no? The balance in our books of account is 1 lakh. Do you agree with this balance? Yes or no? This is the way in which the auditor has written a letter to the debtor. Why the auditor has written a letter to the debtor? Inquiring about, to inquire about the correctness of the balance of a particular debtor. Auditor followed a procedure called as direct confirmation procedure. Fortunately, the other party has given a response to the auditor. I used the term fortunately with an intention. Why? Because there is no obligation on the part of the other party to respond. Other party may respond, other party may not respond. Fortunately, I got information or a response from the other party. That response received by the auditor from the other party is technically called as dash confirmation. Inquiry means ascertaining the correctness of information. Response means confirmation means a response to inquiry. Should I write this on the board? What is inquiry? Ascertaining the correctness of a particular information is technically called as dash. Ascertaining the correctness of information is technically called as dash inquiry, and response to such an inquiry is technically called as dash confirmation. Why the auditor is following all these things? To get, to obtain, to collect sufficient, appropriate audit evidence. So what are the other procedures that the auditor need to follow to obtain sufficient, appropriate audit evidence? Inspection, I haven't explained that to you till now. Observation, known to you. Inquiry, just now explained briefly. Confirmation, just now explained in full. There is nothing to explain under the heading confirmation. Then the next one is inspection. I will do one thing. I will try to explain the term inspection further. Okay? What is inspection? The term inspection includes 3 things. The first one is physical inspection. This is known to you. Yes or no? Management said that there are 1,000 units in the closing stock. Management also said that each unit is having a value of 100. And then management specified the value of the closing stock as 1 lakh rupees. Now as an auditor, you need to check the correctness of this value. To check the correctness of the value of the closing stock, what the auditor should do? First of all, the auditor should check the correctness of number of units. The organization is claiming that they are having how many units? 1,000 units. Then they are also claiming that each unit is having a value of 100. And hence they are saying that the value of the closing inventory is 1 lakh. Now you got a doubt. Correctness of 1 lakh is dependent upon correctness of 1,000 also. Yes or no? In that case, how do you check whether these 1,000 units are really there or not? You need to make physical count. You need to make physical inspection, and then you need to count the number of units. Therefore, inspection includes dash. Inspection includes physical inspection. Organization claimed that I am having a building. You got a doubt whether the organization is really having a building or a building is in existence or not. Then you asked management to show the building to you. You want to make physical inspection of the building. and by making physical inspection, you have satisfied that building is actually there. So physical dash forms part of dash. Physical inspection forms part of inspection. Sometimes you may have to inspect supporting documents. Supporting documents. For example, the entity says that it purchased some items from a supplier. In that case, to ascertain the correctness, what will you do? You need to check that purchase with the help of, you need to inspect documents relating to purchase. What is inspection of documents relating to purchase? Purchase invoice. Or else, organization claimed that they are having a building. They are the owners of a building. In order to check whether the organization is really the owner of the building or not, what the auditor is expected to do? The auditor is required to inspect the dash, the title deeds. Yes or no? So inspection includes inspection of physical inspection, inspection of documents, inspection of documents, and inspection of records also. Inspection of records. Now, just go through what are the other procedures that are followed, that are available to the auditor to obtain sufficient appropriate audit evidence. Inspection, briefly explained; observation, explained in full; inquiry, briefly explained; confirmation, explained in full. The next one is recalculation. Sometimes this technique will be followed by the auditor. For example, client provided for depreciation. Then, without going through the correctness of depreciation, the auditor can go through the records. The auditor can go through the records, can identify the cost of the asset, can identify the life period of the asset, can calculate depreciation on his own. The depreciation so calculated by the auditor can be compared with the depreciation calculated by dash management. If those two tally, then the auditor can get a confidence that what is calculated by us and what is claimed in the books is one and the same. In that case, you can satisfy that depreciation is correctly calculated. To come to that conclusion, what the auditor did, the auditor made recalculation of the amount. This will be carried out by the auditor for several things like managerial remuneration. Management claimed some managerial remuneration. Section 197 and 198 of the Companies Act deals with managerial remuneration and how to calculate it. Therefore, auditor will follow such sections, will try to calculate managerial remuneration on his own, and the managerial remuneration so calculated by the auditor can be simply compared with the managerial remuneration claimed by the management. If those two are comparable, you can satisfy that what is done by management is correct. Then in that case, what the auditor is doing is repeating the process that has already been followed by the, you are repeating the process that has already been followed by the management. That is technically called as dash recalculation. I cannot explain you what is reperformance as of now. Okay, please try to understand my inability to explain the term reperformance. That is very difficult to understand, and that I will do while having a discussion on essay 500. Now read it. Nature of audit procedures. The auditor carries out his work by obtaining audit evidence through performance of audit procedures. However, there are some practical and legal limitations on the ability of the auditor to obtain audit evidence. On the ability of the auditor to obtain audit evidence. Sometimes, although the auditor wants to obtain audit evidence, the auditor may not be in a position to obtain such evidence. The best example is auditor wants to follow external confirmations. In that case, auditor first of all should take prior permission from the client. If client has not permitted the auditor, is it possible for you to follow direct confirmation procedure? No. That means a procedure that the auditor requires to follow has not been followed by the auditor. The procedure that is required to be followed by the auditor has not been followed by the auditor. Why? Why the auditor failed to follow a required procedure? Are you following my discussion or not? Should I explain this again? During the course of performance of audit, you got a doubt about the correctness of a particular balance. You checked the debits and credits. Still there is a doubt. In that case, you need to follow external confirmations. For that, you need to take permission from the client. Unfortunately, client is not permitting you to follow direct confirmation or external confirmation procedure. So the auditor wants to follow external confirmation. Client is not permitting the auditor to do that. That means a procedure that the auditor wanted to follow cannot be followed by the auditor. When you want to follow a procedure but you fail to follow that procedure, you may not be able to obtain sufficient appropriate audit evidence. In that case, there is every chance that the opinion given you may become wrong, may become inappropriate. So, for example, an auditor does not test all the transactions and balances. Why? Very good. The auditor cannot test all the transactions and balances because of time constraints. This is the point where I introduced you the concept of audit sampling. Very good. If you start providing answers to me, I will have an immense pleasure in listening to them. Immense satisfaction that you are following my discussion. Okay. For example, so there are practical and legal limitations on the ability of the auditor to obtain evidence, for which an example is given. For example, an auditor does not test all the transactions and balances. He forms his opinion only by testing samples. By testing samples. It is an example of a practical limitation. Management may not provide complete information as requested by the auditor. There is no way by which auditor can force management to provide complete information as may be requested by the auditor. In case he is not provided with required information, he can only report. It creates a legal limitation. Again, this is a hurdle on the part of the auditor. Auditor wanted some information from management. Management has not provided such information. What will you do as an auditor? You can't do anything. That means the information that you want to obtain is not obtained by you because of these problems. So because of some problems, auditor may not always be able to obtain required information. Because of that, auditor cannot give any guarantee or certificate. Sometimes you cannot obtain evidence. Sometimes you may obtain evidence, but in most of the cases that evidence is primary in nature. It is not conclusive in nature. With these limitations, is it practically possible for you to provide a guarantee or certificate? No, these are all limitations because of which auditor can only give a dash, an opinion and not a certificate, a reasonable assurance and not an absolute assurance. Are you getting my point? Right. Next. This is a general point which is easily understandable. The management may consist of dishonest and unscrupulous people and may be itself involved in fraud. What is meant by itself involved in fraud? Management itself involved in a fraud. That we call as dash. Management fraud. It may be engaged in concealing frauds by designing sophisticated and carefully organized schemes which may be hard to detect by the auditor. For this only I have given you an example wherein a fake sale invoice has been created, a fraudulent entry or a fictitious entry has been recorded in the books of account. Despite of the best efforts of the auditor could not be able to detect that the sale entry is a fake sale entry. That is always possible. Read it again. The management may consist of dishonest and unscrupulous people and may be itself involved in fraud. It may be engaged in concealing fraud by designing sophisticated and carefully organized schemes which may be hard to detect by the auditor. It may produce, every word is explained to you. Have you recognized that? It may produce fabricated documents before the auditor to lead the auditor to believe that audit evidence is valid. However, such documents could be fake or ungenuine or non-genuine. Therefore, he may be led to accept they may lead the auditor to accept invalid audit evidence on the basis of unauthentic documents. Therefore, the opinion given by you may not be correct. May be correct, may not be correct because of this limitation. What else could the auditor do? Auditor tried his level best, but because of these limitations, auditor cannot give any guarantee. That is what you need to understand. Next, this point is also certainly understandable to you. It is quite possible that entity may have entered into some transactions with related parties. Such transactions may be only on paper. That is nothing but a fake transaction and may not have actually occurred. May not have actually occurred. The auditor may not be aware of such related party relationships or relationships, or audit procedures may not be able to detect probable wrongdoings. I have followed even dash with dash. Auditor followed dash with dash. External confirmation procedure with my related party. But I have already given an instruction to my related party that provide an answer to the auditor as yes. Whatever the auditor asks, yes. And related party has given an answer as yes. In that case, is it possible for you to identify that the sale is a fake sale? No. These are all nothing but limitations of audit because of nature of audit procedures. Then audit is not an investigation. It is only an audit is only an audit. It is not an investigation. In audit, we always try to get primary evidence, not conclusive evidence. Even if you want to get conclusive evidence, you may not be able to obtain it. Whereas in investigation, they will always try to get conclusive evidence. So audit is not an investigation. The scope of investigation is much wider than the scope of audit. That is the reason why as an auditor, we can give only a reasonable assurance. There is no guarantee that we would be able to identify all frauds. Even if you perform investigation, there is no guarantee that you would be able to identify the culprit. Yes or no? In some extreme cases, in most of the cases, culprits will be identified. But in extreme, rarest of the rare cases, even if you perform investigation, you would not be able to detect the culprit. Yes or no? When investigation fails to detect the mistakes, how auditor is able to identify all the misstatements? Therefore, audit is not dash. It is not an investigation. Auditing is not an official investigation. We must clearly understand that audit is distinct from investigation. Investigation is critical examination of accounts with a special purpose. For example, if fraud is suspected and it is specifically called upon to check the accounts whether fraud really exists, it takes the character of investigation. Audit, on the other hand, as we have already discussed, the objective is to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatements, whether due to fraud or error, thereby enabling the auditor to express an opinion. Conclusion: audit is never started with a preconceived notion about state of affairs. What I said to you about this point, don't try to start your audit with a doubt, suspicion, or disbelief about the truthness and fairness of the financial statements, about wrongdoing, about some wrong having been committed, etc. And the next one is time. This is very difficult to understand. Future events. Let us first complete the term future events. Future events or conditions may affect an entity adversely. Adverse events may seriously affect the ability of the entity to continue its business. The business may cease to exist in future due to changes in market conditions, emergence of new models or products, or due to onset of some adverse events. Therefore, it is in the view of above factors that an auditor cannot provide a guarantee that financial statements are free from material misstatements due to frauds or errors. You cannot understand a single word out of it. I know it. And you can understand this only when you are able to recollect the importance of the term going concern which is known to you. What are basic accounting assumptions? What are basic accounting assumptions? The first one is going concern. The second one is accrual. The third one is consistency. Or else second one is consistency. The third one is accrual. The order may be different, points are one and the same. So what are the basic accounting assumptions? Going concern, consistency, and accrual are the basic accounting assumptions. What is the importance of basic accounting assumptions? every organization, while preparing their financial statements, shall have to follow these basic accounting assumptions. Yes or no? I repeat, every organization is under obligation to follow these basic accounting assumptions while preparing and presenting their financial statements. If they followed the basic accounting assumptions in preparation and presentation of financial statements, it need not be disclosed. It need not be disclosed. The fact that they followed basic accounting assumptions is not required to be disclosed by the management anywhere in the financial statements. Readers will make an assumption that since nothing is disclosed, probably dash would have followed dash in preparing dash. Since nothing is disclosed, readers will make an assumption that the organization had followed basic accounting assumptions in preparation and presentation of financial statements. Are you able to understand this point? So what is the point? The organization is under obligation to prepare and present their financial statements by following basic accounting assumptions. Those basic accounting assumptions are 3 in number. The first one is going concern, the second one is consistency, and the third one is accrual. If the organization has followed such basic accounting assumptions, there is no need that organization shall disclose in the financial statements that they have in fact followed basic accounting assumptions. That means the organization should keep quiet. There is no need to disclose the fact that you have followed basic accounting assumptions. If you fail to follow, if the management fails to follow any one or all of the basic accounting assumptions, it is necessary for them to disclose that fact in the financial statements. So, if you follow basic accounting assumptions or fundamental accounting assumptions, there is no need to disclose such fact in the financial statements. If you fail to follow basic accounting assumptions or fundamental accounting assumptions, you are required to disclose those facts in the financial statements. Now, let us focus our discussion only on the term going concern. Only on the term going concern. What is going concern? What is the importance of it? Please explain me. Then I will start explaining you. I cannot explain this point as of now. I can explain this point elaboratively in future because there is a specific standard that we need to discuss in future called as SA 570, which exclusively deals with the concept of going concern. I will try to explain you few points from SA 570 without which you cannot understand even a single word out of the heading future events. This is very difficult unless you understand SA 570 at least in brief. What do you know about going concern? Tell me. What is going concern and what is the importance that you know? Every organization, while preparing their financial statements, must have to follow going concern assumption. That means every organization has to make an assumption that they will continue in operation. They will continue in operation for a foreseeable future. They will continue in operation for a foreseeable future. That is what you know about going concern. Nothing more than that. I know it very well. Now, I want to ask you one more question, and I am sure you are unable to understand. You will certainly unable to understand that question. Even if you understand it, you cannot provide a correct answer for that question. It's a challenge. Ready? You are the management. You prepared financial statements by following going concern assumption. Don't take this example lightly. This is very difficult. Okay? You are the management. You have prepared your financial statements by following going concern assumption. Unfortunately, the assumption that you made in preparation and presentation of financial statements becomes wrong or inappropriate. There was a pin drop silence in the class. Now, the assumption made by you becomes wrong or inappropriate. When the assumption made by the management that it will continue in operations for a foreseeable future becomes wrong or inappropriate, the question is how it affects the financial statements. That is my question. It do affect the financial statements. That is statement number 1. Now question, how it affects financial statements. I know very well that you cannot provide an answer for that. If anybody is willing to provide an answer, stand up and tell me the answer. Do you understand the question? What is the question? Management followed going concern assumption, but unfortunately, the assumption made by the management in preparation and presentation of financial statements becomes wrong or inappropriate. Then what would be the impact of that on the financial statements? That was my question. What is that? Okay. I have received a good answer from where I have understood a clue which can be used by me to explain this concept in the briefest possible manner. Okay. If going concern assumption is wrong, what the management should do? Management could have prepared the financial statements by following liquidation basis. But unfortunately, management prepared their financial statements on going concern basis. In that case, what may happen? The financial statements prepared by the entity would become wrong. Why it is wrong, that I will explain you in tomorrow's session, because time may not be sufficient for me to explain this today. But I will do that. I will try to do that. Today's date is 31st March 2023. My name is A Limited. I am a manufacturer. I am a manufacturer of single-use plastic. I am a manufacturer of plastic carry bags. Single-use plastic. I am getting a very good amount of profits for the past several years. Today, that is on 31st March 2023, central government had given a circular in the official Gazette of India specifying that manufacturing of single-use plastic has been banned in India from 1st April 2023, and hence all the manufacturers manufacturing single-use plastic had to shut down their business effective from 1st April 2023. And this is known to me on 31st March itself. Okay? I am the management. I know that I need to stop my business from 1st April 2023, the very next day. And I am in the process of preparation of my financial statements as on 31st March 2023. I am in the process of preparing my financial statements as on 31st March 2023. I know very well that I cannot continue my business operations from the next day, that is from 1st April 2023. Very recently, I purchased a fixed asset worth rupees 1 lakh. Very recently, I purchased a fixed asset worth rupees 1 lakh. And I provided depreciation amounting to 10,000 on that asset. Now the value of the asset is being reflected, is to be reflected in my balance sheet at 90,000 rupees. So I reflected. Now, while preparing my financial statements as on 31st March, should I take going concern assumption or not? Am I allowed to take going concern assumption or not? Yes or no? So I cannot prepare my financial statements on going concern basis. But I decided to prepare my financial statements on dash basis, on going concern basis. Following, I know that it is wrong, but I followed going concern assumption. I prepared my financial statements, and accordingly, I have shown an amount of 90,000, a value of 90,000 against plant and machinery. This plant and machinery has been disclosed by me under the heading property, plant and equipment. Plant and machinery has been disclosed as a part of PPE, and the value of the plant and machinery has been shown as 90,000. Are you following this? Now, for the purpose of purchase of this property, plant and equipment, I have taken a loan from a bank worth rupees 1 lakh. So that amount, that plant and machinery has not been purchased by me with my own cash flow. I have purchased it by taking a loan from the bank. How much was the loan taken by me from the bank? 1 lakh rupees. And the banker has charged an amount of interest of 12,000 thereon. I haven't paid any interest. So the loan balance becomes 1 lakh 12,000. So the value of the loan is 1 lakh 12,000. This loan has been granted by the banker for a long period of time. That means I need to make the repayment of the loan over a period of 10 years. Therefore, I classified this loan as a non-current liability in my balance sheet. The asset has been classified. The asset has been classified as a non-current asset, and the asset has been classified as a non-current asset, and liability has been classified as a non-current liability. Asset is shown at a value of 90,000. Liability has been shown in the balance sheet at a value of 1 lakh 12,000. Now my question to you is the balance sheet prepared by me correct or not? Yes or no? If your answer is no, why? Why the balance sheet prepared by me is incorrect? Because in the balance sheet, I classified asset wrongly. I also classified the liability wrongly. Why? Because I cannot continue my operations. When I am unable to continue my operations, and if the bank knows it very well, what the banker will ask me? To make the repayment immediately. If I need to make this repayment immediately, should I classify that asset as a non-current liability as a non-current liability? No, it should have to be classified as a dash. So instead of classifying the liability as a dash, I classified it as dash. Instead of classifying that liability as a current liability, I making an assumption that I will continue in operation for a foreseeable future, making an assumption that I will make the payment over a period of 10 years, I classified it as a non-current liability. Now the banker is asking me to make the payment immediately, and there is no need for me to make the payment of 1,12,000. Banker wants to forego the interest. Banker is asking me to make a repayment of the original amount, that is principal amount of 1 lakh. Now I want to ask you two questions. Is the classification of liability done by me is right or wrong? Is the classification done by me right or wrong? Valuation done by me right or wrong? Classification is wrong. Classification of liability is wrong. Valuation of liability is wrong. Similarly, if I shut down my business, what should I do with this PPE? I need to sell it. When I am having an intention to sell it, when I am having an intention to sell the PPE, can I classify it as a non-current asset? No, that means classification of asset is also wrong. If I sell this, I would be able to fetch an amount of only 30,000. In that case, how much is the value to be reflected in the balance sheet? That is what you said. I need to prepare my financial statements on liquidation basis. So, I made wrong classification. I made wrong valuation. Therefore, my balance sheet is not said to be correctly prepared. Why this happens? Because dash taken by dash is inappropriate. Going concern assumption made by the management becomes wrong or inappropriate. The final conclusion. When the going concern assumption made by the management becomes wrong or inappropriate, then classification of assets and liabilities done by the management may become wrong. Valuation of assets and liabilities done by the management may also become wrong. When classification becomes wrong, valuation becomes wrong, how could you say that financial statements are correctly prepared? In that case, financial statements prepared by the entity would also become wrong. Why? Why? Because the organization had taken a wrong assumption or an inappropriate assumption while preparing the financial statements. That would be the impact of inappropriate going concern assumption on the financial statements. Financial statements will never reflect a true and fair view in such a case when the going concern assumption made by the management becomes wrong or inappropriate. This is the first and last time that you are listening to this type of explanation or analysis, you won't listen this analysis in your lifetime. This is the first time and the last time. Unless you understand this example, you cannot understand the importance of going concern assumption. If it is inappropriate, classification of assets and liabilities will become wrong, valuation of assets and liabilities will become wrong, and hence financial statements will also become wrong. That is the reason why, as an auditor, we are made responsible. As an auditor, we are made responsible to verify whether going concern assumption made by the management is appropriate or not. What is your duty as an auditor? You need to verify whether going concern assumption made by the management is appropriate or not. How do you check that? By following the procedures that were mentioned in SA 570. Some indicators like some indicators have been given in SA 570. They are technically called as events or conditions. Those events or conditions were classified in SA 70 as financial events, operating events, financial events, operating events, and other events. Under the heading financial events, we are going to have a discussion about 10 points. Under the heading operating events, we are going to have a discussion about 5 points. And under the heading other events, we are going to have a discussion about 4 points. In all, we are going to have a discussion about 20 points. If you are able to understand those 20 points, then you can understand what is meant by event or condition. Then you can have a better understanding of whether going concern assumption made by the management is appropriate or is inappropriate. But now read it. Read this point, and I will conclude this point today itself. Future events. Future events. 2 minutes, Andy. Future events or conditions may affect an entity adversely. Adverse events may, those adverse events, these events or conditions may have an adverse impact on the entity's ability to continue in operation for a foreseeable future. Future events, should I repeat it? Because of these events or conditions, entity may not be able to carry on its operations for a future. That means going concern assumption in that case made by the management will become wrong. So future events or conditions may affect an entity adversely. Adverse events may seriously affect the ability of the entity to continue its business. The business may cease to exist in future. As on the date of balance sheet, it may be okay, but you cannot give a guarantee that it may cease its operations in future. The business may cease to exist in future due to changes in market conditions, emergence of a new business model or products, or etc. etc. Therefore, it is in view of the above factors that an auditor cannot provide a guarantee that financial statements are free from material misstatements due to frauds or errors. And finally, time cost benefit comparison. This I will explain tomorrow because already it is 11 o'clock, past 11. So I will try to explain this point tomorrow. Classroom discussion questions will also be completed within half an hour's time. A maximum of half an hour will be taken by me to complete this chapter. Tomorrow we are going to start a new chapter. Generally, my policy is that whenever I want to start a new chapter, I will give an alarm to the student that I am going to start a new chapter by tomorrow. In that case, you must be able to attend to the class. If you miss the class for the first day, you will face severe problems in understanding that entire chapter. Okay? Okay. So, we are having a discussion on the concept of going concern in the previous session. You know very well that going concern is nothing but one of the basic accounting assumptions. As said earlier, every organization is under obligation to prepare and present their financial statements by following such basic accounting assumptions. If such assumptions are followed in preparation and presentation of financial statements, the fact that such assumptions have been followed is not required to be mentioned or disclosed anywhere in the financial statements. However, if the organization fails to follow going concern assumption, the fact that they have failed to follow going concern assumption is required to be clearly disclosed in the financial statements. I repeat, when you fail to follow going concern assumption in preparation and presentation of financial statements, the fact that you have failed to follow going concern assumption shall have to be clearly disclosed in the financial statements. This is point number 1. Point number 2 is more important, which is like this: be careful. That means you have not followed going concern assumption. Yes or no? When the organization has not followed going concern assumption, what other assumption would have been followed by the management? There are only two assumptions. Either you can follow going concern assumption or you can follow liquidation method. Yes or no? So when the entity itself is saying that they have not followed going concern assumption, what does it mean? They would have followed liquidation method. In that case, when you fail to follow going concern assumption, what other basis you have followed for preparation of financial statements is also required to be disclosed in the financial statements. You are not following my discussion. This is very important, and I will correlate this discussion with SA 570 in future. And as said earlier, if something is elaboratively discussed at one point of time, I am not going to discuss the same thing in that elaborative manner when I am dealing with the point for the second time or third time. So be careful while listening to the particular point for the first time. So where the entity failed to follow going concern assumption, the fact that the entity failed to follow going concern assumption shall have to be clearly disclosed by them in the financial statements. In that case, they are also required to specify the reasons why they have not followed the going concern assumption. These points are interlinked to one another. If you focus on these points, it is very easy for you to understand these points. What the entity is expected to do, the entity is required to follow going concern assumption. If they have followed going concern assumption, then there is no need for them to disclose that fact in the financial statements. If they fail to follow going concern assumption, the fact that they failed to follow going concern assumption should have to be clearly disclosed by them in the financial statements. That means management itself is declaring that they have not followed . In that case, users will get a doubt. Why the management has not followed going concern assumption? It is necessary for the management to follow going concern assumption, but here management itself is saying or declaring that they failed to follow going concern assumption. Why the management failed to follow going concern assumption? What reasons led them to follow other basis? The reasons for which you failed to follow going concern assumption are also required to be disclosed in the financial statements. Then the user may get a doubt. What other method the organization followed? Therefore, you should also specify what other basis have you followed for preparation of financial statements. So, three things are required to be disclosed. What are they? When an entity fails to follow going concern assumption while preparing the financial statements, three things are required to be disclosed by the entity in their financial statements. What are they? Point number 1, that they have failed to follow going concern assumption. Point number 2, why they failed to follow going concern assumption, the reasons behind it. And point number 3, what other basis had the entity followed for preparation of financial statements? These three things are required to be invariably disclosed by the management in the financial statements. I borrowed these 3 points from SA 570. Okay, right. Then I explained you. So, and in the previous session also, I explained you about what may happen if the entity has taken going concern assumption, but unfortunately, the going concern assumption made by the management becomes wrong or becomes inappropriate? Yes or no? Are you able to follow me? In the given case, the entity has applied going concern assumption, but the entity is not really a going concern. To prove that, I have given an example. Today is 31st March 2023. The entity's name is A Limited. It is a manufacturer of single-use plastic. On 31st March 2023, central government had given a notification in the official Gazette of India specifying that A Limited had to stop manufacturing the single-use plastic from 1st April 2023 onwards. That means A Limited cannot continue its operations from 1st April. That means A Limited had to shut down their operations. That means A Limited is not a going concern. The fact that they cannot continue, in operations for future is known to A Limited as on dash date, as on 31st March. So on 31st March itself, A Limited knows very well that their organization is not a going concern. However, they started preparing financial statements on 31st March. While preparing financial statements, generally an entity is expected to take an assumption called as going concern assumption. But in the given case, A Limited is not supposed to take going concern assumption. Why? Because it knows very well that it cannot continue its operations for a foreseeable future. They need to shut down their operations. This is very well known to A Limited even on 31st March. So while preparing financial statements on 31st March, A Limited knows very well that their organization is not a going concern. If you know that your organization is not a going concern, what basis of accounting should you follow? Liquidation basis. But instead of following liquidation basis, A Limited decided to apply going concern assumption. And by applying going concern assumption, they prepared financial statements. The most important point that you must understand in the given example is the entity is not a going concern. It is known to it, but still it prepared the financial statements by taking going concern assumption. That means the assumption made by the management is either dash or dash. The assumption made by the management in the given example is wrong or is inappropriate. Then I explained you about what may happen if the going concern assumption made by the management becomes wrong or becomes inappropriate. When going concern assumption made by the management becomes wrong or inappropriate, it can be said that classification of assets and liabilities done by the management will become wrong, as well as valuation of assets and liabilities will become wrong. So what you must try to recollect from this is, okay, when the going concern assumption made by the management is a wrong assumption, then it can be said that classification of assets will become wrong. Valuation of assets will also become wrong. Classification of liabilities would become wrong. Valuation of liabilities will also become wrong. When everything is wrong, can financial statements reflect a true and fair view? Obviously no. That means when going concern assumption is wrong, financial statements will not reflect a true and fair view. Are you able to understand up to this point? Right. Then what is our duty as an auditor in respect of going concern assumption made by the management? It is our duty as an auditor to check, to examine whether going concern assumption made by the management is appropriate or is inappropriate. Why should the auditor check the appropriateness or inappropriateness of going concern assumption made by the management? Why should you check the appropriateness or otherwise of the going concern assumption made by the management? Because if the going concern assumption made by the management is appropriate, there would not be any problem either to the management or to the auditor. The problem arises only when the going concern assumption made by the management becomes wrong or inappropriate. What happens if going concern assumption becomes wrong or inappropriate has already been explained to you. Therefore, it is our responsibility as an auditor to check whether going concern assumption made by the management in preparation and presentation of financial statements is appropriate or not. To check that, you need to follow some procedures. To check that, you need to follow some procedures that were mentioned in SA 570. The name of SA 570, as already mentioned to you, is going concern. That standard identified some events. That standard identified, this is very important, be careful. That standard identified some events or conditions. As an auditor, when you observe, such events or conditions during the course of performance of your audit. I repeat, that SA 570 contains some events or conditions, and those events or conditions were classified broadly in SA 570 into three categories. The first one is, which is appearing on your screen, the first one is financial events or conditions. The second one is operating events or conditions. The third one is other events or conditions. If you observe any one of those events while you are performing your work as an auditor, no doubt management would have taken an assumption that they will be able to continue in operation for a foreseeable future. That means management made an assumption that theirs is a going concern. But as an auditor, you should get a doubt. As an auditor, you should get a doubt. When the auditor should get a doubt, whenever the auditor comes across any one of either dash or dash or dash events or conditions. Whenever the auditor comes across either financial events or conditions, operating events or conditions, other events or conditions during the course of performance of his audit, the auditor should get a doubt about whether this entity is really capable of continuing its operations for a foreseeable future. What was the assumption made by the management? The management has made an assumption that it will continue in operations, and hence management was of the opinion that the entity is a going concern. But as an auditor, you got a doubt. Is it really possible for this entity to continue its operations for a foreseeable future? This is the doubt that should rise in the mind of the auditor, particularly when the auditor comes across any one of these events. What are those events? Financial events, operating events, other events. I can list down all those things, but you cannot understand even a single word out of it. For example, under the heading financial events, the following aspects were mentioned. When the auditor identifies that the entity under his audit is suffering with substantial and continuous operating losses, when it is suffering with negative cash flows, when it is suffering with negative working capital, when it is suffering with negative net worth, when it is suffering with adverse key financial ratios, when the suppliers has started insisting on cash on delivery basis, when the entity fails to comply with loan agreements or debenture agreements, when a loan is required to be paid by the entity but there are no prospects of making repayment of such loan by the entity, when the entity makes use of short-term funds for the purpose of meeting their long-term requirements, and so on. Like this, there are several points that were mentioned under events or conditions, particularly under the heading financial events. Under the heading operating events, things like loss of key managerial personnel without replacement, loss of major market, loss of principal supplier, labor difficulties, emergence of a highly successful competitor, these things were mentioned. And I'm capable of explaining all those things now itself, but this is not the point where those things are required to be discussed with you. I will try to discuss these things elaboratively in SA 570. So if you come across any one of those events or conditions while you are performing your audit, you must get a doubt. Till now, the auditor is not having any doubt about the entity's ability to continue in operation for a foreseeable future. Now the auditor got a doubt. Why the auditor got a doubt about entity's ability to continue? Because the auditor comes across any one or more of some events or conditions. Previously, these events or conditions were called as indicators or indications. Previously, they were called as indicators or indications. Now the name has been changed from indicators or indications to events or conditions. That is the reason why we previously call these things as financial indicators, operating indicators, other indicators. Now we are calling them only as financial, operating and others. Financial events or conditions. Operating events are conditions. Other events are conditions. That is the way that we are calling them now. So why I am telling you about the old name also. Sometimes you may find the terms indicators or indications in a particular material. Don't get confused. They both are one and the same. Whether you call it as events or conditions or you call it as indications or indicators, whatever you call, they mean one and the same. This is what I explained to you under the heading dash. Going concern. Now, and that is explained to have an understanding of the last point under the heading, inherent limitations of audit, that is future events. Now you can just go through what is given in our material. You may have some better understanding of these 3 points now. Future events are conditions. Future events are conditions. Future events are conditions. Have I explained you the term events are conditions? Very good. Future events or conditions may affect an entity adversely. What is meant by may affect the entity adversely? It affects the entity's ability. It affects future events or conditions may affect entity's ability to continue its operations. Future events or conditions may affect entity's ability to continue in operations. Adverse events may seriously affect the ability of the company of an entity to continue its business. That's what I said to you. The business may cease to exist because of such events or conditions. There is a possibility that the business may have to shut down in future due to changes in market conditions, the emergence of a new business model. This point has been explained in SA 570 as emergence of a successful competitor. My name is Idea. I am the leader in network market till the entry of Jio. Now, who is the leader in that market? Jio is the leader. So, Jio in the given example or Reliance in the given example is said to be a competitor. The competitor is a highly successful competitor. When a highly successful competitor enters into the business line that you are doing, certainly it affects your business. That is the reason why the number of Idea has fallen from number 1 to number 3. Or the number of Airtel has fallen from number 1 to number 2. That means your business is going to get affected. Some companies like Aircel, etc. have been closed after entry of Jio. Some other companies have merged into one company like Vodafone and Idea. All this happens only because of the entry of Jio. That Jio in the given example is said to be a highly successful competitor. What you need to understand from this example is, okay, when there is a highly successful competitor enters into our business line, there is every chance that our business may get affected. to a point where we need to close our business as well. That is the meaning of that sentence. Are you able to follow this point? Read it. The business, Aircel is the best example, which has ceased its operations in India only because of the entry of Jio into Indian market. So the business may cease to exist in future due to changes in market conditions or emergence of a new business model or emergence of a new product or due to onset of some adverse events. Therefore, it is in view of the above factors that an auditor cannot provide a guarantee that financial statements are free from material misstatements due to fraud or error. On the date of balance sheet, entity may have taken an assumption that it is a going concern. Few days later, it is proved that the entity is not a going concern. Then, can the users of the financial statements question the auditor? I repeat the question again. Please be careful. You are the auditor. I am the user of the financial statements. You have conducted audit of A Limited. At the time of conducting audit, you checked whether A Limited is a going concern or not. You have satisfied that A Limited is a going concern. And fortunately, financial statements of A Limited were also prepared on the basis of going concern assumption. You expressed an opinion that financial statements are reflecting a true and fair view. And I made use of the opinion given by the auditor along with financial statements. Within few days of the auditor's report, the entity shuts its operations. Now, user of the financial statements wants to go to court of law against the auditor because the auditor has said that the entity is a going concern. Now the entity is not a going concern. Therefore, the auditor is wrong in giving his opinion and hence the auditor shall have to be punished. In that way, user wants to go to the court against the auditor. In that case, will the user succeed against the auditor? No. Why? Because the auditor is not giving any dash. You are not giving any guarantee. That is the reason why I keep on saying that an auditor cannot give an absolute assurance about anything. You can give only a dash assurance, only a reasonable assurance. Because of all these limitations, how an auditor is expected to give an absolute assurance? With these limitations, we are just expected to provide only a reasonable assurance and not an absolute assurance. These are all the things which are not in the hands of the auditor. You cannot control, being an auditor, you cannot control all these things. When you are not in a position to control some things, how an auditor can be made responsible for those things which are not in the hands of the auditor? You are not in the control of such activities, and how you are made responsible for such activities. That is the reason why, as an auditor, you will not be held responsible or liable, because you are not giving any dash, but you are giving only dash. You are not giving any absolute assurance with regard to anything, but you are just giving a dash assurance, a reasonable assurance. Are you able to follow the last point also? Read it. Therefore, it is in view of the above factors that an auditor cannot provide a guarantee that financial statements are free from material misstatements due to frauds or errors. And time and cost benefit comparison. You know very well about, fortunately, you know very well about the concept of audit sampling. Had I explained the concept of audit sampling to you, I said to you that sometimes due to time constraints, it may not be possible for you as an auditor to check 100% of the transactions. In that case, what the auditor is expected to do? The auditor is required to follow an approach called as audit sampling, in which case auditor is not supposed to verify all the transactions. Few transactions will be selected by the auditor, and audit procedures. When I say audit procedures, every one of you must be capable of recollecting what are all the audit procedures that I discussed with you in the previous sessions. Can you recollect what are all the audit procedures that you can follow as an auditor? Risk assessment procedures, further audit procedures. Further audit procedures are divided into compliance procedures and substantive procedures. Substantive procedures are divided into tests of details of transactions and tests of balances. and substantive analytical procedures. Apart from that, some other procedures are also available to the auditor, like inspection, observation, inquiry, confirmation, recalculation, reperformance, etc. These are all the procedures that are available. These are all the procedures that are available for an auditor to obtain sufficient, appropriate audit evidence. Okay, right. So when you follow audit sampling, you cannot follow all these procedures, or at least some of these procedures on all the transactions. You may leave some transactions from verification. When you left off some of the transactions from verification, there is every chance, if the auditor is not fortunate, it may happen to the auditor like this. There are 1 lakh transactions entered by the organization. The auditor is having some time constraints. So auditor knows very well that he cannot perform 100% checking of these transactions. Hence the auditor wants to follow audit sampling technique. Out of 1 lakh transactions, the auditor selected 59,000 transactions. If you select 59 out of 1 lakh, it is called as audit sampling. If you select only 5,000 out of 1 lakh, still it is called as audit sampling. If you select 90,000 out of 1 lakh, still it is called as audit sampling. If you select 99,999 out of 1 lakh, still it will be called as audit sampling. If you select all 1 lakh transactions, it cannot be called as audit sampling. This is the base on which I am going to explain you the definition of audit sampling when I am dealing with SA 530. In SA 530, audit sampling has been defined as application of, what is that? Application of audit procedures. Application of audit procedures to less than 100% of the transactions. Application of audit procedures to less than 100% of the transactions. That is called as audit sampling. Here also 59,000 is less than 1 lakh. 5,000 is less than 1 lakh. 90,000 is less than 1 lakh. 99,999 is also less than 1 lakh. 1 lakh is not less than 1 lakh. So in the last case, you cannot call it as dash. Audit sampling. You may get puzzled by listening to this. Some of you people may be of the opinion that why should the auditor follow audit sampling, or what benefit will the auditor get by following audit sampling, particularly when the auditor selects 99,999 out of 1 lakh. Have you get the doubt or not? This is technically called as sample size. What is that? Sample size. Size of the sample. Size of the sample to be selected by the auditor may be either 5,000 out of 1 lakh, or 59,000 out of 1 lakh, 90,000 out of 1 lakh, 99,999 out of 1 lakh. That is technically called as size. The size is dependent upon risk that the auditor can accept, that we discuss later. So what you need to understand here is, let us assume that I am an auditor. I selected say 90,000 out of 1 lakh transactions because of time constraints. I thoroughly verified all the selected 90,000 transactions. That means 90% of the transactions have been covered. I don't find any mistakes or misstatements in the selected and verified 90,000 transactions. In that case, if you were the auditor, what would be your conclusion? Out of 1 lakh transactions, you have selected 90,000 transactions. You carried out audit procedures on the selected 90,000 transactions. Every required audit procedure has been followed by you. Fortunately, you do not identify even a single mistake or misstatement in the selected 90,000 transactions out of 1 lakh. In that case, what assumption would you make as an auditor? That is my question. Since selected and verified 90,000 transactions do not contain any material misstatements, the remaining 10,000 transactions which were not selected and verified by me may also not contain any material misstatements. This could be the assumption, the conclusion. This should be the conclusion the auditor can draw. Yes or no? All these words are technical words. This should be the conclusion the auditor could draw from examination of a sample of 90,000 transactions? Yes or no? So you have checked 90,000 out of 1 lakh. You don't find any misstatements in the checked 90,000 transactions. Hence, you made an assumption that the remaining 10,000 transactions may also not contain any material misstatements. And hence, the auditor had given an opinion saying that financial statements are reflecting a true and fair view. And there is always a possibility that the transactions which were not selected and tested by the auditor may have contained material misstatements which could not have been detected by the auditor because the auditor has not selected the same. And this may be happened to you as well. In the past, there are 200 questions in a particular subject. Because of time constraints, you have selected and prepared for 190 questions. And in the examination, 10 questions are given. All the 10 questions that are given in the examination are the questions that were not selected and prepared by you. Is this possible or not? Obviously, yes. Obviously, yes. సుడి బాగుండకపోతే ఇట్టగే జరుగుతుంది. Out of 200, you prepared for 190 questions. In the examination, you find 10 questions which are not in the list of prepared questions. That's it. That is the fate. Okay. So that is always possible. Similar to that, here also out of 1 lakh transactions, you have selected how many transactions? 90,000, and you thoroughly checked it. You don't find any mistakes, but there is every chance that the remaining 10,000 transactions which were not selected and verified by the auditor may contain some material misstatements which could not be detected by the auditor. In that case, auditor will conclude that financial statements are free from material misstatements. But in fact, in reality, financial statements are not free from material misstatements. That means the opinion given by the auditor may become dash, may become wrong. Why? Why? Because the auditor followed sampling. Now, some of you people may think like this. Because the auditor followed sampling, auditor is unable to detect all material misstatements. Had the auditor followed 100% verification, had the auditor followed 100% verification of the transactions, the auditor could have identified all material misstatements. Now my question is, if you were the auditor, if you thoroughly check all 1 lakh transactions, is there any guarantee that you would be able to detect all material misstatements? No guarantee. That has already been explained to you with the help of a fake invoice. Yes or no? So even if you check every transaction, there is no guarantee. Because of this only, we are giving only a dash but not dash. A reasonable assurance but not an absolute assurance. Now read what is given in the material. Time, cost, benefit comparison. Timeliness of financial reporting and the balance between benefit and cost. The matter of difficulty, time or cost involved is not in itself a valid basis for the auditor to omit an audit procedure for which there is no alternative. So what they are saying, this is very important for true or false statements in the examination. You can mark that particular point with a star so that you can focus more on that particular point while you start preparing for the subject. This is a favorite question for the examiner, particularly for true or false statements, because students do get confused by reading this statement. That is the reason why you should focus on this statement. Although time is not available, although the benefit that the auditor is getting through conducting audit is less than the cost, auditor is not expected to omit a procedure which is required to be followed by him. A procedure which is required to be followed by him. The matter of difficulty, time or cost involved is not in itself a valid basis for the auditor to omit an audit procedure for which there is no alternative. That is the reason why, as an auditor, you are expected to plan the audit, to complete the audit within the time and cost constraints. This is another concept called as audit planning. In future, we are going to have a discussion on a chapter called as audit strategy, audit planning, and audit program. Those aspects are dealt with by a standard on auditing. Number is SA 300. So SA 300 deals with audit strategy, audit plan, and audit program. And I will try to explain the concept of planning in the briefest possible manner. If you try to plan for a work, you may be able to complete the work within a given time and cost constraints. Yes or no? For example, the entire coaching is completed. Now you need to start your preparation. Before starting your preparation, would you plan for your preparation, or would you start your preparation just like that without any planning? If you plan your preparation, then it is always possible that you might be able to complete your preparation within the given time. That is the reason why, if I were the student, if I were to start my preparation for examinations, first of all, what I do is, I will try to identify the number of months or number of days available for my preparation. Then I will identify the number of subjects for which I need to prepare. That means I need to decide whether to write only one group or to write both the groups. If I decided to write both the groups, then I need to prepare for 6 subjects. So how many number of days are available? How many subjects are required to be prepared? How many days are required to be allotted for each subject? Then I will try to identify how many chapters are there in each subject and how much time is required to be allocated for each and every chapter. Like this, I will try to write all the points in detail on a paper. I will also provide for contingencies. Why? Because sometimes it may not be possible for us to complete a particular point. In that case, I will try to provide for contingencies as well. Once a paper is prepared, I need to follow that paper strictly, so that I can complete my preparation within the given time constraints. Like a student, an auditor is also required to plan for his audit. Without proper planning of the audit, it is not at all possible for the auditor to complete the audit within the given time and cost constraints. So completing the audit within the time constraints is possible only when the auditor plan for his audit. That planning the audit is technically called as audit plan. Usually, auditor will prepare a program for that. That program is technically called as audit program. So, audit planning will be done by the auditor through designing a program called as audit program. So, you are expected to plan for the audit so that everything will be covered in audit. But still, irrespective of this, what is the meaning of notwithstanding? Notwithstanding implies irrespective of. So whenever the term notwithstanding is appearing, don't try to read that. Instead, try to incorporate the term irrespective against notwithstanding, so that you will get better idea. So what is notwithstanding? Irrespective of this. This means you planned for the audit. Even if you plan for the audit, the relevance of information and thereby its value tends to diminish over time, and there is a balance to be struck between reliability of information and cost. Simply speaking, you need to perform a cost-benefit analysis. When the auditor performs cost-benefit analysis, sometimes the auditor may have to leave. Some of the transactions from his verification. What is meant by cost-benefit analysis? Let us assume that I have been appointed as the auditor for conducting audit of 3 bank branches. I have been appointed as the auditor for conducting audit of 3 bank branches. Assume that each branch has entered into an average of 1 lakh transactions in that particular year. 1 lakh transactions in that particular year. Say 3 lakh transactions in that particular year. That means all 3 banks has entered into 9 lakh transactions in that particular year. I have been appointed as the auditor of the bank on say 31st March 2023 for the financial year 22-23. In the appointment letter, it was clearly mentioned by the bank that I can start my audit from 4th April 2023, and I am expected to submit my report so as to reach the auditor, the statutory central auditor, by 11th April 2023. This is the practical difficulty that we face while we conduct audits. If time permits, I will try to show you the appointment letter also. I have been the auditor for State Bank of India for 4 years. For 4 years, I will try to show you the appointment letter. In that letter, you will identify that number of branches allotted are 3, but the time given is only 8 days. Within 8 days, we are supposed to cover 3 bank branches, and that too we are supposed to cover 9 lakh odd transactions. Is it practically possible for a human being to cover 9 lakh odd transactions within a span of just 8 days? Certainly not. The appointment was made on 31st March. Banker is saying that we can commence our audit from 4th April, and we are required to submit our report by 11th April. How many days are there? 4th, 5th, 6th, 7th, 8th, 9th, 10th and 11th. 8 days are there. When we go for audit on 4th April, branch manager may tell like this: sorry sir, the required reports were not yet downloaded. You can start your audit from tomorrow onwards. Out of 8 days, 1 day is gone. Only 7 days are there. Out of 7 days, 1 day is required for preparation of reports. 1 day is required for sending the reports. Out of 7, 2 days are gone. There are only 5 days. Within a span of 5 days, you are expected to check 9 lakh odd transactions. Is it really possible for you to check 9 lakh odd transactions within a span of just 5 days? Certainly not. That is technically called as time constraint. What is that? Time constraint. And in that case only we need to focus on internal controls, and then we need to adopt audit sampling, because it is highly impossible for the auditor to verify each and every transaction. In the next year, I made a complaint to the Reserve Bank of India saying that so and so bank has given me or has allotted me 3 bank branches for conducting audit, and they have given me a time of only 8 days for conducting audit. The time is not sufficient for conducting an effective audit. So please ask the bankers to provide enough time for us to conduct the audit. This was the content of the letter that I have written to Reserve Bank of India. Reserve Bank of India has taken action on the bank, and in the next year, the banker appointed me as its auditor only for 1 branch. And the audit fees fixed for that is 5,000 rupees. Inclusive of all the expenditure. Let us assume it so that you can understand the meaning of the term cost benefit analysis. These are all only presumptions or assumptions. Okay. And you cannot deny the audit. Let us assume. And in fact, you cannot do that. That I will prove in company audit. Okay. So you cannot deny the audit. The banker appointed you for conducting audit of only 1 branch. The amount of fees payable by them is only 5,000 rupees. The branch allotted is a branch located in Srinagar, Jammu and Kashmir. Now, if you were the auditor, how many days would you try to spend in the branch for conducting and completing the audit? That's it. If I were the auditor, I will spend only for 1 day. Why? Because the cost of carrying out the audit is much more than the benefit that I am getting. How much benefit that I will get by completing the audit? 5,000. If I stay there for a period of say 3 months, I have to incur an amount of 3 lakh rupees. My outflow is 3 lakh rupees. My inflow is 5,000 rupees. This 5,000 is benefit. This 3 lakh rupees is cost. If you were the auditor, would you try to stay there for 3 months? Would you try to verify each and every transaction thoroughly? And would you try to give your opinion after 3 months? Certainly not. This is technically called as dash. Cost benefit analysis. In that cost benefit analysis, sometimes the auditor may have to resort to audit sampling. If you resort to audit sampling, obviously some of the transactions may not be checked by you. When you fail to check some of the transactions, there is obviously a possibility that the transactions which were not selected and checked by you may contain some material misstatements. Those misstatements cannot be detected by you. In that case, the opinion given by you may become dash, may become wrong. So these are all the eventualities. These are all the possibilities. And unfortunately, nothing of these things are under the control of the auditor. You cannot control them. You know that there are limitations, but you cannot overcome such limitations. And that is the reason why they are technically called as a dash of audit. Inherent limitations of audit. Because of these limitations only, as an auditor, we are not expected to give any guarantee or certificate. We are just expected to provide an opinion. We are just expected to provide only a reasonable assurance and not an absolute assurance. By this, I completed a discussion on chapter number 1. Question number 12 is now completed, and hence chapter number 1 is also completed. Now let us do one thing. All about audit reporting that we discussed earlier. What do you know about audit report? Anybody can provide an answer for this question. What is audit report? What do you know about audit report? Tell me, what is audit report? The easiest point that you can communicate with me is the objective of the auditor is to form an opinion to get a reasonable assurance. Then the opinion so formed by the auditor shall be expressed to the users of the financial statements. How do you express that opinion? You cannot express that opinion orally. There may be lakhs of shareholders. It is not at all possible for the auditor to express his opinion orally to each and every shareholder. Therefore, the mode in which the auditor is required to express his opinion only is in writing only. Therefore, audit report is said to be the end product. What is that? Audit report is said to be the end product of an audit. Have I explained this point earlier to you or not? Audit report is nothing but end product of an audit. Audit report contains what? Very good. Audit report contains opinion given by the auditor. What types of opinion can the auditor issue? Initially, I classified the opinion that can be given by the auditor into 4 broad categories. What are they? The first one is clean opinion. The second one is qualified opinion. The third one is adverse opinion. And the fourth one is disclaimer of opinion. And the last 3 are called technically as modified reports. And the first one is called as unmodified report, otherwise called as unqualified report. Then I even explained you about the scenarios or situations wherein the auditor can issue a clean report, a qualified report, an adverse report, or even a disclaimer of opinion. Now I need from your side a cooperation, and you should try to recollect what we discussed earlier about these types of opinion and tell me what is the only situation in which the auditor can provide a clean opinion after obtaining sufficient appropriate audit evidence. That means in the given case, the auditor is able to obtain sufficient appropriate audit evidence. After obtaining sufficient appropriate audit evidence, the auditor concludes that financial statements do not contain any material misstatements. Do not contain misstatements. It is do not contain material mistakes. There may be some mistakes in the financial statements, but those mistakes or misstatements are not material. So when the auditor concludes that financial statements do not contain any material misstatements, or else you can express this in this way: financial statements are free from material misstatements. In that case, you can conclude that they are reflecting a true and fair view. In that case, the auditor can issue a dash report. That is the only situation in which the auditor can give a clean report. So what is the situation in which auditor can give a clean report after obtaining sufficient appropriate audit evidence? If the auditor concludes that the financial statements are free from material misstatements, then the auditor can conclude that they are reflecting a true and fair view. Hence, the auditor can provide a clean opinion. Then the challenge for you is about qualified opinion. I know very well that very few of you people would be able to recollect both the things that I explained to you in the past relating to qualified report. Under how many situations the auditor shall have to issue a qualified, don't try to refer to your running notes, okay? It's a challenge to you. Under how many situations the auditor is required to provide a qualified report? Two situations. The first one is when the auditor is able, very good, when the auditor is able to obtain sufficient appropriate audit evidence. The second one is when the auditor is unable to obtain sufficient appropriate audit evidence. Out of these two, first one is easy to understand. The auditor is able to obtain sufficient appropriate audit evidence, and the auditor concludes on the basis of that evidence, the auditor concludes that the financial statements contains material misstatements, but those material misstatements are not pervasive. Very good. There are material misstatements, but they are not pervasive. They are not as a whole to the financial statements. They are limited or restricted to a particular area. Excepting that area, everything is fine. In that case, as an auditor, you need to issue a dash opinion, qualified opinion. I know very well that every one of you is capable of recollecting this point. This is easily recollectable, but this one is somewhat difficult. Now, what is the other situation in which the auditor should issue a qualified opinion? The wording that has been used in this standard is very different and difficult to understand. That is the reason why I am trying to write it here. Okay, when the auditor is unable to obtain sufficient appropriate audit evidence, and when the auditor concludes that the undetected misstatements, what is that? The auditor concludes that the undetected misstatements in the financial statements, the undetected misstatements in financial statements may be, the auditor concluded that the undetected misstatements in the financial statements may be material but not pervasive. Here, the term maybe has been used in standard as possible effect. What is that? Possible effect. May or possible, they both mean one and the same. Now, auditor fails to obtain sufficient appropriate audit evidence. The information that the auditor requires is not available to the auditor. But the auditor is able to conclude that because of lack of information, we may have missed to identify all the mistakes in the financial statements. So there may be some dash in the financial statements. Because of lack of information, we would have failed in detecting some material misstatements in the financial statements. Such things are technically known here as dash. Undetected misstatements. Undetected misstatements. And the auditor started presuming that there may be some undetected misstatements in the financial statements. And the possible effect of such undetected misstatements in the financial statements may not be dash. May not be pervasive. There may be material misstatements, but they may not be pervasive. If this is the expectation of the auditor, if this is the expectation of the auditor, why I am using the term expectation? Because the auditor is unable to obtain sufficient appropriate audit evidence. In that case also, the auditor can issue a qualified opinion. The third one is adverse opinion. The third one is adverse opinion. This opinion should be issued by the auditor only under one situation. What is that? When the auditor is able to obtain sufficient appropriate audit evidence, and when the auditor concludes, when the auditor, I am not explaining anything new to you. If somebody has not listened to our previous discussion, they may fail in understanding what is being explained to you. Don't blame me for that purpose. Okay. So auditor concludes that financial statements contains material misstatements, and they are pervasive also. They are pervasive also. That means financial statements as a whole contains material misstatements. In that case, they won't reflect a true and fair view, and hence, in that case, auditor had to give an adverse opinion saying that your financial statements are not reflecting a true and fair view. So clean opinion is to be given only under one situation. Qualified report is required to be provided under two situations. Adverse report is required to be provided only under one situation. And the fourth one is disclaimer of opinion. This is also required to be given only under one situation. What is that? When the auditor is unable to obtain sufficient appropriate audit evidence, and when the auditor concludes that the undetected very good. The undetected misstatements in the financial statements could be both material as well as pervasive in nature. The possible effects of those undetected misstatements on the financial statements could be both the possible effects of such undetected misstatements in the financial statements could be both material and pervasive. In that case, you cannot form an opinion at all, and hence you need to provide a dash opinion, disclaimer of opinion. Are you able to recollect all these things? When the auditor is able to obtain sufficient, obtained means auditor is able to obtain sufficient appropriate audit evidence, and when the auditor concludes that financial statements do not contain any material misstatements, since financial statements do not contain any material misstatements, there is no question of pervasiveness. In that case, auditor had to give an unqualified opinion. That means auditor had to give a clean report or unmodified report. Auditor is able to obtain, situation number 2, auditor is able to obtain sufficient appropriate audit evidence, and auditor concludes that financial statements contains material misstatements, but those material misstatements are not pervasive. In that case, what type of opinion should you give? A qualified opinion. Stop there. Come to the next one. When the auditor is not obtained means unable to obtain sufficient appropriate audit evidence. When the auditor is unable to obtain sufficient appropriate audit evidence, and point number 2, and when the auditor concludes that financial statements contains material misstatements, but they may not be pervasive, in that case also auditor should give dash. So in how many situations the auditor is required to give a qualified opinion? In 2 situations. In how many situations auditor shall provide a clean opinion? Only in 1 situation. Are you able to see it on the screen? The last one. When the auditor is able to obtain sufficient appropriate audit evidence, And when the auditor concludes that financial statements contains material misstatements, unfortunately, those material misstatements are also pervasive. In that case, what type of opinion should the auditor provide? An adverse opinion. And then the last one, when the auditor is unable to obtain sufficient appropriate audit evidence, but the auditor concludes that financial statements contains material misstatements and they are dash also, pervasive also. In that case, the auditor had to give a disclaimer of balance of P&L account or balance of P&L appropriation account or surplus account. In the second year, the company suffered with a loss of 60,000. Therefore, by the end of the second year, the surplus becomes only 20,000. In the first year, the surplus is 80,000, whereas in the second year, the surplus is 20,000. I said to you earlier that there is some change, or there may be some change in the surplus. For example, in the third year, the company suffered with a loss of 60,000 again. Let us assume that the company suffered with a loss of 60,000 even in the third year. In that case, what would be the balance in the surplus account? What would be the balance in the surplus account? This is P&L appropriation account of the third year. By balance brought down 20,000 rupees and to net loss say 60,000 rupees. In that case, surplus will become a dash balance, debit balance. So sometimes surplus may be in credit balance, sometimes surplus may be in debit balance. The point that I'm going to explain to you is very, very important, which will help you a lot in providing correct answers to the practical questions. Assume that the paid up capital of a company is 60 lakh rupees. Assume further that reserves of the company are say 40 lakh rupees. Reserves are say 40 lakh rupees. Surplus is say 1 lakh rupees. So what is the total of paid up capital, reserves and surplus? It is 1 crore 1 lakh. In that case, is CARO made applicable to the company? Obviously, yes. Because in that case, what you did is you added the paid up capital with the reserves as well as with the surplus, because in the given case, surplus is a positive figure. Yes or no? Assume that the paid up capital of the company is 60 lakhs. Assume further that the reserves of the company are say 45 lakhs. Reserves are 45 lakhs. Surplus is minus 5 lakhs. What is the meaning of the term minus 5 lakhs? Generally, surplus will be in credit balance. If you say minus 5 lakh rupees, it is nothing but a debit balance of surplus account. In that case, what will be the total of the paid up capital plus reserves and surplus? Paid up capital 60 plus reserves 45, 1 crore 5 lakhs minus surplus 5 lakhs, it will become exactly 1 crore rupees. So, if the surplus figure is positive, it is required to be added to these two things. If the figure of surplus is negative, it is required to be subtracted from these two things. That is what you need to understand. Now repeat the condition number 1, that condition number 2 that is required to be satisfied by a private limited company to exempt it from the purview of CARO. If the paid up capital plus reserves and surplus of such a private limited company is not in excess of 1 crore rupees as on the date of balance sheet, then that private limited company is said to be exempted from the purview of CARO. Here, the term paid up capital includes all types of capital. It will be either equity capital or preference capital, etc. The term reserves includes all types of reserves, whether it be a capital reserve or it be revenue reserves like general reserve, balance security premium account, general reserve, security premium account, debenture redemption reserve, dividend equalization reserve. Not only these reserves, every type of reserve, whether it be a capital reserve or it be a revenue reserve, the term reserves includes all types of reserves. So, if you are made responsible to identify, whether a private limited company is exempted from the purview of CARO or not, first of all, you need to verify whether that private company is either a holding company or a subsidiary company of a public company. If you satisfy that the private limited company is not either a holding company or a subsidiary company of a public company, then you need to check the second condition. What is the second condition? If the paid up capital, reserves and surplus of such a private limited company is not in excess of 1 crore rupees as on the date of balance sheet, then that private limited company is exempted from the purview of CARO. What is meant by as on the date of balance sheet? For example, for the financial year 20 to 23, you have been appointed as the auditor of a company, and the period of the financial year will start from 1st April 2022 and will end by 31st March 2023. Will end by 31st March 2023. So what is the meaning of the term as on the date of balance sheet in the given case? As on the date of balance sheet in the given case is 31st March 2023. On this date, you need to check what is the paid up capital of the private limited company, and you need to add reserves of the private limited company to that paid up capital, and then you need to add even surplus. If surplus is positive, add it to the remaining 2. If surplus is negative, subtract it from the remaining 2. If the resultant figure is 1 crore or less than 1 crore, if it is 1 crore or less than 1 crore, that private limited company is said to be exempted from the purview of CARO. Now, can you please repeat what are the conditions that are required to be complied with by a private limited company to exempt it from the purview of CARO? Point number 1, such a private limited company shall not be either a holding company or a subsidiary company of a public company. Condition number 2, the paid up capital, reserves and surplus of such a private limited company shall not exceed. It may be equal to 1 crore or may be less than 1 crore. It shall not exceed 1 crore rupees as on the date of balance sheet. The third condition is the total borrowings. What is that? The total borrowings of such private limited company from banks and public financial institutions. The total borrowings of such a private limited company from banks and public financial institutions shall not exceed 1 crore rupees at any point of time. What is that? At any point of time during the financial year. At any point of time during the financial year. I will try to focus on the last sentence later on, that is at any point of time during the financial year. Let's first have a discussion about the term total borrowings from banks and public financial institutions. Okay, banks and financial, don't use the term public, banks and financial institutions. The total borrowings from banks and financial institutions shall not exceed 1 crore rupees at any point of time during the financial year. Now, what is meant by borrowings from banks? Here, the bank may be either a public sector bank or even a private sector bank, or even it is a foreign bank, where the private limited company has borrowed some monies from banks, whether it be from public sector banks, or it be from private sector banks, or it be from foreign banks. All the borrowings made by private limited company, or all the borrowings all the loans taken by such private limited company from all such banks, That means you need to add borrowings of the private limited company from public sector banks plus private sector banks plus foreign banks plus borrowings from financial institutions. The total of borrowings from banks and financial institutions shall not exceed 1 crore rupees at any point of time during the financial year. Another important point is here borrowings not only includes long-term borrowings but also includes short-term borrowings. In this at this context, I need to explain some other things to you, without which you may not have a good understanding of the term borrowings, and hence let us have a discussion on that point first, then I will come back to this point. Loans that are granted by a bank, loans that are granted by a bank can be classified broadly into two categories. The first one is term loans. The second one is working capital loans. Please listen to this discussion very carefully. This discussion will help you a lot in not only understanding the conditions relatable to private limited company, but this discussion will help you a lot in having an understanding of a chapter called as bank audit in future. So try to understand this discussion, try to remember it for a long period of time. This is very, very important. Once you become a chartered accountant, and if you are working as an employee in an organization, you must have knowledge about all these types of borrowings, because you are the negotiator of loans. Okay, so loans that can be taken by an organization from banks can be classified broadly into two categories. The first one is term loans, the second one is working capital loans. What is meant by a term loan? Generally, term loans are granted either for the purpose of purchase of a fixed asset or for the purpose of construction of a fixed asset. Purchase of a fixed asset or for the purpose of construction of a fixed asset. I repeat, term loans are granted by the bankers either for the purpose of purchase of a fixed asset or for the purpose of construction of a fixed asset. I'll give you one example each for these 2 points so that you'll have a better understanding of what is a term loan. For example, there is a person called as X. X is trying to purchase a flat in an apartment. He is trying to purchase a flat in an apartment. The cost of the flat is 50 lakh rupees. He is having only 10 lakh rupees with him. That means his contribution for purchase of flat is 10 lakh rupees only, and he wants to take a loan of this 40 lakh rupees from a bank. Now the banker, he made an application to the bank. The banker evaluated repayment capability, satisfied with the same, and hence the banker granted Mr. X a loan of 40 lakh rupees, and the purpose for which the loan is granted by the banker in the given case is for purchase of a fixed asset. X wants to purchase a fixed asset. He need an amount of 40 lakh rupees for that. He made an application to the bank, and banker has granted a loan of 40 lakhs. That amount of 40 lakhs shall have to be utilized by X for the purpose of purchase of a fixed asset, that is flat in the given case. So in the given case, banker granted a loan which is called as term loan. What is the purpose of granting such loan by the bank? For the purpose of purchase of a fixed asset. Sometimes these term loans may be granted by the bankers even for the purpose of construction of a fixed asset. Continuing the same example, X is having a open site. He wants to construct a building in that open site. He is expecting the cost of construction to be say 1 crore rupees. His contribution for that is 20 lakh rupees. So he needs a loan of 80 lakh rupees. He is having 20 lakh rupees surplus money. So he wants to construct a building. The estimated cost of the building is 1 crore, whereas he is having only 20 lakhs. Hence, he wants to borrow an amount of 80 lakh rupees from a banker. And he made an application to the bank. Banker had evaluated repayment capability, satisfied with the same, and hence banker granted a loan of 80 lakh rupees to X. In the given case, what is the purpose for which the banker has granted loan to X? For the purpose of construction of a fixed asset. So where any bank or where any financial institution has granted any loan either for the purpose of purchase of a fixed asset or for the purpose of construction of a fixed asset, such loans granted by the banks are technically called as term loans, and in most of the cases those loans are technically called as long-term loans also. What are they? They are also called as term loans, otherwise called as long-term loans. Why they are called as long-term loans? Generally, the repayment period of such long-term loans shall be ranging from 3 years to 25 years. That means the borrower is not required to make the repayment of such loans in lump sum. The borrower is made responsible to make the repayment of the loan through monthly installments. What is that? Borrower is required to make the repayment of such loan through monthly installments. And those monthly installments shall have equal amount, and hence those are technically called as equated monthly installments, popularly known as EMI. I took a housing loan in the year 2014 amounting to 35 lakh rupees, and the repayment period fixed to me is 180 months. Every month I need to pay an amount of 42,010 rupees to the bank. So for a period of 180 months, that means 15 years. What is the repayment period of this term loan? 15 years. If the repayment period is ranging from 3 to 25 years, it is technically called as a very long repayment period, and hence those loans are technically called as long-term loans. In the given case, I am required to pay an amount of 42,000 rupees per month for a period of 180 months. After completion of 180 months, if all the installments are paid, it is said that I repaid the loan along with the interest. And most importantly, banks generally grant loans only by taking security. In the given case also, banker asked me to provide some security. I said that with the amount of the loan that you are giving, I am going to construct a building. The building that is being constructed by me with the help of the funds provided by you shall be offered as security to you. So in the given case, what I did is, the building being constructed by me has been offered as security to the bankers. So an immovable property in the form of a building has been offered as security to the banker in the given case. By this, what you need to understand is, point number 1, term loans are generally granted either for the purpose of purchase of a fixed asset or for the purpose of construction of a fixed asset. Generally, the repayment period of these term loans may be ranging from 3 to 20 or even 25 years. Therefore, those are also technically called as long-term loans. When you want to take a term loan from a bank, the banker will certainly ask you for a security. You need to provide some security. Usually, a person who is taking term loan will provide the asset being created with the help of loan as security to the banker. In the given case, what is the asset being created by me with the amount of loan granted by the banker? Building, and hence it has been offered as security. This is all about term loan, otherwise called as long-term loan. In the given example, I offered my immovable property, that is building, as security. In that case, how do bankers create security? I cannot keep my building in the bank. Yes or no? I cannot keep my building in the bank. Therefore, in that case, what the banker asks is, the banker may ask me to deposit. The title deeds. Relating to my building. Then I need to deposit title deeds relating to my building with the banker. So when I deposit title deeds relating to the building with the banker, I cannot sell that building. Yes or no? If I want to sell that building, I need to hand over title deeds to the purchaser. And the title deeds are not with me. Title deeds are with the banker. So until and unless I make repayment of loan, banker will not give back these title deeds to me. If I haven't got title deeds from the banker, I cannot sell the property. What does it mean? Without making repayment of the loan, I cannot get back my title deeds from the bank, and hence I cannot sell my property. This is one way through which the banker will try to create security, particularly when the borrower offered some immovable property as security to the banker. In the given case, immovable property is offered as security, and security has been created by the banker in the form of depositing the title deeds. The borrower is required to deposit his title deeds simply with the banker. That is one sort of creating or one type of creating security. In this type of security, there is a problem associated. The problem is like this. The banker asked me to deposit title deeds of my building. I deposited original title deeds of my building as security. Immediately, I made a complaint with a local police station saying that I lost my original title deeds. Please find them. Then the local police, and while making a complaint, I said that while I am traveling in an auto, I forgotten to take the title deeds of the property, and hence I lost my title deeds. Please search for the title deeds. This is the complaint I made with the police, and I asked the police to book an FIR also for that. An FIR has been booked. Police searched for title deeds. They are unable to locate title deeds, and hence police has given me a certificate saying that this person made a complaint to us on so and so date asking us to search for the title deeds. We searched the title deeds. Unfortunately, we are unable to find them out. Then immediately I made an application to the respective sub-register office saying that I lost my original title deeds. Please issue us duplicate title deeds. Along with my application, I also attached the FIR copy and not traceable certificate given by police. Thereafter, the SRO sub-register office has given me duplicate title deeds, and immediately I sold the building with the help of duplicate title deeds. In the given example, you are the banker. I have taken a loan from you. I offered my building as security. Title deeds, original title deeds of the building have been offered as security to you. Later on, I made a complaint with police. Later on, I made an application with sub-register office. I got duplicate title deeds. On the basis of duplicate title deeds, I sold my building, and then I stopped making repayment of the loan. If you were the banker, what will you do? Nothing. You need to go to a court of law. It may take at least 10 to 15 or 20 years to resolve the case in India. That is the reason why in some cases, instead of asking the borrower to deposit title deeds with the bankers may ask the borrower. This depositing of title deeds is one way of creating security called as mortgage. What is that? Mortgage. And sometimes because of this problem, banks ask the borrower to create a registered mortgage. What is meant by registered mortgage? I offer my building as security to the banker. Then immediately I need to make a report to sub-register office, respective sub-register office, saying that I have taken so and so amount of loan from so and so bank, and I offered so and so building as security in respect of repayment of that loan. Please register this in your records. This is an application to be made by the borrower with the sub-register office. Then the sub-register office, by charging some fees, will record these things in the registers maintained by them. Once sub-register office records these details in their registers saying that so and so is the owner of the property, he offered that property as security to so and so bank in respect of a loan of so and so. That is the thing that will be recorded by SRO in their registers. Once the property, the details are registered with SRO, then it is said that it is a registered mortgage. Then what is the privilege that is available to the banker when the mortgage gets registered with sub-register office? When the property or when the mortgage gets registered with the sub-register office, what is the benefit that the banker gets? For example, I want to do the same thing that I have done in the previous example. What I want to do, I want to lodge a police complaint saying that I lost my uh, original title deeds, asking police to search for them. Obviously, police will not be able to identify them. Then I want to make an application to the sub-registrar office for grant of duplicate title deeds. Sub-registrar office will provide me with the duplicate title deeds. Then I will try to sell the property. This is my plan. But the fact that I have taken a loan from the bank and I offered the property as security has already been informed to the sub-registrar office. Sub-registrar office recorded the same in the registers maintained by them. Then I have taken duplicate title deeds of my property. I started to sell this property to somebody. I offered to sell this property to somebody. He is the purchaser. He wants to purchase the property from me. If you were the purchaser of the property, it is your responsibility. If you were the purchaser of a property, particularly an immovable property, it is your responsibility to consult the local sub-registrar office and to take a certificate from the local sub-registrar. The certificate to be taken by the purchaser from the local sub-registrar office is technically called as EC. What is that? EC means encumbrance certificate. So the purchaser is made responsible to take an EC from sub-registrar office, and this purchaser made an application to the sub-registrar office for getting EC. In that EC, it was clearly reflected that I am the owner of the property, but that property has already been offered as security to a particular banker, and that security has been registered with the sub-registrar office. When the buyer identifies this, the buyer won't come forward to purchase this property. Why? Because the property gets registered in the name of whom? In the name of the banker. That is being clearly reflected in a certificate called as EC, encumbrance certificate. Why that is being reflected in EC? Because the mortgage has been registered with sub-registrar office. Then only the fact that the asset has been offered as security will be reflected in the EC. By this, the banker may be able to save his skin. That is the reason why there are two options to the banker. The first one is they simply take title deeds from you. The second one is bankers will ask you to create a registered mortgage. This is all about term loan. Are you able to understand the way in which the bankers do create security? What is the first way? Just by taking your title deeds and just by taking deposit of your title deeds, the banker will try to create security. That is one way of creating security in respect of immovable properties. That is also called as mortgage. But there is another way of creating security in respect of immovable properties, otherwise called as registered mortgage. What is registered mortgage has been explained to you in detail. Are you able to understand this concept? Yes or no? Is it necessary to explain it again? This is all about concept of term loans. Then what is a working capital loan? Working capital loans are generally granted to meet the requirements of working capital. To meet the requirements of working capital. Do you know what is working capital? Very good. So in order to meet the requirements of working capital, I need some loan from a bank. For example, I want to produce 1 lakh units of finished product. I want to produce 1 lakh units of a particular product. And for production of 1 unit of that product, I need to introduce 2 units of raw material into the production process. So to produce 1 lakh units of finished product, I need to purchase 2 lakh units of raw material. Each unit of raw material will cost 20 rupees. So 10 rupees. So I require an amount of 20 lakh rupees only for the purpose of purchase of raw material. This raw material is required to be converted into finished product. For that, I need to use manual labor, and for the laborer also, I need to pay 10 rupees per each and every unit of raw material processed. So how many units are required to be processed? 2 lakhs. How much I will get after processing 2 lakh units of raw material? I will get only 1 lakh units of finished product. So all 2 lakh units of raw material are required to be processed by the laborer manually, and for each unit I need to pay another 10 rupees for the labor. That means I need to have another 20 lakh rupees to make payments to the laborer. Other overhead expenditure is say 10 lakhs. That means I need a fund of 50 lakh rupees. I need a fund of 50 lakh rupees for the purpose of producing 1 lakh units of finished product. That 50 lakhs in the given example is technically called as my requirement for meeting my working capital, and hence my working capital requirement in the given example is said to be 50 lakh rupees. I don't have even a single paisa, so I approached a banker asking or requesting the banker to grant me a loan of 50 lakh rupees. Remember, with this 50 lakh rupees, I am not going to create any immovable property. This 50 lakhs is not required by me either for the purpose of purchase of a fixed asset or for the purpose of construction of a fixed asset. This amount is required by me for the purpose of meeting my working capital requirements. Remember, I approached State Bank of India. I approached State Bank of India for getting a loan of 50 lakh rupees. This amount of loan is required by me for the purpose of meeting my working capital requirements. I don't want to create any fixed asset with the help of this 50 lakh rupees. I want to meet my working capital requirements because with this amount of 50 lakhs. Hence, I made an application to SBI. Remember, I don't have any account with SBI previously. I'm not having any banking relation with SBI previously. Even I don't have any account in State Bank of India. But I made an application to State Bank of India requesting State Bank of India to grant me a loan of 50 lakhs for the purpose of meeting my working capital requirement. Such loans are technically termed as working capital loans. Usually, bankers may grant working capital loans either in the form of cash credit or in the form of overdraft. Bankers will grant working capital loans either in the form of cash credit or in the form of overdraft. What is going to be discussed by me is nothing but a cash credit. What is a cash credit? So working capital loans granted by the banker may be either in the form of a cash credit or in the form of an overdraft. Different types of auditors' opinion. Now let us focus on question number 6. List out the contents or elements of auditor's report. This is what I called as dash of auditor's report. Basic elements of auditor's report. You may find some other points which were not discussed by us. Don't worry, I will have a discussion on such aspects as well. Okay. The first one is title. The second one is addressee. The third one is opinion. The fourth one is basis of opinion. The fifth one is applicable only in some situations, in particular situations. That is the reason why I am not calling it as a basic element of auditor's report. The next one is key audit matters. The next one is responsibilities for the financial statements. This is nothing but dash responsibility, management responsibility. This is auditor's responsibility. This point is also relatable to this. This point is also relatable to auditor's responsibilities. Signature on the auditor's report, place of signature, date of auditor's report. We had an elaborative discussion even on UDIN, unique document identification number. I have shown you the way in which UDIN is required to be generated and to be reported by the auditor. So these are all called as dash of dash. Contents are basic elements of auditor's report. Title, addressee, opinion, basis of opinion or basis for opinion, key audit matter. All this is responsibilities of the management. These three are responsibilities of the auditor. signature of the auditor's report, place of signature, date of auditor's report. Along with your signature, you need to mention unique document identification number. These are all basic elements of auditor's report. By this, we completed question number 6 also. Now, explain in detail the basic elements or contents of the auditor's report. Title. The auditor's report shall have a title that clearly indicates that it is the report of an independent auditor. For example, independent auditor's report distinguishes independent auditor's report from reports issued by others. Annual report issued by a company not only includes auditor's report, but it also includes reports issued by board of directors, reports issued by different committees, and so on. If there is no title to the auditor's report, it is very difficult to distinguish. If there is no title to the auditor's report, it is very difficult to distinguish between what is auditor's report and what is board of directors report and what is report given by committees. Therefore, to distinguish the report given by the auditor with the reports given by others like board of directors, committees, etc., auditor should provide a dash to his report, a title to his report. The title to be given by the auditor to his report is dash, independent auditor's report. You have already gone through the original audit report. You find therein the term independent auditor's report. That is the title to be given by the auditor to his report. That's it. Nothing more to discuss about the term dash, title. So what should be the title to be given by the auditor to his report? Independent auditor's report. The second one is addressee. Don't try to go through every point. Instead, try to go through point number to whom the auditor is required to address his report is dependent on for whom the report is prepared. Now read it. The auditor's report shall be addressed as appropriate based on the circumstances of the engagement. Sometimes law or regulation or terms of engagement may specify to whom the auditor's report is to be addressed. The auditor's report is normally addressed to those for whom the report is prepared. Here the term to whom is important. Here the term for whom is important. If you are able to remember these 2 points, it can be said that you understood the point addressee. Auditor's report is required to be addressed for whom the report is prepared. For this purpose only, I explained you that in case of a sole proprietary concern, report is required to be addressed to the proprietor. In case of partnership firms, the report is required to be addressed to the partners. In case of a company, the report is required to be addressed to the shareholders. That is the point that they have given in point C. In case of a company, the report is addressed to the shareholders of the company. So out of all these 3 points, the only point that you need to understand and remember is to whom the auditor must address his report is dependent upon for whom the report is prepared. However, sometimes a law or a regulation may specify about to whom the auditor is required to address his report. When a law specifies, then you need to address your report to that party. Next, that is about addressee. So point number 1, title is completed. Point number 2, addressee is also completed. The next one is about responsibility. Point number 7, responsibilities for the financial statements. This is nothing but responsibilities of dash management will be discussed in further question. Let us try to go through that question first. Question number 9. Write about responsibility of management for financial statements. the auditor's report shall include a section with the heading Responsibilities of Management for the Financial Statements. This section of the auditor's report shall describe management. Are you able to follow it or not? Management's responsibilities for original audit report has been shown to you. Under that heading, management's responsibilities paragraph has been shown to you. And I have highlighted all the responsibilities of the management. Okay, the same points are repeated here also. Management is made responsible for dash. Preparation of financial statements in accordance with applicable financial reporting framework. Management is made responsible for designing, implementation, and maintenance of internal controls. Management is made responsible to prepare financial statements on dash basis, going concern basis. Management is, that is a general point. Not only these 3 points, I have explained you almost 10 points. Okay. Those are all nothing but I have shown them under the heading management's responsibilities for financial statements. That is question number 9. Write about responsibilities of the management for financial statements. Now, write about UDIN number, unique document identification number. I want to give you 2 minutes time, 3 minutes time. Please go through all 5 points under the heading question number 9. If you are unable to understand any of those points, I am here to explain you. Read it. What is unique document identification number? It was noticed that financial documents or certificates attested by third person misrepresenting themselves as CAs. They are not chartered accountants, but they are exhibiting themselves as chartered accountants. They are being appointed as the auditors of companies also, and they started signing on the auditors' reports also. In that case, auditor's report cannot be said to be authentic. To address that situation problem, CA Institute had introduced a unique concept called as UDIN, unique document. You cannot generate UDIN. Only a member of the institute can generate UDIN. That means only a member of the institute can sign on the sign on the financial statements. That is the objective with which CA Institute had introduced a mechanism called as dash, unique document identification number. It was noticed that financial documents or certificates attested by third person misrepresenting themselves as CA members were misleading the authorities, both the authorities and the stakeholders. ICA also received number of complaints of signatures of CAs being forged by non-CAs. Signatures of CAs being forged by dash. This is my signature. You can learn it and you can sign it on auditor's report. Okay? But you cannot do that. Why? Because if you sign on the auditor's report, you need to generate UDIN. That is not possible for you. Okay? Done. ICA also received number of complaints of signatures of CAs being forged by non-CAs. To curb the malpractices, PDC, we call it as PDC, Professional Development Committee of ICA, implemented in a phased manner an innovative concept of UDIN, Unique Document Identification Number. All certificates were made mandatory with effect from so and so as per the council's decision. Not only certificates, but now reports also. If you give any certificate or if you issue any report, you must generate dash. In the portal also, I shown to you that the portal is asking me about whether you are going to issue a certificate or you are going to issue an opinion. Okay. So in respect of all certificates, as well as the reports issued by a chartered accountant, it is mandatory on the part of the chartered accountant to generate a number called as unique document identification number. Chartered accountants having full-time certificate of practice. When I say full-time certificate of practice, you must be able to recollect the concept of part-time practice. Sometimes a chartered accountant in practice may have taken prior permission from the CA Institute to carry out either part-time employment or full-time employment either in a business concern or in a non-business concern. CA Institute may allow such member to practice the profession of chartered accountancy on one hand and to become a part-time employee or full-time employee either in a business concern or in a non-business concern. In that case, CA Institute will put a condition. But the precondition is that such a chartered accountant cannot carry out his dash function, his attest function. That is what he is mentioning. Chartered accountants having full-time certificate of practice who are in practice only can register on UDIN portal and generate UDIN by registering certificates attested or certified by them. Not only certificates, reports also. The term report is missing here. Okay. Next, accordingly, an auditor is required to mention UDIN with respect to now they covered report also. To each audit report being signed by him along with his membership number while signing on the auditor's report. There is nothing specific to explain in UDIN because I have shown you the way, practical way in which UDIN is required to be generated. That is more than sufficient for this. Okay. Do you have any doubts about question number 8? Now, coming back to question number 7. Focus on signature of the auditor. The auditor's report shall be signed. Oh, the report is signed by the auditor. Oh, in his personal name. Where the firm is appointed, as the auditor, the report is to be signed in the personal name of the auditor and in the name of the auditor firm. The partner or proprietor signing the audit report also needs to mention the membership number assigned by ICA. They also include registration number of the firm. I call it as firm registration number allotted by ICA while signing on the auditor's report. Place of signature. For this, I explained you a scenario wherein you are practicing in Guntur. You were the auditor of a company whose registered office is located at Hyderabad. Now you are in Vizag. You are about to sign on your report. While signing on the report, you need to mention the place of signature. Which place would you mention in your report? Should it be Guntur or Hyderabad or Vizag? The auditor's report shall name specific location, which is ordinarily the city where the audit report is signed. So this point is also completed. Signature of the auditor's report, place of signature, date of the auditor's report. The date of auditor's report informs the users of the auditor's report that the auditor has considered the effect of events and transactions of which the auditor become aware and that occurred up to the date. What is the meaning of this? Subsequent events. So if you mention a date in your report, it implies that you are communicating to the users of the financial statements that you have identified all subsequent events up to the date. You have classified them into adjusting and non-adjusting events, and you have ensured that all adjusting events are properly adjusted and all non-adjusting events have been properly disclosed. The auditor's responsibility for events and transactions after the date of auditor's report is addressed in SA 560. Have I mentioned SA 560 in my discussion? Have I mentioned SA 560 in my discussion? The auditor's report shall be dated no earlier than, this was not explained to you, I missed it, no earlier than the date on which the auditor has obtained sufficient. This point itself is not properly mentioned in our material. I will try to explain it in a different way. For example, management has given a representation letter to the auditor, say on 20th August. But the auditor has given a date to his report as 19th August. Is it right or wrong? Management has given a representation letter to the auditor on 20th August, whereas the auditor has given a date to his report as 19th August. Is it right or wrong? If it is wrong, why? Management representation is nothing but information obtained by the auditor. Information is nothing but audit evidence. This implies that even before receiving dash, even before receiving audit evidence, the auditor signed on the auditor's report. So date of the auditor's report must be at least on the date of the representation letter or after the date of the representation letter. It should not be before the date of the representation letter. Have I communicated this point to you correctly? Should I explain it again? What is the date of management representation letter, otherwise called as written representations? In my example, it is 20th August 2023. But auditor report has been given on 19th August 2023. What does it mean? Without considering dash received from dash, dash has given dash. Without considering information given by the management, otherwise called as audit evidence. Without considering audit evidence, the auditor has given a report. That is wrong. That is the reason why auditor's report should be dated as on the date of written representations or after the date of written representations. That is what they wanted to communicate to you under point number C. Next. That's it. This is date of auditor's report. 14th UDIN is already completed. After the break, we shall try to focus on concept questions as well. Okay. So 8th question is completed. 9th question is also completed. 7th question is in the stage of completion, excepting some most important aspects, that is opinion paragraph, basis for opinion paragraph, etc., etc. We'll have a discussion on those aspects also. While explaining you about key audit matters, if required, I will try to focus and finish off a discussion on 701 also. Say 701 also. Okay, take a break. Now it is 9:15. Come back by 9:30. The next point is the concept of opinion paragraph. Opinion paragraph is easy to understand. So first of all, before having a discussion on opinion paragraph, go through what is opinion paragraph, what it looks like actually in the auditor's report, so that you'll get a generalized review about the opinion paragraph. While reading the paragraph itself, I will try to identify most important points in the paragraph and I will try to highlight them. If you are able to understand the highlighted points, it is said that opinion paragraph is completed. We have the opinion paragraph should contain the opinion given by the auditor. That is point number 1. The opinion paragraph in an auditor's report should look like this. We have audited. That means the auditor is giving a declaration to the users of the financial statements. The auditor is giving a declaration to the users of the financial statements that he has carried out or he has conducted an audit. So the first highlighted point under the heading opinion paragraph is audited. It is nothing but a declaration given by auditor to the users of the financial statements that he carried out an audit. We have audited. What has been audited by the auditor? The accompanying financial statements of Reliance Industries Limited. So auditor made a declaration to the users of the financial statements that he had carried out an audit, and the organization which has been audited by the auditor, the name of the entity that has been audited by the auditor is dash Reliance Industries Limited. What has been audited by the auditor? Balance sheet has been audited, statement of profit and loss account has been audited, statement of cash flow has been audited. If there is any statement of changes in equity, that was also audited, along with notes to the standalone financial statements, including summary of significant accounting policies and other explanatory information. I repeat, the following are the declarations that are being made by the auditor in the opinion paragraph that he conducted audit of financial statements. Financial statements includes balance sheet, statement of profit and loss account, cash flow statement, statement of changes in equity, including summary of significant accounting notes and summary of significant accounting policies and other explanatory information. The name of the entity which has been audited by the auditor shall also be mentioned in the opinion paragraph. Apart from that, the period or year, this is year, and the period and year for which audit is conducted. In the given example, the year for which the audit is conducted is ending for the period ending or year ending on 31st March 2023. And then the auditor had to express his opinion. In our opinion, and to the best of our information, and according to the explanations given to us, the aforesaid financial statements give the information required by the Companies Act in the manner so required and give a true and fair view in conformity with the Indian accounting standards prescribed under section 133 of the Act, read with the company's Indian accounting standards rules 2015 and other accounting principles generally accepted in India, of the state of affairs of the company as at 31st March and its profit and loss, total comprehensive income, cash flow and changes in equity for the year ended on that date. So what are to be included by the auditor under the heading opinion paragraph? The fact that the audit has been conducted shall be declared by the auditor. Apart from that, the name of the entity for which audit has been conducted, the details of the financial statements on which the audit is conducted, like balance sheet, statement of profit and loss account, etc., the period for which audit has been conducted. Then the auditor should also include specifying that he focused not only on those P&L account and balance sheet, but also on notes to financial statements, and then the auditor had to express his opinion on the financial statements. This is all about opinion paragraph. Since you have gone through the actual opinion paragraph that appear in an auditor's report, understanding what is given in our material will now become easier for you. Now, I will try to read what is given in the material. When I am reading each and every point, you need to respond specifying the particular point that we have gone through in the Reliance Industries Limited's report. Ready? Auditor's opinion. The first section of auditor's report shall include auditor's opinion and shall have the heading opinion. The opinion section of the auditor's report shall identify the entity. Opinion section shall identify the entity whose financial statements have been audited. Very good. So Reliance Industries Limited. Auditor identified the entity whose financial statements have been audited. The auditor should state that financial statements have been audited. It is nothing but a declaration made by the auditor to the users of the financial statements. The auditor should also identify the title of each statement comprising the financial statements. What is the title? Balance sheet, profit and loss account, cash flow statement, statement of changes in equity, including notes and summary of significant accounting policies. Apart from that, the auditor should also specify the date. Date relates to balance sheet, period relates to profit and loss account. Specify the date, period covered by each financial statements comprising the financial statements. That's it. This should be the content of a dash paragraph. Are you able to correlate what is shown in the Reliance Industries Limited's report with what is appearing in your material? So what are the aspects that are required to be included by the auditor in the opinion paragraph? That the financial statements have been audited, that the name of the entity whose financial statements have been audited should be mentioned by the auditor. The auditor should also identify the title of each statements comprising the financial statements, shall also refer to notes, and shall also specify the date and period carried on. The most important point is missing here. Opinion paragraph should include opinion. Not only these things, opinion paragraph should also include dash, an opinion. And that is there in RIL report in the second paragraph. What is the second paragraph? In our opinion, the said financial statements give a dash view, a true and fair view. This is the opinion that the auditor is expected to provide under the heading opinion paragraph. That point is missing in our material, but no problem. Opinion paragraph obviously contains opinion given by the auditor. This is first line. The first section of the auditor's report shall include auditor's opinion, okay, and shall have the heading opinion. That's it. By this, we completed a discussion on auditor's opinion paragraph. Now, basis for opinion. Actually, basis of opinion is the point that is given. That is wrong. This is wrong. Basis of opinion is wrong. Basis for opinion is correct. Why the auditor forms such an opinion? What is the base on which such an opinion has been formed? You should express your opinion. You should also mention the base or basis on which such an opinion has been formed. And remember, this point is having a link with auditor's responsibility for audit of financial statements. So you cannot understand point number 4 in entirety. Once we are able to understand some portion of basis for opinion paragraph, then after explanation of another paragraph called as auditor's responsibility, you would be able to understand the concept of basis for opinion paragraph in full. So I am not giving you any guarantee that you are able to understand basis for opinion paragraph in full in the first instance itself. Only some portion of it may be understandable to you. Again, I am using the same technique, going through the original auditor's report, which will give you an overall view. Then I will try to focus on what is given in the material. Please try to follow these points carefully. This point is very difficult to understand. Basis for our opinion. Why we came to that opinion? Because now again the auditor is declaring to the users of the financial statements that he conducted audit in accordance with standards on auditing. We came to this opinion because we conducted our audit in accordance with standards on auditing. If the company is auditee, then you need to refer to dash 143 subsection 10. If your auditee is other than company, you can merely mention that you have followed standards on auditing issued by dash, issued by ICA. At this point of time, you must be able to recollect what we discussed under section 143 subsection 9 and 143 subsection 10. What is 143 subsection 9 and 10? Whenever you are appointed as the auditor of a company, while you are carrying out your audit, you must have to follow auditing standards as per section 143 subsection 9 prescribed by central government as per section 143 subsection 10. So you are declaring to the users of the financial statements that we come to this opinion. We came to this opinion because we conducted our audit in accordance with dash. We conducted our audit in accordance with the standards on auditing specified under section 143 subsection 10 of the act. Which act? Companies Act. This point is not understandable to you. This point is having a link with paragraph number 7, auditor's responsibilities for audit of financial statements. So this paragraph is not completely understandable to you until and unless we complete discussion on paragraph number 7. Our responsibilities. Here our responsibilities means auditor's responsibilities under those standards. There are some responsibilities to the auditor which were mentioned under those standards are further described. Our responsibilities have been described further, not in this paragraph, but in a separate paragraph called as auditor's responsibility for audit of standalone audit of financial statements section of our report. So, what the auditor is declaring? The auditor is declaring to the users that we came to this opinion because we conducted our audit in accordance with standards on auditing specified under section 143 subsection 10. Those standards impose some responsibilities on us. Those standards impose some responsibilities on us. What are all those responsibilities that were imposed by those standards were discussed in detail in another separate paragraph called as paragraph number 7, which deals with dash auditor's responsibility for audit of financial statement section of our report. Now read it again. We conducted our audit in accordance with standards on auditing specified under section 143 subsection 10 of the act. Our responsibilities under those standards are further described in the auditor's responsibility for audit of standalone financial statements section of our report. Then the auditor started declaring again, we are dash of the company. We are independent of the company. That has already been explained or declared by the auditor in the dash itself. Title itself. What should be the title to be given by the auditor? Independent auditor's report. Already you have declared that you are an independent person. Again you are declaring to the users to create confidence to the readers. Again you are repeating the same point. We are independent of the company in accordance with the code of ethics issued by ICAI. CA Institute has mentioned that auditor should always be independent, not only independent in mind but independence in appearance, and CA Institute prescribes the threats to auditors' independence, also prescribes safeguards to be followed by the auditor to protect his independence. Together with ethical requirements, SA 200 specifies some ethical requirements that are relevant to our audit of financial statements, and we have fulfilled our other ethical responsibilities in accordance with these requirements and ICAI Code of Ethics. What is meant by ICAI Code of Ethics? ICAI Code of Ethics can also be called as dash professional ethics. Then what is other ethical responsibilities? SA 200 specifies ethical requirements. Have I explained this point earlier? SA 200 specifies some ethical certainly I have explained this point. SA 200 specifies some ethical requirements to be followed by every auditor while conducting every independent audit. The ethical requirements mentioned by SA 200 are like this. Integrity. The auditor should be straightforward, honest. Have I explained these points to you or not? The auditor should be straightforward, honest, and sincere in his approach to audit work. Integrity, objectivity, confidentiality. No. Probably I would not have explained these things to you. This is the question I am referring to, but unfortunately we have not completed any discussion on chapter number 2, Fundamental Principles of Professional Ethics, otherwise called as ethical requirements. Ethical requirements that are to be followed by every auditor while conducting an independent audit: integrity, objectivity, professional competence and due care, confidentiality. Fortunately, the term confidentiality is well known to you because I have explained you about the rights of the auditor under the heading 143 subsection 1. The second right is right to obtain information and explanations either from the company or from any officer of the company. When the auditor requires some information from the company may be reluctant to provide required information to the auditor because the company is fearing that information required by the auditor is secret or sensitive in nature, and the company is also fearing that if such information is provided to the auditor may pass on or disseminate such information to third parties, which will be detrimental to the interests of the entity. Therefore, although the company is willing to provide required information to the auditor, the company is having a fear that auditor may pass on this information to third parties. In that case, it is the responsibility as the auditor to you to create some confidence to the company. For that, you need to refer to clause 1 of part 1 of second schedule to the Chartered Accountants Act, which mentions like this: a chartered accountant in practice shall be deemed to be guilty of professional misconduct if he discloses any information acquired by him during the course of his professional work to any person other than the client. So that is nothing but technically called as maintenance of confidentiality of information by the auditor. You will come across lots of information during the course of performance of your audit, some of which may be confidential in nature. If you pass on that information to a third party knowingly or unknowingly, it may be certainly detrimental to the interests of the company as well as the interests of its shareholders. Therefore, as an auditor, you are always expected to maintain dash of information, confidentiality of information. These are all technically known as dash requirements. Ethical requirements. What are they? They are termed as ethical requirements. So, auditor is required to follow ethical requirements as well as the professional ethics issued by the CA Institute. Now you can read this point again so that you may have some more understanding of the basis for opinion paragraph. Read it again. Just wait. We conducted our audit in accordance with the standards on auditing. Our responsibilities under those standards are further described in another paragraph of this report. We are independent of the company, and most importantly, we followed ethical requirements that are relevant to our audit. These ethical requirements were mentioned in essay 200. Just now I have shown you some ethical requirements like integrity, objectivity, confidentiality, professional behavior, professional skill and care. These are all technically called as dash ethical requirements that are to be followed by every auditor. Apart from these ethical requirements, CA Institute had issued a chapter called as professional ethics that is also required to be followed by the auditor. In fact, independent is one of such ethical requirements. We are independent of the company in accordance with Code of Ethics issued by ICAI, together with the ethical requirements that are relevant to our audit of financial statements, and we have fulfilled our other ethical responsibilities in accordance with these requirements and ICAI's Code of Ethics. So what the auditor is declaring is he has followed the ethical requirements mentioned under essay 200, as well as the auditor followed professional ethics. We believe, because we followed all these things, we believe that the audit evidence obtained by us by following different audit procedures is sufficient appropriate to provide a basis for our audit opinion on the financial statements. When I read the term basis, at least one of you should be capable of recollecting the new definition of audit evidence that I gave to you. What is the new definition of audit evidence? Audit evidence can be defined as any information used by, new definition, any information used by the auditor in arriving at conclusions on which auditor's opinion is based. So if you want to come to an opinion, first of all, you need to come to a conclusion. If you want to come to a conclusion, you need to make use of some information. That information used by the auditor in arriving at conclusions on which auditor's opinion is based is nothing but technically called as audit evidence. And auditor is expected to obtain sufficient, appropriate audit evidence. Yes or no? Done. So we believe auditor is declaring to the users of the financial statements like this. We believe that the audit evidence obtained by us is sufficient and appropriate, and it helps us to provide a base for our audit opinion on financial statements. These are all the things that are required to be included by the auditor in a separate paragraph of the auditor's report called as basis for opinion. Actually, three things are declared by the auditor in this paragraph. What are they? That the audit has been conducted in accordance with standards on auditing, that the auditor is independent, and most importantly, that the auditor followed not only ethical requirements but also followed professional ethics issued by the CA Institute. And finally, auditor is declaring that we have obtained sufficient appropriate audit evidence, and that audit evidence is the base for our opinion. That evidence gathered by us is the base for our opinion expressed in the earlier paragraph. What was the earlier paragraph to basis for opinion paragraph? The previous paragraph to basis for opinion paragraph is what? Opinion paragraph. So we come to this opinion because we have obtained dash sufficient, appropriate audit evidence. On the basis of sufficient, appropriate audit evidence only, we came to this opinion. This is what the auditor is expected to include under the heading dash, basis for opinion. Now, I will try to show you auditor's responsibilities paragraph immediately, so that this point is better understandable to you. This is another paragraph, auditor's responsibility for audit of financial statements. Actually, if I read this, most of the points in this paragraph are well known to you. Whenever you know anything about the point being read by me, please respond. Okay? Not now. Our objectives are, as an auditor, our responsibility is to obtain reasonable assurance. Do you know what is reasonable assurance? What is absolute assurance? Why the auditor cannot give an absolute assurance? Is a reasonable assurance a high level of assurance? So, our objective as an auditor, it is our responsibility to obtain reasonable assurance about whether financial statements as a whole are free from material misstatements, whether due to fraud or error, and to issue an auditor's report that includes our opinion. These points were covered both under SA 200 as well as under SA 700. That is the second question that we read. Next, reasonable assurance is also a high level of assurance, but it is not as high as an absolute assurance, but it is not a guarantee. It is not a, we have given only a dash, not dash. We have given only an opinion, not a guarantee or a certificate. So we have given only a reasonable assurance. It is not an absolute assurance, but reasonable assurance is also a high level of assurance, not as high as an absolute assurance. That an audit conducted in accordance with the standards on auditing will always detect a material misstatement when it exists. While explaining you audit engagement letter, I explained you about a particular point called as disclaimer. If anybody of you is having a running notes with you, you can just check it, verify whether I have explained you the term disclaimer or not under the heading what is disclaimer. In the audit engagement letter, the auditor should clearly specify that although the audit is auditor దులుపుకుంటున్నాడు, నాకేం సంబంధంలా. Although the audit is properly planned and properly performed, there is always a possibility that some material misstatements in the financial statements may not be detected by the auditor due to the existence of inherent limitations of audit and inherent limitations of internal controls. Yes or no? Very good. Now read it again. So, reasonable assurance is a high level of assurance, but it is not a guarantee. Reasonable assurance is not a guarantee that an audit conducted in accordance with standards on auditing will always detect a material misstatement when it exists. That means auditor is specifying to the readers that don't made us responsible to identify all material misstatements in the financial statements. It is highly impracticable for us to identify all material misstatements due to the existence of inherent limitations of audit and inherent limitations of internal controls. Misstatements can arise either from fraud or error and are considered material if individually or in aggregate, they could reasonably be expected to influence the economic decisions of users taken on the basis of financial statements. When I read this, at least one of you people would be able to recollect the definition of excellent. Materiality. What was the definition given to the term materiality in the past? Material items can be defined as those items that will influence the economic decisions of users of financial statements. If any item in the financial statements is capable of influencing the economic decisions of the users of the financial statements, then such an item shall have to be considered by you as an auditor as a material item. That is what the auditor is disclosing here. Are you getting an overall view about the point? If it is not possible for you to get an overall view, try to understand point by point. I will read it after the completion of this, then you will get an overall view. So, it is not we are just giving an opinion to you. We are not giving any guarantee that we will be able to detect all material misstatements when they exist. There is a possibility that some of the material misstatements that could have been there in our financial statements may not have been identified by us. Okay? Next. As part of these are all the responsibilities of dash. These are all dash responsibilities of dash. What are the responsibilities of the auditor? Our responsibility is to get a reasonable assurance about whether financial statements as a whole are free from material misstatements, whether due to fraud or error, and to issue an auditor's report that includes our opinion. Reasonable assurance is also a level of assurance, but we are not giving any guarantee that we are able to identify all material misstatements in the financial statements. Some misstatements may get unnoticed, may get undetected by us. Okay? Next. Misstatements can arise from fraud or error and are considered material if individually or in aggregate they could reasonably be expected to influence the economic decisions of users taken on the basis of these financial statements. And auditor started further explaining his responsibilities. In the previous paragraph, auditor explained about the responsibilities of dash. In the previous paragraph, the auditor explained about the responsibilities of dash management. Now, in the current paragraph, the auditor is trying to explain his own responsibilities. If auditor keeps on explaining only the responsibilities of the management, at some point of time or other, the users may question the auditor about why you have been appointed as an auditor. Therefore, it is necessary for you to explain your own responsibilities also in a separate paragraph. So, as a part of an audit, in accordance with standards on auditing, everywhere the auditor is repeating the term standards on auditing, standards on auditing. That means the auditor is declaring to the users that he performed his audit only by following standards on auditing. That is the importance of standards. I told you several times in the past that if you fail to follow standards on auditing, you will be deemed to be guilty of professional misconduct. We exercise, as a part of audit in accordance with these standards, we exercise professional judgment and we maintained professional skepticism throughout the audit. Are you able to recollect those 2 points that we discussed under the initial chapter number 1, professional judgment and professional skepticism? There are several areas wherein the auditor is required to take some professional judgments, like whether a particular item is material or immaterial, whether evidence obtained by the auditor is sufficient or is insufficient, what type of report should the auditor give. These are all the judgments or decisions that are required to be taken by the auditor on his own. While taking such judgments or decisions, nobody will help the auditor. Auditor alone is made responsible to take such decisions. Since they are key decisions, the auditor should be more careful while making such judgments. So we made dash and we maintain dash is the declaration being made by dash to dash. We made professional judgments. We maintain professional skepticism throughout the audit. This is the declaration being made by dash to dash, by the auditor to the users of the financial statements. We also, I will just try to read that first point. After completion of the first point, at least one of you people should respond by specifying a particular technical term. By specifying a particular technical term. Ready? We also identify, it is our responsibility. It is our responsibility as an auditor to identify and assess the risks of material misstatements, whether due to fraud or error, design and perform audit procedures responsive to those risks, and obtain audit evidence that is sufficient and appropriate to provide a basis for our opinion. What is your comment on this? First of all, try to comment on first part. This is part 1. Next, try to focus and comment on part 2. Identify and assess risk of material misstatements, whether due to fraud or error. What is your comment on it? That's it. Risk assessment procedures. In essay 3, while explaining you about importance of internal controls, I said to you that as a part of risk assessment, internal controls shall have to be evaluated by the auditor. If the auditor finds that very good internal control systems are in existence in the organization, the possibility of occurrence of fraud is less. The possibility of existence of material misstatements in the financial statements would also be low or less. Contrary to that, if the auditor finds that internal controls are ineffective, the possibility of occurrence of frauds is high, and the risk of material misstatements in the financial statements would also be high. Such procedures to be followed by the auditor are technically called as dash risk assessment procedures. Risk assessment procedures not only includes evaluation of internal controls, they also include several other things that we discuss under essay 315. And after assessment of the risk, by the auditor, risk of material misstatements by the auditor either as high or as low, depending on risk assessment procedures or depending upon the results of risk assessment procedures, the auditor shall determine the nature, timing and extent of audit procedures. If risk is low, you can even follow audit sampling. If risk is high, you may have to perform routine checks or full checking, otherwise called as 100% verification. If risk is low, you can follow simple procedures. If risk is high, you need to follow extended procedures. If risk is low, you can perform your audit at the end of the year. If risk is high, you have to follow surprise verification. Unfortunately, I haven't explained you anything about surprise verification till date. I will do that in the coming days. Okay. So what the auditor should do is completely dependent upon dash. What the auditor should do in an audit is completely dependent upon dash. The assessment of risk of material misstatements in financial statements. If risk is high, you will decide accordingly. If risk is low, again you will decide accordingly. Read it. It is our responsibility to identify and assess the risk of material misstatements, whether due to fraud or error. And if we identify risk, we are also made responsible to design and perform audit procedures responsive to those risks. Can you please explain me the literal meaning of the term responsive to those risks? If risk is high, you need to respond accordingly. If risk is low, you need to respond accordingly. If risk is high, how do you respond? By following extended audit procedures. If risk is low, how do you respond? By following audit sampling. So both are procedures. What procedure is to be followed is dependent upon risk. That is our responsibility. Okay. We also identify and assess the risk of material misstatements, whether due to fraud or error, design and perform audit procedures responsive to those risks, and obtain audit evidence that is sufficient and appropriate to provide a basis for our opinion. And this point is very difficult for you to understand, but fortunately, with the knowledge that I gave to you in the past, you may be able to understand it. I want to ask you one question. Auditor may fail either in detecting fraud or may fail in detecting an error. Yes or no? Auditor may fail in detecting fraud, or sometimes auditor may even fail in detecting error. If you were the auditor, which one is more riskier to you? Failure to detect fraud is generally considered as more riskier to the auditor than failure to detect an error. Yes or no? I repeat, if you fail to detect fraud, there is a high risk to you. If you fail to detect an error, the risk is low to you. Why? Anybody? Fraud is dash. When a person involves in a fraud, he'll get some reward for that. He'll get some incentive for that. For example, I was involved in fraud through defalcation of cash. In that case, I will get some benefit in the form of cash, some incentive in the form of cash. When you are getting some benefit out of an activity, will you try to repeat it or not? When you are getting some benefit out of an activity, will you try to repeat that activity or not? Similarly, whenever any employee of the organization or even management was involved in fraud, and when they started getting some benefits out of it, will they repeat it or not? So fraud is a dash in nature, repetitive or recurrent in nature, whereas error is not. Why? In case of an error, the thing that has been done is not intentional. Even the person who is doing that may not know that he is doing it wrongly. So he won't derive any incentive or benefit out of that. Therefore, dash may not be repeated. Errors may not be repeated. Frauds will be repeated. That is the reason why you said, I haven't said this, you said that risk of failure to detect fraud is higher than the risk of failure to detect an error. Now I want to ask you one more question. Fraud may be of maybe an employee fraud or even management fraud. Now I want to ask you one more question. Which risk is higher? Very good. Risk of failure to detect an employee fraud, failure to detect a management fraud. Failure to detect management fraud is more dangerous than failure to detect an employee fraud. Why? Because employees do involve in fraud, but the value of the fraud perpetrated by the employee is significantly very, very less. Whenever management itself was involved in fraud, as I said earlier, management will try to involve in fraud through fraudulent financial reporting. The quantum of fraud by the management is much higher than the quantum of fraud done by the employee. That is the reason why if you fail in detecting employee fraud, it will be less riskier to you than failure on your part to identify management fraud. Are you able to follow these two things? Now read it. The risk of not detecting a material misstatement resulting from fraud is higher than the one resulting from error, as fraud may involve collusion, forgery, omissions, etc. etc. That's it. The next one is we need to understand internal controls also. We need to verify whether accounting policies that are being followed by the entity are appropriate or not. We need to check whether accounting estimates, made by the management are reasonable or not. These things are well known to you. I have explained these things at different parts of the subject. What is accounting estimate? What do you call as for that? I have given you an example also. Provision to meet warranty claims or guarantee claims. I am a dealer in selling TVs. Have I explained that point or not? I am a dealer in TVs. I used to sell TVs with a warranty period of 2 years. Within a period of 2 years from the date of sale, if the buyer encounters any problem in the TV set, the buyer can simply return it back to the dealer. Dealer will incur expenditure to repair it, to put it in good working condition. Then the same will be delivered by the dealer to the customer concerned. This is called as a guarantee. Then I explained you a lot of things. If management wants to inflate profits, what the management would do? If the management wants to either inflate the profits or reduce the profits, what the management could do? Management may make wrong accounting estimates intentionally. Yes or no? Management may make wrong accounting estimates intentionally. That is the reason why it is our responsibility as an auditor to check whether accounting estimates made by the management are reasonable or not. So these are all our responsibilities. Okay. What are the responsibilities of the auditor? What are the responsibilities of the auditor? The responsibilities of the auditor is to get a reasonable assurance about whether financial statements as a whole are free from material misstatements and to issue a report. And more importantly, auditor's responsibilities includes identifying and assessing the risks of material misstatements, designing and performing audit procedures responsive to those risks, understanding internal controls, evaluating whether the accounting policies that are being followed by the entity are appropriate or not, checking whether accounting estimates made by the entity are reasonable or not, and whether going concern assumption made by the management is appropriate or not. Have I explained you anything about the term going concern assumption in the past? If I remember it correctly, I haven't explained anything about going concern assumption in the past. Okay, right. You know very well about what is going concern. Tell me your understanding of going concern. And when I say going concern, most of you people are of the opinion that you know everything about going concern. And by the end of this discussion, I prove that you do not know even a single point relating to going concern. Be ready for that. What is going concern? The only thing that is known to you about going concern assumption is like this. There are some fundamental or basic accounting assumptions. Those basic accounting assumptions are 3 in number. The first one is going concern. The second one is consistency. And the third one is accrual. These 3 are said to be fundamental or basic accounting assumptions. Now, what is the importance of these fundamental or basic accounting assumptions? Every organization while preparing their financial statements must have to follow these three basic or fundamental accounting assumptions. If they have followed these basic or fundamental accounting assumptions, the fact that the fact that they have followed these basic or fundamental accounting assumptions need not be disclosed by them. Need not be disclosed by them in the financial statements. However, if the management fails to follow, any one of these fundamental or basic accounting assumptions, the same must be disclosed by the management. Yes or no? This point is also known to you. I know it very well. Now, what is a going concern? Going concern implies while preparing financial statements, organization may make an assumption that it will continue. It continue in its operations for a foreseeable future. For a foreseeable future, not exceeding 1 year from the date of balance sheet. This is not known to you, I know it. Okay. It will continue in its operations for a foreseeable future. Now, it seems that you are very much confident about going concern assumption. So I want to ask you one question. Don't try to provide answer for that. Just try to understand it. Okay? Ready? Next. So, the question is like this. An organization made going concern assumption in preparation and an organization made going concern assumption in preparation and presentation of financial statements. The question is like this. What happens if the going concern assumption made by the management in preparation and presentation of financial statements becomes wrong or becomes inappropriate? I said earlier that you are not expected to provide an answer for this question. Try to understand the question first. What is the question? Management prepared their financial statements by taking going concern assumption. Unfortunately, the assumption so made by the management becomes wrong or inappropriate. In that case, what may happen? That is my question. Do you understand my question? Then try to provide an answer for that. Anybody, only one by one. It's a challenge to you. Basti mein sawal. What happens if the going concern assumption made by the management in preparation and presentation of financial statements becomes wrong or inappropriate? I will try to explain it. I know very well that even a single person out of you do not understand the importance of going concern assumption. I will try to explain it with the help of a very big example. It's a long example. It takes some time. Be careful while listening to it. This is the first time and the last time that you are listening to this type of explanation in relation to going concern in your lifetime. Ready? There is a company called as A Limited. The company is a manufacturer of single-use plastic. The company is a manufacturer of single-use plastic. They are manufacturing plastic carry bags. They are the manufacturers of plastic carry bags. On 31st March 2023, that is the closing date of the financial year 2022-23, on 31st March 2023, central government had given a notification in the official Gazette of India. Let us assume that they are banning the manufacturing as well as trading of the single-use plastic or manufacturing and trading of plastic carry bags in India, and that will come into force from 1st April 2023. That means 31st March is the last date that you can manufacture such plastic carry bags. From the next day onwards, you need to stop it. You need to shut down your business. That was the order given by central government through a notification in the official Gazette of India. So from the financial year 2023-2024, this A Limited cannot continue its operations. Yes or no? Yes or no? A Limited is in the process of preparation of their financial statements as on 31st March 2023. Just now you told me that while preparing financial statements, every organization has to follow some basic or fundamental accounting assumptions. One such basic or fundamental accounting assumptions is going concern. Now what A Limited did is like this. While preparing their financial statements on 31st March, there is no need for you to prepare financial statements on 31st March itself. It may be prepared later on also, but the cutoff date for preparation of financial statements is 31st March. By the time the A Limited is preparing their financial statements for the year ending 31st March 2023, they know very well about notification given by central government. They know very well that they cannot continue their operations for the next financial year onwards, that is from 2023-24. That means in the given case, A Limited is not a dash. A Limited is not it cannot continue its operations for a foreseeable future. So A Limited is not a going concern. Although it is not a going concern, while preparing the financial statements, it made an assumption that it will continue in operation for a foreseeable future, and based on going concern assumption, they prepared their financial statements as on 31st March 2023. Now my question to you, which is very simple to answer, is this assumption made by the management in preparation of financial statements that the entity will continue its operations for a foreseeable future, an appropriate assumption or an inappropriate assumption? Is this assumption appropriate or inappropriate? Unfortunately, assumption made by the management becomes wrong. Unfortunately, assumption made by the management is inappropriate. Now, let us assume that very recently, that is on 1st March 2023, this A Limited took a loan of rupees 10 crores. A Limited took a loan of rupees 10 crores from State Bank of India for the purpose of purchase of a new plant and machinery which will be exclusively used for the manufacture of single-use plastic. They purchased a plant and machinery worth rupees how much? 10 crores on 1st March 2023, for which they have taken a loan of that 10 crore rupees from State Bank of India. This loan is nothing but technically called as dash loan. otherwise called as dash loan, long-term loan. Initially, State Bank of India allowed this company a repayment period of 10 years. How many years? This company is required to repay this loan of 10 crore rupees to State Bank of India over a period of 10 years because it is a long-term loan. Okay. By the end of 31st March 2023, interest accrued on that loan is say 40 lakh rupees. Interest accrued is, let us assume, as 40 lakh rupees. Now, what is the total balance of loan as on 31st March? 10 crores is the principal amount. 40 lakh rupees is the interest accrued and due. The total balance in the loan account is 10 crore 40 lakhs. Yes or no? Now, on 31st March 2023, what central government did? Central government had given a notification in the official gazette asking all the manufacturers of plastic carry bags to shut down their business operations permanently from 1/4/2023. SBI came to know, remember, this loan amount has been reflected, this amount of 10 crore 40 lakh rupees has been reflected by the organization under the heading non-current liabilities, under the heading long-term borrowings on equity and liability side of the balance sheet. The organization reflected this amount under the heading equity and liabilities, under the heading non-current liabilities, and under the heading long-term borrowings in their balance sheet. Now SBI came to know that this company will not survive in future because the company had to shut down their operations immediately. Hence, SBI started asking the company to make the payment within 10 days. What was the earlier time given? What was the earlier period given by SBI? 10 years. Now what SBI is asking the company? We came to know that you are going to shut down your business within a few days. Therefore, make the repayment of our loan within 10 days. And if you pay this amount, we are ready to forego interest amount. We don't need payment of interest. We need repayment of principal. Just pay us 10 crore rupees. We will forego the remaining 40 lakh rupees towards interest. This is what SBI says. Now tell me, in the given example, can you say that the classification, what is that? In the given example, can you say that classification of liability made by the management in the balance sheet as, do you think it as correct or incorrect? If it is correct, okay. If it is incorrect, what should have been the classification? I repeat my question. Management had classified this loan as a long-term borrowing under the heading non-current liabilities. SBI is asking the company to make the repayment within a period of 10 days. In that case, this loan should have been classified as a dash. This loan should have been classified as a current liability under the heading short-term borrowings. So instead of classifying it as a dash, management classified it as a dash. Instead of classifying the loan as a current liability, management classified it as a non-current liability. Yes or no? Similarly, how much is the value of the loan reflected in the balance sheet? 10 crore 40 lakhs. How much is sufficient to disclose? 10 crores. Here, the classification of liability made by the management becomes wrong. Yes or no? I repeat my question, my statement. Here, classification of the loan done by the management becomes wrong. Yes or no? Valuation of liability made by the management becomes wrong. Yes or no? Classification of loan is wrong. Valuation of the loan is also wrong. Coming to the asset side. The company purchased plant and machinery worth rupees how much? 10 crores. Depreciation claimed on it is 10 lakhs. The value of the plant and machinery is now 9 crore 90 lakhs. This has been reflected by the organization under the heading non-current assets under the heading PPE. Under the heading PPE. Unfortunate thing is that from the next day onwards, this plant and machinery could not be used by the company and it cannot be sold also. Why? Because it can be sold only to other manufacturers. All the manufacturers had to shut down their operations from 1st April onwards. So there is no use in holding this plant and machinery by the company. This plant and machinery shall have to be sold by the company as scrap. Then the company would be able to receive only an amount of 1 crore out of such scrap. Now I want to ask you 2 more questions. Question number 1. Is the classification made by the company classifying their plant and machinery as a non-current asset, showing it under the heading PPE a correct classification? No. Is the value that is being reflected in the balance sheet against the heading plant and machinery a correct value? No. Now I am going to conclude this discussion. Ready? Classification of liability becomes wrong. Valuation of liability becomes wrong. Yes or no? Classification of asset also becomes wrong. Valuation of asset also becomes wrong. When classification of assets and liabilities becomes wrong, when classification of assets and liabilities becomes wrong, when valuation of assets and liabilities becomes wrong, can you say that the financial statements of such an organization are reflecting a true and fair view? Now my only question to you, why the financial statements in the given example are not reflecting a true and fair view? Why the financial statements in the given case are not reflecting a true and fair view? Why? Because dash made by dash as well as dash made by dash becomes dash. Classification of assets and liabilities becomes wrong. Valuation of assets and liabilities also becomes wrong. The question is, why they became wrong? Because the going concern assumption made by the management while preparing the financial statements becomes wrong or inappropriate. That is the reason why financial statements of the entity are not reflecting a true and fair view. Now, I want to raise the same question again before you. What happens if the going concern assumption made by the management in preparation and presentation of financial statements becomes wrong or inappropriate? What happens if the going concern assumption made by the management in preparation and presentation of financial statements becomes wrong or inappropriate? Financial statements will never reflect a true and fair. That means whether the financial statements that are provided to the auditor are reflecting a true and fair view or not is also dependent upon whether dash made by dash in preparation of dash is a dash or dash. Whether going concern assumption made by the management in preparation and presentation of financial statements is appropriate or is inappropriate. Therefore, it is your responsibility as an auditor to check whether dash made by dash is appropriate or not. Whether going concern assumption made by the management is appropriate or not. Followed the discussion or not? Now read it. It is our responsibility as an auditor to check whether the going concern assumption made by your management is dash or not, appropriate or not. That means auditor is declaring to the users of the financial statements that he even checked the appropriateness of the going concern assumption made by the management. It is his responsibility as an auditor. I am made responsible to check the appropriateness of accounting policies being followed by your entity. I am made responsible to check the reasonableness of accounting estimates that were made by your entity. I am made responsible to check your internal controls. I am made responsible to check whether the going concern assumption made by the management in preparation of financial statements is appropriate or inappropriate. These are all our responsibilities as dash. As an auditor. Your responsibilities were mentioned in the previous paragraph. Our responsibilities are being explained to you in this paragraph. Followed or not? And I cannot explain you the concept of material uncertainty for the same reason for which I haven't explained you point number 18 under Caro. Point number 18 under Caro has not been explained to you, because that is having a direct link with going concern. That is having a direct link with going concern. Under that heading, I said to you like events or conditions, financial events, operating, other. No. Okay, enough. That is enough. Now, auditor should also evaluate overall presentation and structure and content of the financial statements, including disclosures and whether they represent the underlying transactions and events in the manner that achieves fair presentation. Auditor is also made responsible to consider the materiality. This is all about the concept of materiality. This I cannot explain now, but this is the basis for key audit matter paragraph. Okay, next. That's it. Enough. So these are all the duties of dash, responsibilities of the auditor. Under that paragraph, sometimes auditor is required to include a subparagraph. This is subparagraph 2, auditor's responsibility for audit of financial statements. The name of the subparagraph is like this: report on other legal and regulatory requirements. This is not the first time you are going through this heading. Okay, when I'm explaining you company audits, I said that I cannot explain 143 subsection 3 now, but when we are having a discussion on essay 700, I must have to explain you about 143 subsection 3. So in tomorrow's session, first of all, I will take up a discussion on 143 subsection 2 and 143 subsection 3. Once they are completed, then I will come back to this subheading in the auditor's responsibility paragraph, report on other legal and regulatory requirements. Then only you can understand what are the responsibilities of the auditor. By this, I am concluding today's session. In tomorrow's session, we are going to have a discussion on what? 143 subsection 2 and 143 subsection 3. Avi complete అయిపోతే it may take not more than just half an hour for me to complete essay 700. So after completion of 143 subsection 3 and 2, it may take not more than half an hour for me to complete essay 700. Later on, we can focus either on essay 701 or on essay 705. బాబు మీరు మూస్తే తెరుస్తా నేను నోరు. Section 143 of the Companies Act, particularly Section 143 subsection 3 of the Companies Act, as said earlier, auditor's report should also include the contents of Section 143 subsection 3. In the previous discussion, I said to you that the auditor's responsibility for audit of financial statements paragraph shall contain a subparagraph. The name of the subparagraph is report on other legal and regulatory requirements. Report on other legal and regulatory requirements. Under this heading, auditor should include section 143 subsection 3, requirements of section 143 subsection 3, as well as section 143 subsection 11. Now 143 subsection 11 is well known to you, which deals with the concept of CARO. So CARO reporting is to be done. CARO reporting is to be done by the auditor under the heading report on other legal and regulatory requirements. So two important sections are required to be covered by the auditor under the heading report on other legal and regulatory requirements. Remember, this is a sub-heading of the main heading. Main heading is auditor's responsibility for audit of standalone financial statements. Therefore, in order to understand the requirements of section 143 subsection 3, I want to explain you the particular section by going through the Bare Act. This is the Bare Act. This is 143 subsection 3. Clause A is well known to you. The auditor's report shall also state, the auditor's report shall state whether he here means auditor has sought and obtained all the information and explanations which to the best of his knowledge and belief were necessary for the purpose of his audit. This point has already been explained to you twice till date. So I don't want to explain it further. It is your responsibility as an auditor to obtain information and explanations either from the company or from any officer of the company. And if you are able to obtain such information, report the matter to the shareholders. If the auditor fails to obtain such information, again the auditor is required to report the matter to the shareholders. And information is nothing but technically called as audit evidence, on which the auditor shall have to come to conclusions and on the basis of which the auditor has to form an opinion. So information is key to the auditor, and hence if the auditor is unable to obtain information and explanations, the same shall be reported by the auditor. If the auditor is able to get required information and explanations, then also the same should be reported by the auditor to the shareholders. I will try to show you the actual way in which auditor will make a report under section 143 subsection 3 of the Companies Act. So whether he has sought, that is the wording that was used in the act. Now the auditor in his report specified like this: we have sought and obtained all the information and explanations which to the best of our knowledge and belief were necessary for the purpose of audit. This is 143 subsection 3 clause A. The other points that I told you about this point is sometimes management may fail to provide required information and explanations to the auditor on the ground that the information required by the auditor is secret or sensitive in nature. In that case, it is the responsibility of the auditor to create confidence. It is the responsibility of the auditor to create confidence to the management that auditor will not pass on or will not disclose such information to third parties, for which auditor is required to communicate with the management by referring to clause 1 of part 1 of second schedule to the Chartered Accountants Act. What is clause 1 of part 1 of second schedule to the Chartered Accountants Act? According to that clause, a chartered accountant in practice shall be deemed to be guilty of professional misconduct if he discloses any information to a third party without the consent of the client or as required by any law for the time being in force. This is the other point that we discussed under that 143 subsection 3 clause A. By this, I can say that I completed a discussion on 143 subsection 3 clause A. Under that heading, you need to make a report to the shareholders explaining them whether you are capable of getting required information and explanations or not. Then the next one is the auditor should also mention whether the company under his audit is maintaining proper books of account. The auditor కొంచెం ఫ్యాన్ కట్టేవే అనుకోకుండా పాపం వేసావు కానీ బాగా నిద్ర వచ్చేస్తుంది. అంటే ఇవాళ మూల నక్షత్రం కదా, అమ్మవారి దర్శనానికి వెళ్ళొచ్చా పొద్దున్నే 1:30కి. అందుకని కొంచెం నిద్ర. పర్లేదంటే మీరు పర్వాలేదన్నా పర్వా ఉందన్నా క్లాసే, తమ్ముడే ప్యాకాటే. సరే. వెదర్ ఇన్ హిజ్ ఒపీనియన్ proper books of account as required by law, whether in his opinion proper books of account as required by law have been kept by the company so far as appears from his examination of those books, and proper returns adequate for the purposes of his audit have been received from branches not visited by him. I repeat, you need to check whether the company under your audit has maintained proper books of account as required by law. What is meant by proper books of account as required by law? When I say proper books of account as required by law, every one of you must be able to recollect section 2 clause 13 of the Companies Act. What section 2 clause 13 of the Companies Act says? Every company is required to maintain such books of account which shall include details relating to all sums of money received and expended, all purchases and sales, all assets and liabilities and assets, and where the company has been directed by the central government to make and maintain cost accounting records. Such cost accounting records shall also form part of the books of account to be maintained by the company. Apart from that, company is required to maintain several other books of account as per the provisions of the Companies Act, like register of shareholders, register of debenture holders, register of charges, etc. Therefore, it is our duty as an auditor to assess or to evaluate whether the company under our audit is maintaining proper books of account or not as required by law. So you need to check whether company is maintaining proper books as required by law, and the same is to be reported. Whether in his opinion proper books of account as required by law have been kept by the company so far as appears from his examination of those books. That is point number 1. And proper returns adequate for the purposes of his audit have been received from branches not visited by him. The second part of clause B is difficult to understand without some further explanation. So first of all, I will try to explain you some important aspects that were mentioned under section 128 of the Companies Act. Section 128 of the Companies Act also deals with the concept of books of account. So if you are having knowledge of section 128 of the Companies Act, then only you can understand the terminology that was used under 143 subsection 3 clause B. So what is section 128? The following are the provisions of section 128 of the Companies Act. Point number 1, a company is under obligation to maintain its books and other related records only at its registered office. Where any company wants to maintain its books of account at a place other than the registered office, or where any company wants to move the books of account out of its registered office, first of all, the board of directors of such a company are required to pass a resolution to that effect, and the resolution so passed by the copy of the resolution so passed by the board of directors is required to be filed with concerned register of companies. This is a procedural formality. So, a company is under obligation to maintain its books of account only at its registered office. If you want to maintain your books of account at a place other than registered office, or if you want to move the books out of your registered office, you need to pass a resolution to that effect. Board of directors had to pass a resolution to that effect, and a copy of the resolution is required to be filed by the company with the register of companies. This is point number 1 under section 128 of the Companies Act. Point number 2. However, if the company is having any branch office, where the company is having a branch office, books relating to such branch, that branch may be either a foreign branch or an Indian branch. If the company is having either an Indian branch or a foreign branch, the company has been given a liberty to maintain books of account either at its registered office or even at its branch office. In other words, books of account relating to branch may be maintained by the company either at the branch itself or they may be maintained by the company at the registered office. Sometimes it may so happen that the company may have decided to maintain books of account relating to branch only at the branch level, not at the registered office. Supposing that there is a company called as A Limited. A Limited is having a head office in India. A Limited is also having a branch office in USA. Now A Limited decides to maintain books of account relating to the branch. A Limited decides to maintain books of account relating to the branch, not at the registered office of the company, but in the branch itself. Therefore, what the company is doing is, books relating to its head office are being maintained at the registered office. Books relating to foreign branch are being maintained by them at the branch level only, though they were not maintained at the registered office. So where the company is having a branch and where the books of account relating to the branch are being maintained at a branch level, it is necessary for the company to provide copies of such books of account to their head office at periodical intervals not exceeding 3 months. What is that? Not exceeding 3 months. That means once in 3 months, all the books and other related records that are being maintained at the branch level are required to be sent to the registered office. In that case, branch books are available not only at dash but also at dash. Not only at the branch office, but they are also made available at the registered office. Remember, this rule of sending books of account of the branch to the registered office of the company once in 3 months is made applicable in respect of foreign branches. In other words, where the company is having a foreign branch and where the books of account and other related records of such a foreign branch are being maintained by the company at the branch level only, then the company is under obligation to send copies of such accounts to its registered office once in 3 months. Once in 3 months. Similarly, the company may be having a branch office in India. The company may be having a branch office in India. In that case, the company may again decided to maintain books and other related records of the branch at the branch level only, not at the registered office. In such a case also, the company is permitted to maintain its books of account at its branch level. Again, in that case, the company is required to send the accounts relating to the branch to its registered office at periodical intervals. The term periodical intervals has been used in the Act, but nowhere in the Act it was defined. The term 3 months period is applicable only to foreign branches. For an Indian branch, periodicity has not been mentioned. Since it was not mentioned in the Companies Act, we can make an assumption that whatever be the type of the branch, whether it be a foreign branch or it be an Indian branch, particularly where the company is maintaining its books of account at the branch level, once in 3 months, the company is required to provide copies of such books of account to the registered office so that books are available both at registered office as well as at branch office. This is the most important point. Such accounts that are being sent by the branch, such accounts that are being sent by the branch to the registered office at periodical intervals, such accounts that are sent by the branch to its registered office once in 3 months is technically called as filing returns relating to accounting. Filing returns relating to accounting. This is about point number 2. Point number 3 and 4 were already discussed with you, which are well known to you. Point number 3, a company is required to maintain its books of account only by following double entry system of accounting. A company cannot follow single entry system of accounting. Point number 4, a company must follow only accrual system of accounting. A company cannot follow cash basis of accounting. These are all the provisions of section 128 of the Companies Act. Now I will try to show you what is section 128 so that you will have better understanding of the contents of the Companies Act, section 128 of the Companies Act. Then I can read the same point, that is 143 subsection 3 class C again. Every company shall prepare and keep at its registered office books of account. What are books of account? Books of account have been defined by section 2 class 13 of the Companies Act. Books of account includes records maintained in respect of all sums of money received and expended, sales and purchase, assets and liabilities, items of cost. Enough. If every company shall prepare and keep at its registered office books of account and other relevant books and papers. Books and papers includes books of account, deeds, that means title deeds, vouchers, any document, minutes, everything. Registers maintained. What are the examples of registers maintained by a company? Legal registers are register of shareholders, register of debenture holders, register of charges. Those are referred to as registers maintained either in the form of paper or an electronic form. Read it again. Every company shall prepare and keep at its registered office books of account and other relevant books and papers and financial statements for every financial year, which give a true and fair view of the state of affairs of the company, including that of its branch office. What is that? Including that of its branch office. What is the meaning of this? I have even defined you the branch, the word branch. What is branch? Have I explained you the definition of branch? No. Okay. Branch can be defined as any establishment which is described as such by the company. Over. Branch can be defined as any establishment which is described as branch by the company. For example, I am a company, I am describing this as branch, then this will be called as branch. That's it. That is the definition of branch. So, every company shall keep the books of account at their registered office, including the books of account relating to branch office or offices, if any. And such books shall be kept on accrual basis of accounting and according to double entry system of accounting. The next one, provided that all or any of the books of account aforesaid and other relevant papers may be kept at such other place, in India as the board of directors may decide and where such a decision is taken, the company shall, within 7 days thereof, file with ROC a notice in writing giving full address of that other place. This is what I told you. A company is required to maintain its books of account at its registered office. If you want to maintain your books of account at a place other than the registered office, the board of directors of the company had to pass a resolution to that effect, and a copy of such resolution shall have to be filed by the company with the register of companies. Next, by providing the full address of that other place where the books are being maintained. Provided further that the company may keep such books of account or other relevant papers in electronic mode or in such manner as may be prescribed. Now, where a company, this is important, where a company has a branch office in India, where a company is having a branch office in India or outside India, where the company is having a branch office either in India or outside India, it shall be deemed to have complied with the provisions of subsection 1 if proper books of account relating to the transactions effected at the branch office are kept at that office. What is the meaning of that? Kept at that office. What is the rule and what is the exception to the rule? The rule is that every company must maintain its books of account only at its registered office, including books of account relating to its branch office. That is the rule. Now, what is the exception? The exception is a branch office can maintain books of account at the branch itself. There is no compulsion on the part of the company to maintain books of account relating to the branch only at the registered office of the company. You may either maintain books of account relating to branch at the registered office, or else you could maintain such books of account at dash level, at branch level. Where a company has a branch office in India or outside India, it shall be deemed to have complied with the provisions of subsection 1 if proper books of account relating to the transactions effected at the branch office are kept at that office and proper summarized returns, summarized. Now read this. Whether in his opinion proper, this is 143 subsection 3 clause B, whether in his opinion proper books of account as required by law have been kept by the company so far as appears from his examination of those books and proper returns. Now you find that the term returns is appearing both under section 128 and under section 143 subsection 3 clause B. Yes or no? So in order to explain you about what is returns, I started having an explanation on section 128. So, and where the company is having a branch office either in India or outside India, and where the company is maintaining its books of account at its branch, then proper summarized returns periodically are sent by the branch office to the company at its registered office or other place referred to in subsection 1. That means if you are maintaining your books of account at your branch level, periodically you need to send proper summarized returns. What is meant by summarized return? Copies of such books of account are being called as proper summarized returns, must be sent by the branch to the registered office periodically. In the rules, it was mentioned that in respect of foreign branches, periodicity means once in 3 years. But in respect of Indian branches, no such period is mentioned. So we made an assumption that period is applicable both for an Indian branch as well as for a foreign branch. This is what I want to convey to you, the term returns. It is appearing both under 128 and 143 subsection 3 clause B. Returns periodically are sent by the branch office to the company at its registered office. That's it. This is enough for you. Now come back to the original discussion. 143 subsection 3 clause B, whether in his opinion, now this point need not be elaborated, whether in his opinion proper books of account as required by law have been kept by the company so far as appears from his examination of those books, and proper returns adequate for the purposes of his audit have been received. Proper returns adequate for the purpose of his audit have been received from the branches not visited by him. Next. So by this 143 subsection 3 clause A and clause B are completed. Read it again. Auditor's report shall also state whether he has sought and obtained all the information and explanations which to the best of his knowledge and belief were necessary for the purpose of his audit, whether in his opinion, that means whether in the opinion of the auditor, the company has maintained proper books of account as required by law, and whether proper returns adequate for the purpose of his audit have been received from branches not visited by him. That means branch had to send periodical returns to its registered office. Whether they were received or not shall be checked by you, and you need to make a report to the shareholders. Now go through the original auditor's report. In our opinion, this is clause B. So how the auditor is expressing this? In our opinion, proper books of account as required by law have been kept by the company so far as it appears from our examination of those books. That's it. Okay. Next. The third one. Clause C. Whether the report, this is a continuation of clause B, whether the report on the accounts of any branch office of the company audited under subsection 8. If you are unable to understand this, I can say that either I may have failed in explaining you the subject correctly, or you may have failed in listening to it correctly. Okay. Whether the report on the accounts of any branch office of the company audited under subsection 8 by a person other than the company auditor has been sent to him under the provision to that subsection, and the manner in which he has dealt with it in preparing his report. What you understood by going through 143 subsection 3 clause C. You are the head office auditor. You are not the branch auditor. The company is having a branch. You are the auditor of head office. Somebody else has been appointed as the branch auditor, and provisions relating to appointment of branch auditor, his rights, his duties, and so on have been discussed by us under section 143 subsection 8 of the Companies Act, wherein I highlighted that branch auditor is required to address his report, branch auditor is required to address his report, as well as is also required to submit his report to the company's auditor. The company auditor will in turn consolidate all the reports received from several branches, and then the company auditor will prepare a final report which is required to be addressed to the shareholders and required to be provided to the company secretary. So what the statutory or head office auditor is declaring under 143 subsection 3 clause C, dear shareholders, your company is having a branch office. I am the auditor of only head office and I am not the auditor of branch office. Some other person has already been appointed as the auditor of your branch office. That person conducted audit of the branch and that person forwarded his report to me. That person forwarded his report to me. That person means branch auditor forwarded his report to me. Me means the statutory auditor. That means although I am not the branch auditor, I received a branch auditor's report. That is what the auditor is conveying or is required to convey to the shareholders under section 143 subsection 3 clause C. Whether the report on the accounts of any branch office of the company audited under subsection 8 by a person other than the company auditor has been sent to him under the provision to that subsection and the manner in which he has dealt with it in preparing his report. Point clause D. This point I will try to show only clause D because clause C is not appearing here. Okay. Clause D. Clause D in the original act and point C in this report are one and the same. This was already explained to you. Whether company's balance sheet and profit and loss account dealt with in the report are in agreement with the books of account and returns. If you keenly observe that provision, you would have identified that the term returns is again appearing there. So what is your duty as an auditor under 143 subsection 3 clause D? What is appearing in the books of account shall also appear in financial statements. That means there should be a dash between dash and dash, an agreement between books of account and the items that are reflected in the financial statements. Read it again. That is the reason why, in order to verify whether balance sheet is correctly prepared or not, whether profit and loss account is correctly prepared or not, first of all, you need to check the correctness of the trial balance. You need to check the correctness of ledger. You need to check the correctness of a journal. That means you are focusing on books of account. Why you are focusing on books of account? To ensure that what is appearing in the books and what is appearing in the financial statements is one and the same. They are in agreement with one another. Whether company's balance sheet and profit and loss account dealt with in the report are in agreement with the books of account and returns. Here returns implies branch related returns. Next one. This point is very easy to understand. Whether in his opinion the financial statements comply with accounting standards. I said to you earlier that every company is under obligation to follow accounting standards in preparation and presentation of financial statements. The section 133 of the Companies Act specifies that company must have to prepare their financial statements by following accounting standards. Accounting standards are of two types. The first one is original accounting standards. The second one is Ind AS. I said to you earlier, particularly when I am explaining you about Division 1, Division 2 and Division 3 of Schedule 3 to the Companies Act, I said to you that Division 1 is made applicable to those companies which are required to follow original accounting standards for the purpose of preparation and presentation of financial statements. Division 2 is made applicable to those companies for which Ind AS are made applicable. Division 3 is made applicable for very good non-banking financial companies. Now, earlier you may not have knowledge about what is a non-banking financial company. Now I feel that I have provided you with adequate knowledge relating to non-banking financial company. We had an elaborative discussion on NBFCs under the heading CARO. So how the auditor is expressing this in his report? In our opinion, the aforesaid standalone financial statements comply with the Ind AS. This company is a dash company, listed company. For all listed companies, Ind AS is made mandatory. That is the reason why the auditor is declaring to the shareholders that the company followed Ind AS, which were specified under section 133 of the Companies Act for the purpose of preparation of such standalone financial statements. Now go through the original law, whether in his opinion, that means in the opinion of the auditor, the financial statements prepared by the company have complied the accounting standards, applicable accounting standards. Sometimes only old accounting standards may be made applicable. Sometimes Ind AS may be made applicable. That is about point number E. Now point number F. This is very difficult to explain to you. For explaining this, I will try to explain some other important points relating to going concern. In the previous class also, we had some discussion about going concern. What is that? Inka What is the importance of going concern? What is the importance of going concern to the management as well as to the auditor? Every organization, while preparing their financial statements, had to follow fundamental or basic accounting assumptions. Those fundamental or basic accounting assumptions are three in number. First one is going concern, the second one is consistency, the third one is accrual. When the company follows basic or fundamental accounting assumptions in preparation and presentation of financial statements, that fact need not be disclosed by the company in the financial statements. However, if the company fails to follow those fundamental or basic accounting assumptions, then the fact should be disclosed by the company in the financial statements. This is point number one. One such basic or fundamental accounting assumptions is going concern. Every organization is required to prepare their financial statements by taking an assumption that their entity will continue in its operations for a foreseeable future. That assumption made by the entity is technically called as going concern. If the going concern assumption made by the entity becomes is found to be appropriate, if the going concern assumption made by the management is appropriate, there would not be any problem either to the auditor, there would not be any problem either to the auditor or even to the management. However, where the going concern assumption made by the management is wrong or is inappropriate, then it can be said that the classification of assets and liabilities becomes wrong, valuation of assets and liabilities also becomes wrong, and hence financial statements will not reflect a true and fair view. That means whether financial statements prepared by the entity are reflecting a true and fair view or not is also dependent upon whether going concern assumption made by the management is appropriate or not. That is the reason why, as said earlier, if you were the auditor of a company, you are under obligation to evaluate. If you were the auditor of a company, you are under obligation to assess, to evaluate whether the going concern assumption made by the company in preparation and presentation of financial statements is appropriate or inappropriate. Is appropriate or inappropriate. When it is found to be appropriate, there would not be any problem to the auditor. When it is found to be inappropriate, then financial statements will not reflect a true and fair view. So what is your duty as an auditor in respect of going concern assumption made by the management? You need to check whether that assumption made by the management is appropriate or not. Usually, at the time of commencement of audit, auditors do make an assumption that the going concern assumption made by the management is appropriate. Management is of the opinion that their organization is a going concern. Auditor will also make an assumption that, okay, whatever the assumption that the entity took is a correct assumption, a reasonable assumption. However, sometimes during the course of performance of audit, I repeat, while preparing financial statements, management will take an assumption that the entity will continue in its operations for a foreseeable future. That assumption is called as a going concern assumption. And at the time of commencement of audit, the auditor will also make an assumption that the entity is a going concern. However, sometimes during the course of performance of audit, the auditor may come across any one of the following events or conditions. I repeat, initially the auditor was of the opinion that the entity is a going concern. With that opinion only, the auditor started conducting audit. But during the course of performance of audit, the auditor may come across some events or conditions. The auditor may come across some events or conditions. And because of the existence of such events or conditions, there may rise a doubt to the auditor. There may rise a doubt to the auditor about the entity's ability to continue its operations for a foreseeable future. Please try to read the entire sentence so that you may have some more idea. While preparing financial statements, management will make an assumption that the entity is a going concern. At the time of commencement of audit, the auditor will also assume that the entity is a going concern. Based on that, the auditor started conducting audit. However, during the course of performance of audit, the auditor comes across some events or conditions. When the auditor comes across such events or conditions, the existence of such events or conditions may raise a doubt to the auditor. So when you come across events or conditions, that should raise a doubt to you about what? About the entity's ability to continue its operations for a foreseeable future. Just now we are of the opinion that the entity is a going concern, but we came across some events or conditions. Because of the existence of such events or conditions, now the auditor is of the opinion that the entity may not be able to continue its operations for a foreseeable future. Such events or conditions are classified broadly into three categories. The first one is financial events or conditions. The second one is operating events or conditions. And the third one is other events or conditions. I will try to explain you almost everything under the heading financial, operating and other events or conditions, so that you will get some more knowledge about this, which will be certainly helpful in understanding the relevant point. What is the relevant point? I am going to discuss with you about 143 subsection 3 clause F. Under clause F, a particular point is appearing. The point that is appearing is like this: the observations or comments of the auditor on financial transactions are matters which have any adverse effect on the functioning of the company. I want to explain you in detail about the term adverse effect on the functioning of the company. If you really want to understand the term adverse effect on the functioning of the company, first of all, you must have some knowledge about SA 570. So, now the auditor made an assumption that the entity is a going concern. However, during the course of performance of audit, the auditor comes across or has identified some events or conditions. When the auditor identifies such events or conditions, then the auditor should get a doubt. What is the doubt the auditor should get about? ఇప్పటిదాకా మనం ఈ ఆర్గనైజేషన్ గోయింగ్ కన్సర్న్ అని అనుకుంటున్నామే, ఇది నిజంగా గోయింగ్ కన్సర్నేనా? విల్ ఇట్ కంటిన్యూ ఇట్స్ ఆపరేషన్స్ ఫర్ ఎ ఫోర్సేబుల్ ఫ్యూచర్ జస్ట్ లైక్ వీ మేడ్ అన్ అజంప్షన్? Is it really possible for this entity to continue its operations for a foreseeable future? That is the doubt the auditor should get when the auditor comes across dash events or conditions. Such events or conditions have been classified broadly into three categories. The first one is financial events or conditions. The second one is operating events or conditions. And the third one is other events or conditions. Previous to revision of SA 70, these financial events, operating events or other events were called as indicators or indications. Indicators or indications. Previously, they were called as indicators. Financial indicators, operating indicators, other indicators. Now they are being called as financial events or conditions, operating events or conditions, other events are conditions. There are almost 12 points under the heading financial events or conditions. Almost 5 points under the heading operating events or conditions. And almost 3 to 4 points under the heading other events or conditions. I will try to explain you some of those points briefly so that you can understand what is meant by event or condition and why there should arise a doubt to the auditor about the entity's ability to continue its operations for a foreseeable future when the auditor comes across such dash. Till then, there is no doubt to the auditor about the entity's capability, about the entity's ability to continue in its operations for a foreseeable future. When the auditor comes across any one of those events or conditions, then the auditor should get a doubt about whether this entity is really capable of continuing its operations for a foreseeable future. Such events or conditions have been classified broadly into 3 categories: financial, operating, and others. The following are few examples for financial events or conditions. 1. Substantial and continuous operating losses. Second one, negative cash flows. Very good, very good. Third one, negative net worth. Fourth one, negative working capital. Fifth one, adverse key financial ratios. Sixth one, inability to pay creditors on the due dates. Seventh one, creditors insisting on cash on delivery basis. Violation of the terms of loan agreements or debenture agreements. I repeat, 1. Substantial and continuous operating losses. 2. Negative cash flows. 3. Negative net worth. 4. Negative working capital. 5. Adverse key financial ratios. 6. Inability to pay creditors on the due dates. 7. Creditors insisting on cash on delivery basis. 8. Violation of the terms of loan agreement or debenture agreements. Point number 9. Use of short term using short-term sources of finance for meeting their long-term requirements. The 10th one is fixed-term borrowings. Fixed-term borrowings approaching maturity. Fixed-term borrowings approaching maturity without realistic prospects of renewal or repayment. Actually, these are all the things that you must have knowledge of to understand point number 18 under Caro. And these points must be understandable to you. Again, to have an understanding of the term adverse effects on the functioning. If the company is unable to function, can you call it as going concern? If the company is unable to function, can you call it as going concern? So functioning is the term relatable to dash, going concern. and we are having a discussion on going concern assumption only. So these are all technically called as financial events or conditions. What are they? For example, till then, the auditor was of the opinion that the entity is a going concern. However, during the course of performance of audit, the auditor observes that the entity under his audit is suffering with negative cash flows. When the entity is suffering with negative cash flows, is there a possibility that the entity may shut its operations in near future or not? If yes, why? If yes, why? I do agree with you. When you are suffering with negative cash flows, there is a chance that you may have to shut down your business. You may not be able to continue your business. Why? When the cash flows are positive, you can continue your life or business. When the cash flows are negative, you cannot do that. For example, I am getting a salary of 100 rupees per month. My expenditure per month is 200 rupees. My inflow is 100 rupees. My outflow is 200 rupees. How should I meet this deficit of 100 rupees? I borrowed an amount of 100 rupees from one of my friends. He has given me an amount of 100. I promised him that I will repay this amount of 100 within a month's time. So 100 salary plus 100 borrowing, 200. The entire amount of 200 has been spent in month number 1. Again, in month number 2, I received a salary of 100 rupees. Now my expenditure is 200 rupees. To meet the shortfall of 100, what I did is I have taken a loan of 200 rupees from one of my friends. Out of 200, 100 rupees has been used for the purpose of making repayment of the previous loan, and the remaining 100 rupees has been used to meet this shortfall. So in the second month, I took a loan of how much? 200 rupees. In the third month, it will become 300. In the fourth month, it will become 400, and so on. At one point of time, I will recognize that I may not be able to make the repayment. At that point of time, I may leave that city. That means I am not said to be, I may file an insolvency petition with court of law also. In that case, it is said that I am not continuing in my original business. Therefore, it is said that I am not a going concern. Why the entity is not being considered as a going concern? For the simple reason that it is suffering with dash. So where the auditor of an entity identifies that the entity under his audit is suffering with negative cash flows, it is an indication that the entity may or may not, may or may not be able to continue its operations for a foreseeable future. Till now, we are of the opinion that the entity is a going concern. Now, for the first time, you got a doubt about the entity's ability to continue in its operations because the entity is already suffering with dash. Negative cash flows. The third one is negative net worth. The fourth one is negative working capital. Net worth should always be positive. Net worth should always be positive. If net worth is negative, what does it implies? You are not having any capital to carry on your operations. When you are not having any capital, for example, capital of the company is 100 rupees. Reserves and surplus of the company is minus 200. Reserves and surplus is minus 200. What does it implies? The entire capital of the company has been wiped off due to losses. In that case, it is said that the net worth of the company is negative. Okay, or else you could I can give another example to you for this. How do you calculate net worth? Assets minus liabilities. If the value of the liabilities exceeds the value of the assets, then it is called as the net worth is negative. The next one is negative working capital. What is that? Negative working capital. If working capital is positive, what is meant by positive working capital? If current assets are more than current liabilities, it is said that working capital is positive. If current assets are less than current liabilities, it is said that working capital is negative. What is working capital? Do you know what is working capital? What is working capital? Don't say working capital means current assets minus current liabilities. Current assets minus current liabilities is a formula that we make use of to calculate working capital. It is not the meaning of working capital. Funds required to meet day-to-day transactions is technically called as working capital. So, for calculation of working capital, we use a formula current assets minus current liabilities. If current assets are more than current liabilities, it is said that your working capital is positive. If current assets are less than current liabilities, it is said that your working capital is negative. What would be the impact on the organization when the working capital is negative? Will the suppliers of goods come forward to supply goods to the entity on credit basis? Will the suppliers of goods are willing to provide raw material to the entity on credit basis, particularly when they observed that the entity is suffering with negative working capital? Certainly not. So current assets are less, current liabilities are more. There is no working capital, there is no production, there is no sale, there is no profit. Although the company is unable to get a profit, it suffered with huge losses. When the entity is constantly suffering with losses, there is no guarantee that the entity will be able to continue its operations. There is a chance that the entity may shut its operations in the very near future because it is suffering with substantial losses, or it is suffering with negative working capital. Like this, there are several other points. If you come across any one of these points, then as an auditor, you should get a doubt about dash. You should get a doubt about the entity's going concern, or you should get a doubt about the entity's ability to continue its operations for a foreseeable future. Like this, there are some other events or conditions like operating events. There are 5 points under the heading operating events. 1, loss of key managerial personnel without replacement. 2, loss of major market. 3, loss of principal supplier. 4, labor difficulties. And 5, emergence of a highly successful competitor. What is that? Emergence of a highly successful competitor. Okay. So these 5 points are going to be discussed by us in future when we are having a discussion on SA 570. And the other indicators are also 3 or 4 in number. The first one is violation of laws and regulations. The other one is pending legal proceedings that results into judgments, or that could result into judgments that may not be met by the organization, and changes in government legislations or policies, and so on. Uninsured or underinsured catastrophes. These are all events or conditions under the heading financial, operating, and others. So if you come across any one of these events or conditions, obviously they may have a negative impact on the dash of the company. They may have a negative impact. Negative or adverse, they both mean one and the same. Yes or no? Functioning or continuity, they both mean one and the same. Yes or no? Now read point number F on your own and try to understand it. Now I have established a link between 143 subsection 3 clause F and SA 570. Read that point on your own. The observations or comments of the auditor on financial transactions or matters which have any adverse effect, on the functioning of the company. Simply speaking, if you observe anything or any event or condition which will have an adverse impact or on the functioning of the company, the same, your observations or comments thereon shall have to be specified by the auditor under section 143 subsection 3 clause M. ఇది అయిపోతే మళ్ళీ వెళ్ళిపోవాలి క్లాస్ నుంచి బయటికి మనం. సో the observations or comments of the auditors on the financial transactions or matters which have any adverse effect on the functioning of the company. On the functioning of the company. Now, that point is not appearing in the auditor's report. Why? Because in the given case, the auditor had not observed anything, any financial, operating or other events or conditions which may have an adverse impact or effect on the functioning of the company. Therefore, that point was not included by the auditor in his report. So till now we have completed 5 points under 143 subsection 3. What are they? Whether the auditor has obtained information and explanations, whether the company is maintaining proper books of account, etc., whether the auditor received report from the branch auditor in respect of branches not visited by him, and whether balance sheet and profit and loss account dealt with in the report are in agreement with the books of account and returns, whether the opinion of the auditor, the financial statements comply with accounting standards, and the observations or comments of the auditor on financial transactions or matters which have any adverse effect on the functioning of the company. This point is a good point which is important in examination point of view also. If you want to understand 143 subsection 3 clause G, first of all you must understand section 164 subsection 2 of the Companies Act. If you are having knowledge of 164 subsection 2, then you can understand 143 subsection 3 clause G. I am not referring to 141 subsection 3 clause G, but I am referring to 143 subsection 3 clause G. I am not referring to 141 subsection 3 clause G, but I am referring to 143 subsection 3 clause G. What is 141 subsection 3 clause G? Ceiling on number of audits. The section number is different, that's it. Subsection is one and the same, clause is also one and the same. Now we are having a discussion on 143 subsection 3 clause G, which deals with directors disqualifications. Directors disqualifications under section 164 subsection 2 of the Companies Act. So if you want to understand this, first of all you must understand this. So first of all I will try to focus on section 164 subsection 2. 4 conditions were specified under 164 subsection 2. 4 conditions were specified under section 164 subsection 2. 4 conditions were specified under section 164 subsection 2. And if any company satisfies any one of those 4 conditions, if any company satisfies if any company satisfies any one of those 4 conditions, then all the directors of such company are disqualified from being reappointed as the directors of that company or from being appointed as the directors of any other company. All the directors for a period of 5 years from the date of such a default. I repeat, 4 conditions were given under 164 subsection 2. That is point number 1. Point number 2, if any company satisfies any one of those 4 conditions, then all the directors of that company shall be deemed to be disqualified to be reappointed as the directors of the same company or to be appointed as the directors of any other company for a period of 5 years from the date of such a default. That means if any one of those four conditions are satisfied, directors of the company are said to be disqualified. They cannot be reappointed. They cannot be appointed for any other company for a period of how many years? 5 years. That is called as directors disqualifications under section 164 subsection 2 of the Companies Act. The first point. How many conditions are there? 4 conditions are there. Now I will try to show you the conditions so that you may have some better understanding of those conditions. Section 164 of subsection 2 of Companies Act. This is subsection 2. No person. That means a person shall not. A person shall not. Who is or has been a director of the company. Point A, condition number 1. Point B, condition number 2. This has been divided by me into 4 conditions because point B includes 3 conditions. Okay. Condition number 2. If that company has failed, to repay the deposits accepted by it, failed to repay the deposits accepted by it, or failed to pay interest thereon. That is condition number 2. This is condition number 1, which was not yet explained. This is condition number 2. When a company failed to repay the deposits accepted by it, or failed to pay interest thereon. Next, or in the first condition also the term or is used. That is the reason why I said that if the company satisfies any one of those 4 conditions, then all the directors of such company are disqualified from being appointed as the directors of that company or any other company for a period of 5 years from the date of such a default. Or if the company failed if the company has failed to redeem any debentures on the due date or to pay interest due thereon. The first one and second one are almost similar to one another. In the first case, the company would have failed in repaying deposits. In the second case, the company would have failed in redeeming the debentures. In the first case, the company may have failed in making payment of interest on deposits. In the second case, the company may have failed in payment of interest on debentures. So only difference is the first one deals with deposits, the second one deals with debentures. That's it. Both are dash. Both are borrowings. Adukkotam. If the company has failed to repay the deposits accepted by it or pay interest thereon, or to redeem any debenture on the due date or pay interest due thereon, or the company has failed to pay any dividend declared, and such failure to pay or redeem any dividend declared and such failure to pay or redeem continues for 1 year or more. Here the term redeem is more important. I will try to focus on that also. First of all, I will try to tell you about dividend declared. Do you have any knowledge about dividends? If you say yes, within how many days a company is required to pay dividends? Don't try to make the law. Okay, if you are having knowledge of it, tell me. Otherwise, I will tell you. I will explain you the law. Okay, according to the Companies Act, according to the provisions of the Companies Act, whenever any company declares any dividend within 5 days, whenever any company declares any dividend within 5 days from the date of declaration of dividend, within 5 days from the date of declaration of dividend, the company is required The company is required to transfer the entire dividend proceeds into a separate bank account. What is the provision? This is mentioned in section 123 of the Companies Act. Okay. Whenever any company declares any dividend, within 5 days from the date of declaration of dividend, where dividend is declared in the annual general meeting. Who declare the dividend? Shareholders. In the AGM, shareholders are required to carry on ordinary business. Ordinary business is ADDA. What is ADDA? Appointment of auditors, declaration of dividend, the appointment of directors, adoption of or approval of annual accounts. Adoption or approval of annual accounts, appointment of directors, declaration of dividend, and appointment of auditors. These four are technically called as ordinary business. So who will declare dividend? Shareholders in an annual general meeting. Within 5 days from the date of declaration of dividend, the company is required to transfer the entire dividend proceeds into a separate bank account. For example, the company is having a paid up capital of 10 crores. The company declared a rate of dividend of 10% on it. 10% on it. Now the paid up capital of the company is 10 crores. The company declared a rate of dividend of 10%. That means the amount of dividend to be paid by the company is how much? The amount of dividend to be paid by the company is how much? 1 crore. This 1 crore rupees is required to be transferred by the company by opening a separate account in a bank. And that amount is required to be transferred by the company within how many days? Within 5 days from the date of declaration of dividend. This is rule number 1 relating to dividend. Rule number 2. And the dividend declared shall be paid. The dividend so declared shall be paid within 30 days. How many days? The dividend so declared shall have to be paid by the company to their shareholders within 30 days from the date of declaration of dividend, not from the date of transfer to separate account. This 30 days period is also required to be calculated from the date of declaration of dividend. That means, for example, if the company declared dividend on say 1st of August, within 5 days from 1st of August, the company is required to transfer the entire dividend proceeds to a separate bank account, and within 30 days from 1st of August, the company shall have to make the payment of dividend to the shareholders. Usually today companies are following the system of making payment of dividends through electronic transfers. That means dividend proceeds will be transferred from company's bank account to the bank account of the shareholders automatically, directly, without any further communication from company's side. However, it is the responsibility of the company. It is the responsibility of the company to go through that separate account. After the expiry of 30 days from the date of declaration of dividend. When the company goes through that separate bank account, sometimes the company may have identified that some balance is lying to the credit of that separate account. Some balance is lying to the credit of such separate account. What does it imply? It implies that that amount has not been paid even after 30 days. That amount is technically called as unpaid dividend. Such unpaid dividend is required to be transferred by the company to another separate account called as unpaid dividend account or unclaimed dividend account within 7 days from the expiry of 30 days. From the expiry of 30 days. So within 5 days from the date of declaration of dividend, the entire dividend proceeds are required to be transferred by the company to a separate bank account. Within 30 days from the date of declaration of dividend, the entire dividend is to be paid by the company. If some dividend is not paid by the company even after 30 days of declaration of dividend, such dividend shall have to be technically called as unpaid dividend or unclaimed dividend. Such unpaid dividend or unclaimed dividend should not be maintained by the company in that separate account. That amount shall have to be transferred by the company by opening another account called as unpaid dividend account or unclaimed dividend account of so and so company, limited or private limited, within 7 days from the expiry of 30 days. And that amount will remain in that unpaid dividend account or unclaimed dividend account for a period of 7 years from the date of such transfer. From the date of such transfer. After that, it will be transferred to Investor Education and Protection Fund. Investor Education and Protection Fund established by central government. Not only the dividend proceeds, the shares in respect of such dividends are also transferred to Investor Education and Protection Fund. Why I am telling all these things to you? Because you must know that dividend once declared is a liability on the part of the company. It must have to be paid by the company within how many days? Within 30 days. If the company fails to make the payment of dividend within a period of 30 days, and if such failure continues for a period of 1 year or more, company declared a dividend, but company failed to pay the dividend within for a period of 1 year or more. Such failure continues for a period of 1 year or more. What does it imply? It implies that the company failed in transferring the amount to separate account. Company declared dividend, but the company failed in transferring the amount of dividend payable to a separate account, and that failure continues for a period of 1 year. On one hand, the company declared the dividend. On the other hand, the company is not having any money to pay the dividend. Such failure continues for a period of 1 year or more. That means, is it not the negligence of the board of directors of the company? Is this not the negligence of the board of directors of the company? Certainly yes. Because of the negligence of the board of directors of the company only, the company has declared dividend, but unfortunately the company is not having adequate cash balance to make the payment of dividend. That is the reason why the company failed in making payment of declared dividend. Therefore, who should be punished? It is not the company, it is the director of the company. That is the reason why it is said in section 164, subsection 2 of the Companies Act, that if any company satisfies any one of the following 4 conditions, then all the directors of such company are disqualified from being reappointed as the directors of that company or appointed as the directors of any other company for a period of 5 years from the date of such default. Now come back to the original discussion. So what are the conditions? 4 conditions. Condition number 1, if the company under your audit has failed to repay the deposits or pay interest thereon, or failed to redeem debentures on the due date or to pay interest due thereon, or pay any dividend declared, and such failure, interest due thereon, or pay any dividend declared and failed to pay any declared dividend, and such failure to pay dividend or redeem debentures continues for 1 year or more, shall be eligible. Here, don't read it as shall be eligible. Here the term no person has been used. That means a person shall not be eligible. That means no person is eligible. What is the literal meaning of that? No person is eligible means a person is not eligible. That person is not eligible to be reappointed as the director of that company or appointed in another company in other company for a period of 5 years from the date on which the said company fails to do so. Followed or not? Out of 4 conditions, 3 were already completed. I am fearing to explain you condition number 1 because it is somewhat difficult and it is relatable to some other provisions of the Companies Act. I don't know whether those provisions were completed in our law subject or not. Annual return and annual do you know what is filing of financial statements and annual return? Okay. Just read it. When the company failed in filing, financial statements or annual returns for any continuous period of 3 financial years. Every year, every company is under obligation to file an annual return with concerned register of companies as per the requirements of section 92 of the Companies Act, if I am right. Section 92 deals with what? Annual return. Every company shall prepare a return hereinafter referred to as annual return in a prescribed form containing particulars as they stood on the close of the financial year regarding its registered office so and so. I don't want to explain you all those things. The only point that you need to understand from this discussion is that according to section 92 of the Companies Act, every company is under obligation to file annual return. Okay? Next. Section 137 of the Companies Act. A copy of the financial statements. Have you observed the terms financial statements? Have you observed the term financial statements and the term annual returns in the first condition under section 164 subsection 2? Annual return has been dealt with by which section of the Companies Act? 92. Filing of financial statements has been dealt with by which section of the Companies Act? 137. If the company fails either by complying with the requirements of 92 or by complying with the requirements of 137 for any continuous period of, that means the company is even unable to comply with the requirements of the Companies Act, and such failure continues for a continuous period of 3 years. In that case, all the directors of the company are disqualified from being appointed as the directors of that company or any other company for a period of 5 years from the date of such default. Now, can you please repeat what is discussed under 164 subsection 2? What is 164 subsection 2? 164, according to section 164 subsection 2 of the Companies Act, if any company satisfies any one of the following conditions, then that the directors of every director of that company is disqualified from being reappointed as the director of that company or from being appointed as the director of any other company for a period of 5 years from the date of such default. Condition number 1, if the company failed in filing their financial statements or annual return for a consecutive period of 3 years, or if the company failed to repay its deposits or failed to pay interest thereon on the due date, or if the company failed to redeem debentures or to pay interest on that debentures on the due date, and if such failure to redeem continues for a period of 1 year or more, if the company fails to pay dividend, and if such failure continues for a period of 1 year or more. That's it. This is 164 subsection 2. Why we are having a discussion on 164 subsection 2? Because as an auditor we need to make a comment under section 143 subsection 3 clause G, whether any director is disqualified from being appointed as the director under subsection 2 of section 164. To report this, what should you do as an auditor? To report this point, what should you do as an auditor? First of all, you need to check whether the company had satisfied any one of those, the company under your audit has satisfied any one of those 4 conditions. If the company under your audit satisfied any one of those 4 conditions, then the directors of the company are disqualified. Followed or not? If you really follow this point, I will try to explain you some other point which is more difficult than this point. Okay, ready? Done. Just a minute. Just for a minute. Wait for a minute. So I can complete that point also. Then I will give you a break. There is a company called as A Limited. You are the auditors of A Limited. You are the auditors of A Limited. There is another company called as B Limited, and say another company called as C Limited. A Limited is having Mr. D, Mr. E, Mr. F as their directors. Now, your name is X. You are the auditor of Dash, A Limited. What is your duty as an auditor of A Limited under 143 subsection 3 clause G? You need to verify whether A Limited has satisfied any one of those 4 conditions. You checked it thoroughly and you find that those conditions were not satisfied. That means the company has not failed in filing financial statements or annual return for a continuous period of 3 years. The company has not failed in making repayment of deposits or making payment of interest thereon on the due date, and so on. So there is no disqualifications to Dash of Dash, directors of A Limited. Unfortunate thing is that this D, one of the directors of A Limited, is also acting as the director of B Limited as well as the director of C Limited. So D is acting as the director of not only A Limited but also B Limited and C Limited. You are the auditor of only Dash, A Limited. Now, if this D is disqualified either in Dash or in Dash, automatically he gets disqualification in Dash. If this D disqualified either in B Limited or in C Limited, he will get a disqualification even under A Limited. Unfortunately, you are not the auditor of A Limited. Sorry, you are not the auditor of B Limited and C Limited. Then how do you verify it? You cannot do that. That is the reason why, as an auditor of A Limited, you must have to take a certificate. As an auditor of A Limited, you must have to take a certificate from all the Dash of the company, from all the directors of the company, that they were not attracted with any disqualifications that were mentioned under section 164 subsection 2 of the Companies Act in any other companies in which they are acting as directors. Then you can make a report to the shareholders. This is all about section 143 subsection 3 clause G of the Companies Act. Whether any director is disqualified from being appointed as a director under subsection 2 of section 164. Now this point is very difficult. That is the reason why the CA Institute had given a guidance note on this point. A separate guidance note has been given by the CA Institute both on point number F and point number H. This is the guidance note I am referring to. Guidance note on reporting. This reporting is very difficult. Some of the auditors cannot understand this reporting requirements. So to guide them, the CA Institute had given a separate note for the sake of auditors, and it is called as guidance note on reporting under section 143 subsection 3 clause F and 143 subsection 3 clause H of the Companies Act. Keeping what is mentioned in that guidance note, I will explain you these two provisions. I have already explained you provision relating to clause F by having a reference to SA 570. Reporting under section 143 subsection 3 clause F of the Act, the relevant extras of the section are reproduced below. The observations or comments of the auditors on financial transactions or matters which have any adverse effect on the functioning of the company. Clause F requires the auditor to report, so same has been repeated. An auditor's report may contain matters leading to modification to the auditor's opinion or emphasis of observations or comments, so and so, so and so. The Act does not specify the meaning of the phrase adverse effect on the functioning of the company. The expression should not be interpreted to mean that any event affecting the functioning of the company observed by the auditor should be reported upon, even though it does not affect the financial statements. Such an interpretation would not have been okay. Examples of examples of matters which may have an adverse effect of the functioning of the company. Going concern assumption. Have I explained this point only with reference to going concern assumption? This is the guidance note from where I have explained you the relationship between 143 subsection 3 clause F and SA 570. Okay, take a break. Now the time is 9:30. Come back by 10 to 10. Next class, point number 143 subsection 3 clause H. Any qualification, reservation or adverse remark relating to maintenance of accounts and other matters connected therewith. The point, if you read, will give you a wrong impression. The intention of the act is different, but the meaning that you may derive by going through this point is different. This is the reason why the institute had given a guidance note on this particular point. Any qualification, when I say qualification, at least some of you people would be able to recollect the term qualified opinion, yes or no. Reservation or adverse remark, that means adverse opinion. Simply speaking, 143 subsection 3 clause H is made applicable only when the auditor has given a modified report. In other words, when the auditor issues a clean opinion, then auditor's report shall not contain 143 subsection 3 clause H. So there is a link between type of the audit report and section 143 subsection 3 clause H. If you have given a modified opinion, then only you need to make a comment under 143 subsection 3 clause H. Any qualification, reservation or adverse remark relating to maintenance of accounts and other matters connected therewith. If you go through the original auditor's report, you will never find these things in the auditor's report. Why? Because the reason is that auditor has not given a dash report. For example, in Reliance Industries Limited's auditor's report, you won't find that clause 143 subsection 3 clause H. Why? Why? Because the report given by the auditor in the given case is a dash report, clean report. I said to you in the past like this: if the opinion given by the auditor is a clean opinion, the heading of the opinion paragraph should not be changed. The heading of the opinion paragraph should be opinion. However, if the auditor has given a qualified opinion, the name of opinion paragraph shall be changed to qualified opinion. If the auditor has given an adverse opinion, the name of this paragraph shall be changed to adverse opinion. If the auditor has given a disclaimer of opinion, the name of this heading shall have to be changed to disclaimer of opinion. That means just merely by going through the side heading, the readers of the financial statements should be capable of understanding the type of the report that has been given by the auditor. If the heading is opinion, you may conclude that the auditor has given a clean opinion. If the heading is like qualified opinion, then you can conclude that the opinion given by the auditor is a qualified opinion, and so on. Similarly, for basis for opinion paragraph also, same type of changes are required to be made. If you give a clean opinion, then don't make any change to the heading, that is basis for opinion. If you have given a qualified opinion, then you need to make change to the heading of this paragraph into dash. Basis for qualified opinion, or basis for adverse opinion, or basis for disclaimer of opinion. These points may have been explained to you in the past, right? So any qualification, reservation, or adverse remark relating to maintenance of accounts. I will try to show you the version of the CA Institute with regard to this. Reporting under section 143 subsection 3 clause H of the Act. Clause H requires the auditor to report any qualification, reservation, or adverse remark relating to maintenance of accounts and other matters connected therewith. An auditor's report may contain matters leading to modifications in the auditor's report on the financial statements. The matters that cause such modification may have a consequential effects or possible effects on the books of account maintained by the company. This is the most important paragraph. The words qualification, adverse remark, and reservation used in clause H of section 143 subsection 3 should be considered to be similar to the terms qualified opinion, adverse opinion, and disclaimer of opinion respectively referred to in SA 705, modifications to the opinion in the independent auditor's report. If you are really capable of understanding the paragraph number 16 in the guidance note, that is sufficient. There is no further elaboration is required. So this is about 143 subsection 3 clause H. Now 143 subsection 3 clause I, whether the company has adequate internal financial controls with reference to financial statements in place and the operating effectiveness of such controls. As of now, try to understand that you need to make a comment on company's internal controls, including their operating effectiveness. That's it. In future, we are going to have a discussion on a separate chapter called as risk assessment and internal controls. Then under that chapter, I will try to explain you the terms internal financial controls and internal controls over financial reporting. Those two terms are completely opposite to one another. The second one is not known to you. First one is known to you. That is the reason why I am postponing the discussion on this point to another chapter, that is risk assessment and internal control. As of now, try to understand that it is the responsibility of the auditor to focus on client's internal controls and to make a comment on the operating effectiveness of such controls. Just we can go through the auditor's report also to identify whether that point is included by the auditor in his report or not. Point number E is also known to you. On the basis of written representations received from the directors. Immediately after going through that sentence, you should be able to recollect this example. Yes or no? In this example, what the auditor of A Limited did, auditor has taken a dash certificate. I called it as certificate. Here they are calling it as dash. Written representation. From whom? From the directors. On the basis of written representations received from the directors as on 31st March 2023, taken on record by the board of directors, none of the directors is disqualified. None of the directors is disqualified as on so and so date from being appointed as director in terms of section 164 subsection 2. This reporting has been done by the auditor in accordance with 143 subsection 3 clause G of the Companies Act. This is the point relating to internal controls what we are discussing. Last but one point. What is the last but one point? 143 subsection 3. 143 subsection 3 clause I. 143 subsection 3 clause I. With respect to adequacy of internal financial controls and the operating effectiveness of such controls, refer to our separate report in Annexure A. Our report expresses an unmodified opinion on the adequacy and operating effectiveness of internal controls with reference to financial statements. That's it. Now, go through the original law. The only point that is pending for our discussion is such other matters as may be prescribed. Some matters are prescribed in rule number 11 of Companies Audit and Auditors rules. Now I am not going to have a discussion on those matters. In future, when it is required, I will try to explain those other matters also, because it is very difficult for you people to understand the importance of those points at this stage. If you are getting some more knowledge about different subjects, then you may be able to understand at least part of these 3 points. Of course, the last one is well known to you under point J. What is that? Keeping this in mind only, I have explained you the provisions of section 123 of the Companies Act. Within 5 days, within 30 days, within 7 days, it will be invest in that account for a period of 7 years. After the expiry of 7 years, it is required to be transferred to a separate fund established by central government called as Investor Education and Protection Fund. So the last point is well known to you. Whether there has been any delay in transferring amounts required to be transferred to the Investor Education and Protection Fund by the company. First point, part of the first point is also understandable to you. Okay? Whether the company has disclosed the impact, if any, of pending litigations on its financial position in its financial statements. Have I explained you anything about the term litigations in the past? Have I explained you the responsibilities of the management in respect of litigations pending before court of law? What are the responsibilities of the management in respect of litigations pending before court of law? Litigation pending before court of law is nothing but a dash liability to the entity. Very good. Contingent liability to the entity. When a litigation is pending, what is the duty of the management? Management had to communicate with the entity's lawyer. Here lawyer is an expert. Why the management is expected to communicate with the entity's lawyer? To identify what would be the probable future outcome of that litigation. If the lawyer is of the opinion that there is a high possibility or probability, there is a high possibility or probability of losing the case, entity is required to create a provision. When the possibility of losing the case is said to be remote, in that case, such pending litigation and the details relating to such pending litigation are required to be disclosed as a contingent liability. So these things are well known to you. Okay. So please read it in connection with that point, whether the company has disclosed the impact, if any, of pending litigations on its financial position in its financial statements. And the only point that we haven't discussed and I cannot discuss as of now is point B, that we will discuss later. Okay. So accepting this point B, everything mentioned under section 143 subsection 3 of the Companies Act is said to be completed. Yes or no? Done. Now coming back to our original discussion, we are having a discussion on basic elements of auditor's report. There are 10 basic elements of auditor's report which were mentioned in SA 700. Of course, sometimes few additional points are also required to be included in the auditor's report. Out of 10, now we are able to complete almost 7 points. What are they? Title, addressee, opinion, basis for opinion. Key audit matter paragraph is not yet completed. Management's responsibility for preparation of financial statements. Auditor's responsibility for audit of financial statements. The next one is signature on the auditor's report. Place, date. Everything is completed excepting key audit matters. Yes or no? So, key audit matters is a thing which is very difficult to understand. It is a very difficult standard to understand, particularly for you people, because there was another standard on auditing called as SA 260. That SA 260 is having a close link with the concept called as key audit matters paragraph. Key audit matter paragraph has been discussed in another standard called as SA 701. SA 701. So key audit matters were described in SA 701. If you really want to understand what is a key audit matter, first of all, you must have at least some knowledge about SA 260, or else you must have a knowledge that the basis for key audit matters paragraph or basis for SA 701 is SA 260. So unless you understand at least some portion or some part of SA 260, it is quite difficult for you to understand the concept of key audit matters. Okay. So first of all, I will try to explain you those things. Then we can go through the Reliance Auditor's report to identify what are all the key audit matters that were reported by the auditor in his report. Then I can explain you what is a key audit matter along with the discussion on SA 701. During the course of performance of audit, auditor may come across several important aspects. For example, auditor may come to know about several important aspects during the course of performance of audit. For example, during the course of performance of audit, auditor would have identified material deficiencies in internal controls. Auditor identified material weaknesses or deficiencies in client's internal controls. When the auditor identifies material deficiencies or weaknesses in the client's internal controls, it is said that it is the responsibility of the auditor to communicate such material deficiencies or weaknesses identified by the auditor either to those charged with governance or with management. Why? Because those material deficiencies or weaknesses are very much important, or in viewpoint of the auditor, such material deficiencies or weaknesses observed by the auditor in the client's internal controls are very much important either to those charged with governance or to management. In that case, it is the responsibility of the auditor to communicate the details of such material deficiencies or weaknesses to those charged with governance or to management, and the way in which it is required to be communicated has been explained in Essay 260. Now, what is Essay 260? During the course of performance of audit, sometimes the auditor may come across some important aspects, and in viewpoint of the auditor, such aspects are very much important or relevant, very much important or relevant for those charged with governance or management. If the auditor is of the opinion that those matters are important or relevant to those charged with governance or management, auditor must communicate such matters to dash those charged with governance. Assume that auditor had communicated 20 matters. Auditor had communicated 20 matters to dash to those charged with governance, because auditor finds that such matters are very much dash or dash to dash. Such matters are very much important or relevant to those charged with governance. Hence, it is the responsibility of the auditor to communicate such matters to those charged with governance. Auditor communicated 20 matters. This communication has to be done by the auditor in accordance with the requirements of Essay 260. Now, when the auditor is constantly communicating with those charged with governance, generally users of the financial statements may come to a wrong conclusion that auditor is constantly communicating with those charged with governance but not with us. After all, we appointed the auditors, but auditors are not communicating anything to us. Most of the times auditors are communicating different things only to those charged with governance. If users of the financial statements are of this type of opinion, they feel that auditor is not maintaining transparency. Auditor is not maintaining transparency. He is behaving in one way with management and in another way with shareholders. So auditor lacks transparency. Maybe the conclusion that the shareholders or other users of financial statements would reach if the auditor fail to communicate some important aspects to them. Therefore, out of these 20 matters, I consider 8 matters as important, not only to dash, but also to dash. Not only to those charged with governance, but also to the stakeholders. In that case, it is my responsibility. As an auditor to communicate these 8 matters to the stakeholders through my report. So in the auditor's report, auditor shall have to keep a heading called as dash matters, key audit matters. Under the heading key audit matters, all these 8 points are required to be included by the auditor. So these 8 matters will find their place under the heading key audit matter paragraph in the auditor's report. So if key audit matters are there in the auditor's report, it implies that these matters are being communicated by dash to dash, auditor to stakeholders. In that case, there will be a satisfaction to the stakeholders. Our auditors are not only conveying or communicating with those charged with governance. If required, they are also communicating with us. If required, they are also providing details of some matters which are treated as very much important or relevant in their view to the stakeholders. Therefore, stakeholders feel that the auditor is maintaining transparency. That is the reason why it is necessary for you to communicate some of the matters that you have already communicated to those charged with governance, even with stakeholders, if you treat that those matters are important or relevant for stakeholders. If you are really interested in understanding difference between Essay 260 and Essay 701, key audit matters are required to be included by the auditor as per Essay 700. To understand more about key audit matters, CA Institute had issued another standard called as Essay 701. So Essay 701 deals with dash and that key audit matter paragraph should be a part of dash, should be a part of SA 700. So out of 20 matters that were communicated by the auditor to those charged with governance as per SA 260, auditor decides to communicate 8 matters even with the stakeholders, because the auditor is of the opinion that these 8 matters are very much relevant even to the stakeholders. In that case, the auditor shall have to communicate the same under his report by putting a separate paragraph called as key audit matter paragraph. Okay, right. Remember, this SS 701 or inclusion of key audit matter paragraph is not made applicable, for all audits. For all audits. Only when you were appointed as the auditor of a listed company, only when you were appointed as the auditor of a listed company, you must have to include dash paragraph in your report. Public interest in listed companies is more. So to protect the public interest, some key audit matters are to be communicated by the auditor to the stakeholders. Therefore, inclusion of dash is made mandatory only in respect of dash and not in respect of others. Inclusion of key audit matter paragraph in the auditor's report is made mandatory only in respect of listed entities, and it is not mandatory in respect of other than listed entities. Okay, this is a brief introduction relating to key audit matters. So I want to ask you one question. The question is, from where key audit matters are derived by the auditor? Should I write the question? From where the auditor derives key audit matters. From where the auditor derives key audit matters? From the matters that were communicated, by the auditor to those charged with governance. Some of the matters communicated by the auditor to those charged with governance may also be required to be communicated by him even to the users of the financial statements, particularly where the auditor is of the opinion that such matters are not only important for those charged with governance but are also important for shareholders or other stakeholders. Then only you need to include these points in your report under the heading key audit matter paragraph. Now, I will try to read what is given in Reliance Industries Limited's report. Of course, it is not possible for you to understand everything because only few points are understandable to you now. After say 1.5 months to 2 months after completion of our syllabus, if you are able, including accounts, if you are able to go through the auditor's report, you would be able to understand each and every word of it, including the financial statements. Now, I will try to show you the original key audit matters section in the auditor's report. For every key audit matter, that the auditor wants to communicate, a separate side heading must be given by the auditor, so that by going through the side heading, readers would be able to understand the importance of the matter and they may decide to go through the matter. So, in the given example, auditor probably communicated 4 to 5 points as key audit matters to the shareholders. The first one is about estimates of oil and gas reserves, because this is the audit report of Reliance Industries Limited, which is an oil company. Litigation matters. The company has certain significant ongoing legal proceedings for various complex matters with the government of India and other parties continuing from earlier years, which are as under: matters in relation to oil and gas, matters relating to trading in shares of Reliance Petroleum Limited, and so on. Okay. The next one, that is point number 2. The third point is fair valuation of investment. What is that? Fair valuation of investments. Like this, the matters which the auditor wants to communicate to the shareholders as dash matters, as key audit matters, have been divided into different side headings by the auditor. Information technology systems and controls over financial reporting. Probably this is the end of the key audit matter section of the auditor's report. So 4 points have been communicated by dash to dash under the heading dash. 4 matters have been communicated by the auditor to the users of the financial statements under the heading key audit matters. These 4 matters would have been derived by the auditor from matters that were communicated by the auditor to dash to those charged with governance. This is the importance of the term key audit matters. Now, let us go through your material first. Then I can focus on CRD questions first. Later on, we can focus on other points. Read it. Question number 7. Explain in detail the contents of auditor's report or the elements of auditor's report. There may be some other point like emphasis of matter paragraph, which has not yet been explained to you. It may find its place here. When that matter comes for a discussion, I will try to explain you what is emphasis of matter paragraph. Okay, read it. This question is completed. Question number 6. List out the contents or elements of auditor's report. Question number 5 is also completed. Different types of auditor's opinion. Question number 4 not yet discussed. Question number 3 is also. Question number 3. What factor should the auditor consider? No. Question number 2 is completed. Yes or no? So question number 2 is completed. 2, 5, 6, and now 7. Title, addressee, auditor's opinion, basis for opinion, going concern. This you can understand only after essay 570, but I have provided you with some knowledge relating to going concern. With that knowledge, try to read it and understand it. Where applicable, the auditor shall report in accordance with essay 570. Based on audit evidence obtained, the auditor shall conclude whether in the auditor's judgment a material uncertainty exists related to events or conditions that may cast significant doubt on the entity's ability to continue as a going concern. In essay 570, reporting by the auditor has been divided into 2 broad categories. Once you are able to understand reporting responsibilities of the auditor under essay 570, these 2 points are easily understandable to you. So till then, don't try to read that. Next. Key audit matters. For audits of general purpose financial statements of dash entities, listed entities, or otherwise required by law or regulation, or decides to communicate key audit matters, the auditor shall do so in accordance with dash essay 701. Next, responsibilities for the financial statements completed. Auditor's responsibility for audit of financial statements is also completed. Location of the description of auditor, this point is irrelevant. Don't try to read that. Other reporting responsibilities of the auditor under the heading dash, report on other legal and regulatory requirements. Under this heading, if required, the auditor has to report under 143 subsection 1 when the auditor has not satisfied with any one of those 6 matters that were mentioned under section 143 subsection 1, 143 subsection 3, 143 subsection 11. These three aspects finds their place under the heading report on other legal and regulatory requirements. That's sufficient for you. Okay. If the auditor's report contains a separate section that addresses other reporting responsibilities, the requirement stated above shall be included under a section with the heading report on audit of financial statements. Report on other legal and regulatory requirements shall follow. This point is irrelevant for you. Only try to understand point number B under the heading 10 other reporting responsibilities. Signature of the auditor. Auditor's report shall be signed. This was already read and explained. Place of signature already explained. Date of auditor's report already explained. Unique document identification number is known to you. Now, concept questions. Messrs. Smart and Associates are the statutory auditors of H Limited for the year 21-22. How will the auditor address the audit report issued on the financial statements for the year 21-22? Also give a title to the report. Title is Independent Auditor's Report. To whom the auditor should address the report? You are the statutory auditors of a company. In respect of a company, report is required to be addressed to dash shareholders. That's it. Next. R International is a partnership firm. R International is a recording lo unna lete cheppevandi mee sangate is a partner anduke batipayaru meeru. Richa International is a partnership firm dealing in export of blankets. The partners the partners of the firm, I cannot make further comments. Okay, the partners of the firm are Richa and Ashish. Explain how the statutory auditors of the firm will address the audit report. This is a company, this is a partnership firm. Usually, the audit report of a partnership firm will be addressed either to the managing partner or to all the partners. Amitabh and Associates are the statutory auditors of R Limited, which is a company engaged in the business of manufacture of so and so. The auditor has started drafting the audit report for the year so and so. CA Amitabh, the engagement partner, is of the view that financial statements of R Limited represents a true and fair view. Give the draft of the opinion paragraph of the audit report. We report that your financial statements or state of affairs are reflecting a true and fair view, are presented fairly in all material respects. Next. Messrs. KR and Associates are the statutory auditors of PDL, Prime Deluxe Limited, a partnership firm of chartered accountants have been appointed as the auditors of a company for the year so and so. At the time of finalizing the audit report, one of the engagement team members, Mr. R, asked the engagement partner CAK as to what all should be included in the basis. These are all nothing but questions framed on answers. Okay, so by just going through the question, you would be able to understand the answer. Basis of opinion paragraph. So everything what is given under the heading basis of opinion paragraph is required to be reproduced here. Next, DS Limited is a company engaged in the manufacture of detergent. B and A, Bright and Associates are the statutory auditors of the company. Explain how the paragraph related to management responsibility will come in the auditor's report. Draft auditor's responsibility paragraph. Maya Memani has conducted after drafting para comprising unmodified opinion, yes feels no need to provide basis for opinion. Should the auditor's opinion should contain basis for opinion or not? Whether you issue a clean opinion or a qualified opinion or adverse opinion or a disclaimer of opinion, auditor's report should always include dash basis for opinion. That's it. This is about question number 7. So we are having a discussion on SA 700. Few points were left from discussion under SA 700. Unfortunately, I started having a discussion even on SA 705 as a part of SA 700. So first of all, let us go through the questions that were given under the heading SA 705. After completion of that, we can focus on the remaining questions under SA 700. SA 705, modifications to the opinion. Modifications to the opinion. When you read the term modifications to the opinion, you should be able to recollect that auditor's reports or auditor's opinion can be classified broadly into two categories. The first one is unmodified opinion. The other one is modified opinion. So when the auditor has decided to issue a modified report, you are the auditor of an entity, you have decided to issue a modified report. When the auditor already decided to issue a modified opinion, then first of all, it is necessary for the auditor to identify the type of modified opinion to be given by the auditor. Modified reports are of three types, as said earlier. The first one is qualified opinion. The second one is adverse opinion, and the third one is disclaimer of opinion. These three are technically called as modified reports. I repeat, as an auditor, first of all, you need to take a decision about whether to issue an unmodified opinion or to issue a modified opinion. When the auditor decides to issue a modified opinion, then it is necessary for the auditor to take some other decision, like what type of modification should the auditor make in his report. Modified reports are of three types: qualified, adverse, and disclaimer of opinion. This standard on auditing, that is SA 705, is made particularly applicable when the auditor had already decided to issue a dash report, a modified report. That is the reason why the name of the standard is like this: modifications to the opinion. Modification to the opinion in the independent auditor's report. This standard on auditing deals with auditor's responsibility to issue an appropriate report. I said to you earlier about the importance of issuing an appropriate report. Yes or no? I want to ask you only one question. What may happen if the auditor fails to give an appropriate opinion? Anybody? There will be an increased risk to the auditor, which is to be technically called as audit risk, where audit risk can be defined as the risk arising to the auditor in a situation when the auditor expresses an inappropriate audit opinion where the financial statements are materially misstated. I repeat, where the financial statements are materially misstated, the auditor is expected to issue a modified opinion. Yes or no? When financial statements are materially misstated, when financial statements are materially misstated, then the appropriate report to be given by the auditor must be a modified opinion. Must be a modified opinion. So issuing a modified opinion is said to be appropriate when financial statements are materially misstated. However, instead of issuing a modified opinion, assume that the auditor had given an unmodified opinion. As said earlier, when issuing a modified opinion is said to be appropriate, but the auditor had given an unmodified opinion, it is said that the opinion given by the auditor is dash, wrong, or is inappropriate. When the opinion given by the auditor becomes wrong or inappropriate, and when somebody makes use of such wrong or inappropriate auditor's opinion and makes some decisions, those decisions taken by them will also prove to be wrong. In that case, they may go to court of law against the auditor stating that our auditor is very much negligent in performing his duties. Hence, the auditor has given a wrong report. We made use of such wrong report to take some decisions. Unfortunately, our decisions also becomes wrong, and hence we suffered with some loss. Therefore, it is the responsibility of the auditor to indemnify such loss. That is the way in which user of the financial statements may go to court of law against the auditor. If the court also was of the opinion that the report given by the auditor is wrong or inappropriate, the court may order the auditor to pay some penalty. In that case, that payment of penalty is nothing but a risk to the auditor. Why risk arises to the auditor? Because the auditor has given an inappropriate audit opinion. Another important aspect that you must understand is when the financial statements are materially misstated, then only the auditor should issue a modified opinion. If you really want to understand these two words, when the financial statements are materially misstated, you should be able to recollect the scenarios or situations in which the auditor is required to issue an unmodified opinion and the auditor is required to issue a qualified opinion, an adverse opinion, and disclaimer of opinion. Where the auditor is satisfied or where the auditor concludes that the financial statements are free from material misstatements, then the auditor had to issue an unmodified opinion. When the auditor is able to obtain sufficient appropriate audit evidence and when the auditor concludes that financial statements contains material misstatements and if they are material but not pervasive, when the auditor is unable to obtain sufficient appropriate audit evidence and when the auditor concludes that the possible effect of undetected misstatements on the financial statements would be both material as well as would be material but not pervasive. The auditor concludes that the undetected misstatements, there may be some undetected misstatements in the financial statements. There may be some undetected misstatements in the financial statements which are material but not pervasive. In that case also auditor had to issue a qualified opinion. When should the auditor issue an adverse opinion? When the auditor is able to obtain sufficient appropriate audit evidence and when the auditor concludes that financial statements contains material misstatements and they are pervasive in nature. Under the heading disclaimer of opinion, when the auditor is unable to obtain sufficient appropriate audit evidence, but the auditor concludes that the possible effects of undetected misstatements in the financial statements could be material and pervasive. Have you observed that the term material is appearing in all the last three types of opinion? Qualified opinion, material misstatements, material. So when financial statements contains material misstatements, then the material misstatements, then the appropriate report to be given by the auditor is a modified opinion. Are you able to understand this point at least now? What are the scenarios in which the auditor is required to issue a modified opinion and unmodified opinion are well known to you? This is nothing but the definition of audit risk. So audit risk can be defined as the risk arising to the auditor in a situation where the auditor expresses an inappropriate audit opinion when the financial statements are materially misstated. This is what we discussed about the concept of audit risk earlier. So, when the report given by the auditor is inappropriate, there would be a higher risk to the auditor, which is termed as audit risk. If you were the auditor, would you like to take higher audit risk or would you try to reduce your audit risk? If you really want to reduce your audit risk, you must have to issue an appropriate report. In order to issue an appropriate report, first of all, you should have knowledge about what is audit report, what are the types of audit reports, what are the scenarios or situations in which different types of reports are required to be issued, etc. Keeping that in mind, the Institute of Chartered Accountants of India had issued a series called as Series 700, wherein there are several standards, out of which we are having a discussion on the second standard. The first standard that we discussed under Series 700 is SA 700. This is SA 705. Read it. This standard deals with auditor's responsibility to issue an appropriate report in circumstances when the auditor concludes that modification to the auditor's opinion on the financial statements is necessary. When I complete reading this sentence, at least some of you people should look into this point. If you are able to look into this point after reading of this sentence, it is said that you are able to understand this discussion. What I said to you at the start of SS 705, initially, auditor, the first decision to be taken by you as an auditor is to decide about whether to issue dash or to issue dash. Whether to issue an unmodified opinion or to issue a modified opinion. If the auditor already decides or if the auditor already concludes that modification or modified opinion is necessarily required to be issued, then the auditor is required to follow the requirements of dash. Then the auditor is required to follow the requirements of dash. SA 705. Now read it. First point or first paragraph under SA 705. This standard deals with auditor's responsibility to issue an appropriate report, particularly when the auditor concludes that modification is necessary. That means the auditor already decided to issue a dash report, modified report. In that case, the auditor should first of all try to decide about the type of modification. For that purpose, auditor should have knowledge of SS 705. That is the reason why we are going to learn SS 705. Unless you understand the objective behind learning a particular standard, it's of no use to try learning a standard. Therefore, try to understand the standard. I am repeatedly alarming you that when you are listening to the subject for the first time, you should be very, very careful. You should try to understand each and every word in detail. If you fail to understand each and every word in detail, you are going to face difficulties in future, particularly when you start preparing for the subject. So I repeatedly asking you to be focused while having a discussion on the subject. It should be this subject is very difficult, and it is very difficult for you to recollect the subject at a later point of time unless you understand each and every word of it. That is the reason why I am giving importance to each and every word. That is the reason why I am trying to read each and every word to the extent possible. This standard also deals with how the form and content of auditor's report is affected when the auditor expresses a modified opinion. I know very well that this sentence has already been explained to you, and you will also come to know that this sentence is known to you very, very soon. Okay? Right. Question number 10. What are the circumstances when modification to the auditor's opinion is required? What are the situations in which auditor is required to issue a modified opinion? That is the question. The auditor shall modify the opinion in the following. The wording is very good. The auditor shall modify the opinion in the auditor's report. Auditor's report contain dash. Auditor's opinion. Auditor shall modify his opinion. The auditor should modify the opinion in the auditor's report in the following circumstances. When the auditor concludes that based on audit evidence obtained, that means auditor is able to obtain sufficient appropriate audit evidence. When the auditor shall modify the opinion when the auditor concludes that based on the audit evidence obtained, the financial statements as a whole are not free. When you conclude that financial statements are free from material misstatements, you need to give an unmodified opinion. When you conclude that financial statements are not free, when you conclude that financial statements are free from material misstatements, you need to issue an unmodified opinion. When financial statements contains material misstatements, that means when financial statements are not free from material misstatements, the only report that the auditor can issue is a modified report. It may be either a dash or a dash or a dash, either a qualified opinion or an adverse opinion or a disclaimer of opinion. Read it again. The auditor shall modify the opinion in the auditor's report in the following circumstances: when the auditor is able to obtain sufficient appropriate audit evidence, and when the auditor concludes that financial statements as a whole are not free from material misstatements, or the auditor is unable to obtain sufficient appropriate audit evidence, and to conclude that financial statements as a whole are free from material misstatements. In these two scenarios, or circumstances or situations, the auditor is required to issue a dash report, modified report or modified opinion. Followed or not? So question number 10 is already completed. I know it very well, but I got a doubt whether I have explained question number 10 to you or not in the previous session. That is the reason why I started explaining question number 10 again. Now it is completed. Question number 11 is well known to you. Explain in detail different types of modified opinions. There are three types of modified opinions, namely a qualified opinion, an adverse opinion, and a disclaimer of opinion. Qualified opinion: the auditor shall express a qualified opinion when the auditor, having obtained sufficient appropriate audit evidence, concludes that misstatements are material but not pervasive to the financial statements, or the auditor is unable to obtain sufficient appropriate audit evidence on which to base the opinion, but the auditor concludes that the possible effects on the financial statements of undetected misstatements, if any, could be material but not pervasive. Adverse opinion: the auditor shall express an adverse opinion when the auditor, having obtained sufficient appropriate audit evidence, concludes that misstatements individually or in aggregate are both material and pervasive to the financial statement. Disclaimer of opinion: the auditor shall disclaim an opinion when the auditor is unable to obtain sufficient appropriate audit evidence on which to base the opinion, and the auditor concludes that the possible effects on the financial statements of undetected misstatements, if any, could be both material and pervasive. The auditor shall disclaim an opinion when, in extremely rare circumstances involving multiple uncertainties, the auditor concludes that irrespective of having obtained sufficient appropriate audit evidence regarding each of the individual uncertainties, it is not possible to form an opinion. The only point that you must focus on is it is not possible to form an opinion. When the auditor concludes that it is not at all possible for him to form an opinion, then the auditor had to give a disclaimer of opinion. I have given you some situations wherein the auditor is required to issue a disclaimer of opinion. Both are known to you. I will try to repeat it. Okay? When you have been appointed as an auditor of an entity, and when you go for an audit for the purpose of conducting audit, management has not provided you with the draft set of financial statements. Then the auditor made an inquiry with the management about why they have not provided draft set of financial statements to the auditor. Management has given a reply saying that, sorry sir, all the books and other related records of the entity have been destroyed by fire. When the management has given this reply, immediately the auditor asked management like this: when you are saying that books and other related records of the entity have been destroyed by fire, how it is possible for you to prepare these financial statements? Management has given a reply to the auditor like this. Just like that. Just like that, I prepared the financial statements, was the reply given by the management to the auditor. If you were the auditor, can you now say that financial statements are reflecting a true and fair view? We don't know. Can you now say that financial statements are not reflecting a true and fair view? We don't know, because the supporting books and other related records are not available. Without availability of books and other related records, is it really possible for the auditor to form an opinion? No, that is situation number one. Situation number two, the same thing, but the reason is different. Management is unable to provide books and other related records to the auditor on the ground that all the books and other related records of the entity have been seized by the income tax department, and even photocopies of the books of account are not available with the client. Income tax department raided on the premises of your client, seized all the books and other related records of the client. Even photocopies of the books are not provided to the client. You have been appointed as an auditor. Management prepared financial statements, draft set of financial statements. Now you are asking the management to provide books and other related records. Management has given a reply saying that, sorry sir, books are not available because books are seized by income tax department. Even photocopies of the books are not available. Then how do you prepare these financial statements? Just like that. More importantly, books are available. Books are available. But unfortunately, management started imposing several limitations. Management started imposing several limitations or restrictions either on the rights of the auditor or on the duties of the auditor. In that case, all the books are available. Since the auditor is not permitted to go through such books of account, since management has not provided such books of account to the auditor, it is not at all possible for the auditor to form an opinion. When you are unable to form an opinion, the only option available for the auditor is to issue a dash opinion. Disclaim. Disclaim means ante. You are not you are unable to form an opinion at all. That is the reason why you are saying that I am sorry, we are unable to form an opinion. That is called as disclaiming an opinion. Good. This is all about question number 11. So by this we completed question number 10. Essay 710. Comparative information. The heading itself is somewhat confusing in nature. So try to focus first on the heading. Okay. What is Essay 710? Comparative information. Before having some more discussion on comparative information, first of all, I will try to explain you the thing that is being followed in India generally. When you go through the financial statements prepared by a company, when you go through the financial statements prepared by a company, you know very well that the company is required to prepare financial statements by following the requirements of Part-1 and Part-2 of either Division 1 or Division 2 or Division 3 of Schedule 3 to the Companies Act, and hence they need to prepare their financial statements in vertical form. Right? Particulars, current year, previous year. Particulars, current year, previous year. That means along with current year figures, the company is under obligation to disclose previous year's figures also. Along with current year figures, the company is required to provide previous year's figures. Such previous year's figures are nothing but called as, in India they are called as corresponding figures. What is that? Corresponding period figures. For example, if salaries for the current year or say 4,80,000, the corresponding amount of salaries paid in the previous year is say 2,40,000. So 480 is current year figure, 240 is previous year figure. Remember, you are the auditor for the current year. Current year financial statements includes dash previous year's figures. Such previous year's figures which were included as an integral part, of current period financial statements. They are technically called as dash figures, corresponding figures. I repeat, you are the auditor for the current year. Current year is 2022-23. When you go through the financial statements of the current year, you will, particularly in case of companies, you will certainly observe that current year financial statements not only includes amounts and other disclosures. Current year financial statements not only includes amounts and other disclosures of the current year, but they also include amounts and other disclosures of the previous year. Why previous year figures are being provided as an integral part? Why previous year figures are being provided as an integral part of the current period financial statements? An integral part of current period financial statements for the sake of comparison. So if this model or approach is followed, it is said that the company followed dash approach. Why corresponding figures are provided? For the sake of comparison. So corresponding figures are provided for the sake as information. Figures are provided as information for the sake of dash. Corresponding figures are provided as information for the sake of dash. For the sake of comparison. Therefore, it is technically called, the heading of the standard is technically called as dash. So, what is the heading of SA 710? What is the heading of SA 710? Some information will be provided in the financial statements for the sake of comparison, and hence it is called as comparative information. That comparative information may be provided in the financial statements in two ways. The first way is dash approach. The first way is corresponding figures approach. Generally in our India, we do follow dash approach, corresponding figures approach. And there is one more approach that an organization may follow to provide dash for the sake of comparison. To provide information for the sake of comparison, an organization may follow any one of the following two approaches. The first approach is dash approach, corresponding figures approach. The second one is comparative generally students gets confused between this and this. What is the first heading? Comparative information. What is the last one? Comparative financial statements. They both look like one and the same, but they are not one. They are different. Comparative financial statements is an approach. Comparative financial statements is an approach that can be followed by an entity for the sake of providing dash information to the readers of the financial statements. For the sake of providing comparative information to the readers of the financial statements. So, now you know very well about what is comparative information, why it is provided, and how it is provided. Yes or no? For the sake of comparison, readers will generally try to compare figures of different periods. So, to provide ready-made information to the readers, for example, if you were the reader of financial statements, assume that only current year figures are given. You want to compare current year figures with the previous year's figures. In that case, what should you do? You need to take the previous year's balance sheet, then you need to put the previous year's balance sheet and current year balance sheet side by side, and then you need to compare the current year figures with the previous year's figures. It is time consuming, and in most of the cases, the readers of the financial statements may not have readily available with the previous year's financial statements. That is the reason why, for the sake of comparison, and to provide relevant information to the readers, every company is under obligation, not the sole proprietary concerns or partnership firms. Company is under obligation to prepare their financial statements by including dash information, comparative information. That comparative information will be provided by the company either in the form of dash or in the form of dash. Either by following an approach called as corresponding figures approach, or by following an approach called as comparative financial statements. I want to ask you one question, or at least I will tell you something. Please try to understand it without any further explanation. You were the auditor for the year dash 22-23. So in that example, 22-23 is said to be current year. Along with current year figures, the organization provided amounts and other disclosures relating to the previous year also as a dash part of current period financial statements. As a dash part of current period financial statements. So dash are made an integral part of dash. Previous year figures are made, unless you understand the term integral part, you cannot distinguish between corresponding figures and comparative financial statements. You cannot distinguish between approach number 1 and approach number 2. That is the reason why I am repeatedly saying the term integral part. Integral part. So when previous year figures are made an integral part of the current period figures, then it is said that the organization followed approach number 1. What is that approach? Corresponding figures approach. Read it. Now try to go through this. Now my point is, when you were the auditor for the year 22-23, when figures relating to 21-22 are given, they are nothing but closing balances of dash. They are nothing but closing balances of 21-22 and opening balances of 22-23. That is the reason why I said to you that there is a link between SA 510 and SA 710, and there is a link between SA 560 and SA 710. This is easy to understand. This is difficult to understand. That is the reason why I explained you 560 first. Now you are able to understand both point number 1 and point number 2, relationship between SA 510 and 710 with some ease, and relationship between SA 560 and 710 with some difficulty. But still you are able to understand it. Okay. This is the heading of dash. SA 710. What is the heading? Comparative information. Corresponding figures. Approach number 1, corresponding figures. And approach number 2, comparative financial statements. Now let's focus on corresponding figures approach. Before doing so, read what is given in question number 25. Define comparative information and what are the objectives behind providing comparative information in the financial statements. What I am going to explain you will be the first and final one that you are hearing about SS 710. Nobody in your lifetime will explain you like this by showing you original essay 710 along with appendix. There will be some illustrations given in essay 710. I will certainly show you at least 2 of such illustrations. 5 illustrations are given. I will go through 2 illustrations which will help you a lot in having a very good understanding of what is comparative information. Without going through such illustrations, it is next to impossible for the student to understand essay 710. The material that has been given to you will not be sufficient to understand essay 710 in detail. A student can understand essay 710 only when the student is having some knowledge about appendix, illustrations given in essay 710 by ICAI. Okay, done. What is the meaning of comparative information? The amounts and disclosures. Have I used the term amounts and other disclosures in my discussion? That is appearing on your screen. Amount and other disclosures. Is it visible to you? Should I make changes to the color? Amount and other disclosures. Now read this. The amounts and disclosures included in the financial statements. In the financial statements means the financial statements of dash current year, and such amounts and disclosures are included in respect of generally one. In some cases, for example, if you want to issue a prospectus, last 5 years data may be required to be provided. That is different. Generally 1 year comparative information will be provided. In some extreme cases, more than 1 year's comparative information may also be provided. In respect of one or more prior periods, in accordance with applicable financial reporting framework. For some entities, they need to follow dash corresponding figures. For some entities, they need to follow dash comparative financial information. As per their applicable reporting framework, they need to follow either dash or dash, either approach 1 or approach 2 to provide dash to users, to provide comparative information to the users of the financial statements. There are 2 different broad approaches. That is the reason why I call them as approach 1 and approach 2. What is approach 1? Corresponding figures approach. What is approach 2? Comparative financial statements approach. Followed? Done. Now, what is the objective of essay 710? The approach to be adopted is often specified by law or regulation, but may also be specified in the terms of engagement. Terms of engagement is well known to you. We had some discussion on essay 210, which deals with Audit engagement letter. So the terms of engagement is not new to you, fortunately. So what approach should the entity follow may sometimes be specified by dash law, sometimes be specified by dash regulation, and sometimes be specified as per the terms of engagement. Objectives of essay 710 are: auditor should obtain every time the term sufficient appropriate audit evidence is used. That is the reason why, although material for essay 500 is not given to you till date, I explained you elaboratively about essay 500. Almost 40 to 50% of the standard has been explained to you. What is audit evidence? I have given you two definitions of audit evidence, old definition and new definition. Then I explained you that audit evidence can be classified either on the basis of source or on the basis of nature. On the basis of source, audit evidence can be classified into internal evidence and external evidence. On the basis of source, audit evidence can be classified broadly into three. One is written, two is oral, three is visual. Then I explained you about what is internal evidence, the definition of internal evidence, along with some examples. That please refer to your running notes if you are maintaining a running notes. And what is external evidence? What are the examples of external evidence? Then I also explained you about the reliability standards of audit evidence, which evidence is more reliable and which evidence is less reliable. Under that heading, I explained you about 5 things. External evidence is more reliable than internal evidence. Internal evidence is also reliable when the related internal controls are effective or satisfactory. Written evidence is more reliable than oral evidence. Evidence received by the auditor directly from a third party without the intervention of the client is said to be more reliable. And evidence available in original form is more reliable than evidence available in photocopy or facsimile form. Then I explained you about the concept of sufficient, appropriate audit. Don't try to gather audit evidence. Try to gather sufficient quantity of appropriate or relevant audit evidence. Then only the auditor can come to correct conclusions. Then only the auditor can provide a correct opinion. Then only the auditor can reduce his audit risk. So you know very well about what is sufficiency, what is appropriateness. Sufficiency refers to quantum or quantity of audit evidence to be gathered by the auditor, whereas appropriateness refers to the quality of audit evidence, otherwise called as relevance and reliability. When evidence is relevant and reliable, it is said to be qualitative. It is said to be qualitative, and hence sufficiency refers to quantity, appropriateness refers to quality. Appropriateness includes relevance and reliability. These are all explained to you for the simple reason that everywhere, in every standard, you will come across the term auditor should obtain sufficient, appropriate audit evidence. Without having an understanding of what is audit evidence, why should the auditor gather audit evidence? What are the sources from which the auditor can gather audit evidence? On which evidence the auditor can rely more and on which evidence the auditor can rely less? And what is meant by sufficiency and appropriateness? It is quite impossible for me to communicate what is there in our material. That is the reason why, although it was not given to you, I have given some elaborative explanation on Essay 500, which will be very much helpful to you to have a better understanding of this type of sentences. So why should the auditor follow Essay 710? Why should the auditor follow Essay 710? In order to obtain sufficient, appropriate audit evidence. In order to obtain sufficient, appropriate audit evidence. About what? About whether comparative information, including the financial statements, has been presented in accordance with the requirements for comparative information in the applicable financial reporting framework, and to report in accordance with the auditor's reporting. You need to check whether the same is properly presented or not. You need to check whether comparative information is properly presented and properly disclosed, either as per dash or as per dash. Either as per approach 1 or as per approach 2. What is approach 1? Corresponding figures framework. What is approach 2? Comparative financial statements framework. These two are collectively known as dash. Comparative information. Followed or not? This is the end of the discussion on question number 25. Define comparative information and objectives. Now I don't want to go through your material. I will try to show you the original standard. We'll try to explain it elaboratively, then I'll come back to our material and we'll try to identify whether it is properly given or not. Somewhere in our material, some important point was missed in the previous material. Whether that was set right or not in the current period is not known to you, known to me. That is the reason why I am preferring dash over dash. I am preferring original standard over this material. Okay. Take a break. Now it is 9:25. Come back by 9:45. This standard on, this was already explained to you. Just I am trying to read this. This standard on auditing deals with the responsibilities of the auditor. This standard on auditing deals with the responsibilities of the auditor regarding dash. Regarding what is your duty as an auditor in respect of comparative information while you are conducting dash audit of financial statement. So whenever you are conducting an audit of financial statement, sometimes you may go through, while going through the financial statements, you may have identified that such financial statements contains dash. Such financial statements contains dash comparative information. When the financial statements of the entity under your audit contains comparative information, it is your responsibility as an auditor to check whether such comparative information is properly presented. Very good, very good. Is properly presented. What is meant by properly presented? Some entities may have to follow dash, approach 1, or some other entities may have to follow dash, approach 2 for proper presentation of dash comparative information. You need to verify whether such approaches are followed and this information is properly presented. That is our responsibility. To discharge our responsibilities, first of all, you should know what is comparative information, what is corresponding figures, what is comparative financial statements, and hence the CA Institute had issued a standard called as SA 710 comparative information. Read it. This standard on auditing deals with auditor's responsibilities regarding comparative information in an audit of financial statements. When this point is irrelevant as of now, but I am fortunate that at least some of you people would be able to understand this without any further explanation if you listen to this point carefully. When the financial statements of the prior period, when the financial statements of the prior period have been audited by a predecessor auditor or were not, when the financial statements of the prior period, when the financial statements of the prior period, 1, have been audited by a predecessor auditor, 2, have not been audited, were not audited. These two scenarios are called as, very good. In those two cases, audit carried out by you shall be technically called as initial audit engagement, which was dealt with by which standard? SF. That is the reason why I said to you that there is a link between SS 710 and SA 510. When the financial statements of the prior period have been audited by a predecessor auditor or were not audited, the requirements and guidance in SA 510 regarding opening balances also apply. That means, apart from the requirements of SA 710, auditor must also follow dash. SA 510. Particularly when you are conducting dash. Particularly when you are conducting an initial audit engagement. Read it again. This standard on auditing deals with the auditor's responsibility regarding comparative information in an audit of financial statements when the financial statements of the prior period have been audited by a predecessor auditor or were not audited. The requirements and guidance in SA 510 regarding opening balances also apply. The nature of comparative information. Nature of comparative information to be presented is dependent upon the requirements of financial reporting framework. That means whether to follow dash or to follow dash. How to present comparative information. How to present comparative information is dependent upon approach. There are two approaches. The first one is corresponding figures approach, and the second one is comparative financial statements approach. The nature of comparative information that is presented in an entity's financial statements depends on the requirements of applicable financial reporting framework. There are two different broad approaches to the auditor's report. There are లేదా వస్తుందా నాకు రావట్లేదు సరే మాస్టర్ మైండ్స్ వాళ్ళు చెమట్లో పట్టిస్తున్నారు మాస్టర్ మైండ్స్ వాళ్ళు చెమట్లో పట్టిస్తున్నారు మాకు మళ్ళీ లేదండి బాబు ఊరికాడు సో ఆన్లో లేదు అది the nature of comparative financial statements. The approach to be adopted is often specified by law or regulation, may also be specified in the terms of engagement. This is what is given in question number dash in your material. Question number 25. Okay, done. The essential audit reporting differences between approaches are, this I cannot read and explain as of now. Objectives, this is also known to you. The objectives of the auditor are to obtain sufficient appropriate audit evidence about whether the comparative information included in the financial statements has been presented in all material respects in accordance with the requirements of comparative information in the applicable financial reporting framework, and to report how to give a report in accordance with the reporting responsibilities. These two aspects were discussed in detail in SS 710. Now, what is comparative information? This is important. Definition part. First of all, I will try to focus on the first two things. What is comparative information and what is corresponding figures? The definition is very important for you if you really want to have an understanding of SS 710. So be careful. What is comparative information? Comparative information can be defined as the amounts and disclosures. Amounts and disclosures included in the financial statements. Which financial statements? Current year financial statements. The amounts and disclosures included in the current year financial statements in respect of one or more prior periods in accordance with applicable financial reporting framework. This was already read and explained to you. Next one, corresponding figures. Be careful. What is corresponding figures? When you follow corresponding figures approach, amounts and other disclosures for the prior period are included as an integral part of the current period financial statements. Followed or not? Are you able to recollect the term integral part? They are not differently disclosed. They will be disclosed in the same sheet. That is the reason why dash will be treated as an integral part of current period financial statements. Corresponding figures were deemed to be an integral part of current year financial statements. And this is also very important and difficult to understand. Why previous year figures here means amounts. Why previous year amounts and why previous year disclosures? Why previous year whether why the previous year amounts and why previous year amounts and serious Sharma, why previous year amounts and previous year disclosures were made part of current year financial statements. Why? Because they are included only to be read. They are intended to be read. They means previous year amounts and previous year disclosures which are made as an integral part of current period financial statements are intended to be read only in relation to amounts and other disclosures relating to the current period. This is technically called as dash figures, current period figures. Simply speaking, they are provided only for the sake of dash, only for the sake of comparison, nothing else. Okay. For example, this example is too difficult to understand, but I will try to explain it so that you may get some more knowledge about that wording. You were appointed as the auditor for the financial year 2022-23. So in this example, 22-23 is the current year. Previous year is 21-22. So previous year figures are nothing but being called by us as dash, corresponding figures. In the given example, previous year figures were included as an integral part of current period financial statements and hence they are to be technically called as dash, corresponding figures. So previous year amounts and previous year disclosures were included as an integral part of current period financial statements and hence we call it as corresponding figures. Why corresponding figures are included? These corresponding figures are included only for the sake of dash, only for the sake of comparison, nothing else. Why this point is specifically mentioned in SS 710? This is very difficult to understand. Supposing that I closed column number 2. I closed column number 2. Okay. By closing column number 2, I said to you like this. Now, previously 2 columns are appearing. First one is particulars. Don't try to make use of it. Ignore it. Second column is dash, current year. Third column is dash, previous year. Now I closed the second column. Only one column is appearing. What is the only column that is appearing on the screen? Previous year, that is 21-22. Now I said that if you read original financial statements of the previous year, or if you go through corresponding figures of the current year, they both are one and the same. If I say like that, do you agree with my contention? The answer is no. The answer is no. They both are different. They both may be different. So you cannot treat corresponding figures column of dash. You cannot treat corresponding figures column of current period financial statements is exactly comparable with previous year financial statements. Some amounts reflected in previous year financial statements may be different from the same amounts that are reflected under the heading corresponding figures in the current period financial statements. I will try to provide you with an example so that it will be more clearer to you. Okay, ready? What is the previous year? 21-22. In the profit and loss account of 21-22, in the profit and loss account of 21-22, there is a head called as printing and stationery. There is a head called as printing and stationery. Amount is say 4 lakh rupees. That actually speaking, that 4 lakh rupees is required to be reflected in dash. That 4 lakh rupees is required to be reflected in dash. Corresponding figures as an integral part of dash. Current period financial statements. But unfortunate thing is that in the current year, there is no such head. In the previous year, there was an expenditure head called as dash, printing and stationery. But for the current year, there is no such head. Organization is maintaining two different heads. One is printing and the other one is stationery. In the previous year, they both were clubbed, whereas in the current year, they were divided. Now, if you are the accountant and if you are preparing current year financial statements, would you like to disclose printing and stationery separately for the current year and will divide the amount of the corresponding figures accordingly? Or would you like to prepare your current year financial statements by showing it as printing and stationery? Should I repeat my question? Should you disclose in the current year printing and separate as stationery as separate heads, or will you try to combine them? Huh? I repeat my question. You are the accountant and you are made responsible to prepare financial statements for the current year. In the current year, there are two different heads, printing and stationery. You need to provide corresponding figures also. Unfortunately, in the previous year, there is only one head, that is printing and stationery. Now, my question is, will you try to disclose in the current year as printing and stationery separately, or will you try to combine printing and stationery in the current period financial statements? If I were the accountant, I will do it separately. Why? Because dash is more important to me than dash. Current year financial statements are more important for me than previous year financial statements. Therefore, in the current year, printing is say 2,40,000 rupees. Stationery is another 3 lakh rupees. So now what I will do is, I will try to divide this amount of 4 lakh rupees relating to the earlier financial year into two different groups. One is dash and the other one is dash. One is printing and stationery. So and so will be written here and so will be written here. Now, can you exactly compare these two with this one? No, they both may be one and the same. The profit may be one and the same, but you cannot exactly compare dash column of dash with the dash of dash. You cannot exactly compare corresponding figures column of the current year with previous year financial statements. There may be some differences. Some items may be restated. Some items may have been clubbed, but the overall profit, etc., will be one and the same. Now try to read. Are you able to follow this point? If not, also there would not be any problem. I will try to read this point. Once I read this last sentence, you will certainly be able to understand the example. Read it. Corresponding figures. Corresponding figures can be defined as comparative information where amounts and other disclosures for the prior period are included as an integral part . Comparative information where amounts and other disclosures for the prior period are included as an integral part of current period financial statements, and those corresponding figures are intended to be read only in relation to amounts and other disclosures of the current period. The level of details presented in the corresponding amounts and disclosures is dictated primarily by its relevance to dash current period figures. Please provide an honest answer. Are you really able to understand the last sentence? The level of detail presented in the corresponding amounts, the amounts to be presented in the corresponding figures column is dictated primarily by its relevance to current period figures. That is the reason why I said to you that while preparing current year financial statements, you will give preference for the current year financial statements only and not for the previous year financial statements. That is the reason why in the previous year it was reflected as only one item, but it is divided into two items in the dash column of the current financial year, in the corresponding figures column of the current financial year. So totals may be one and the same, but you cannot exactly compare dash with dash. Totals may be one and the same, but you cannot exactly compare dash with dash. You cannot compare the corresponding figures column, the corresponding figures column of the current period financial statements with the previous year financial statements. The totals may be one and the same, but the headings may be sometimes deleted, sometimes clubbed, and so on. Followed or not? That's it. This is nobody is responding. If you do not respond, I cannot. How do I know whether you are really able to follow it? This is all about corresponding figures. As said earlier, we focus only on corresponding figures. Once we are able to understand corresponding figures, I will try to focus on the other one, comparative financial statements. In fact, in examination point of view, dash is more important to you than dash. No doubt, I am trying to explain both corresponding figures and comparative financial statements. But in examination point of view, corresponding figures is more relevant because in India, most of the companies do follow dash approach, corresponding figures approach. Now, the requirements. This is very, very dangerous paragraph. Be careful. The auditor, you need to provide an answer for this sentence. The auditor, who is the auditor? You are the auditor. Shall determine. What is meant by shall determine? Shall check and conclude. Shall check and conclude. The auditor shall check and conclude whether the financial statements of which period? Very good. The auditor should check and conclude about whether the financial statements of the current period include the comparative information required by applicable financial reporting framework and whether such information is appropriately classified. What is meant by appropriately classified? It is required to be classified. Very good. It is required to be classified primarily by its dash to current period figures. Relevance to current, excellent. Relevance to current period figures. So the auditor shall determine whether the financial statements of the current year include comparative information required by AFRF, and if it is included, whether such information is appropriately classified. What is meant by appropriately classified? For this purpose, so the following are nothing but dash of dash under dash. Duties of auditor under SS 710, particularly when the entity under audit followed dash approach. Corresponding figures approach. The auditor should verify whether comparative information agrees with amounts and other disclosures presented in the prior period. What is the exact meaning of that? Take the current year financial statements. Okay? Take the previous year financial statements. Start comparing dash with dash. Take the current year financial statements. In the current year financial statements, there will be two columns. What are they? Current year figures and corresponding figures. Take the previous year financial statements. Compare the amounts of the previous year financial statements. Compare amounts as appearing in the previous year financial statements with the amounts as appearing under the column corresponding figures of the current period financial statements. So what you are doing is whether previous year figures are correctly shown under the heading dash, corresponding figures, whether they are in dash or not, whether they are in agreement or not. In the previous year financial statements, an amount is reflected at 4 lakhs. In the current year, under the heading corresponding figures column, it was reflected as 1 lakh. Is it tallied? Is it agreed? No. If not agreed, don't be panic. First of all, try to understand why there may be a disagreement between these two. Sometimes management would have merged some of the heads, accounting heads, or may have divided some of the accounting heads because corresponding figures are required to be presented in relation to current year financial statements. That is also required to be confirmed by you. What is the first duty of the auditor? The auditor should verify whether comparative information which is reflected as a dash the auditor should verify whether comparative information which is reflected as corresponding figures agrees with the amounts and other disclosures presented in the prior period. What is prior period? Previous year financial. Compare amount as appearing in previous year financial statements with amounts as appearing in the current year financial statements as dash figures. Excellent. As corresponding figures. If they do tally, there is no problem to you as an auditor. Okay. Next. This point cannot be explained by me to all of you. For some people, even if I explain it, it is not understandable. For some other people, there is no need for me to explain it. Read it on your own. What is the feature of opening balances that we discussed under SF item? Feature. Opening balances reflects the effects of transactions or events that took place during the previous year, and they also reflect the accounting policies that are reflected in the previous, that are reflected in the opening balances have consistently been applied for the current year. Yes or no? Now read that. The auditor should also check whether the accounting policies reflected in the comparative information are consistent with those applied in the current period. Please say whether you are really able to follow this point. Is it necessary for me to explain further? No. Why? Because in SF item I said to you that there are 3 duties to the auditor with regard to opening balances. 2 are general, 1 is specific. What are the 3 duties of the auditor in respect of opening balances? Whether closing balance of the earlier period have correctly been brought forwarded as the opening balance of the current period, whether accounting policies that are reflected in the opening balances of the current period have consistently been applied during the year, and whether opening balances contains any material misstatements. Not only this, I even explained you about what are the general duties of the auditor in respect of accounting policies. What are your duties as an auditor in respect of accounting policies? There are two duties to the auditor in respect of accounting policies. What are they? Checking. Should I repeat my question? What are the duties of the auditor in respect of accounting policies being followed by the management? Auditor should check whether accounting policies that are being followed by the management are appropriate or not. Duty number 2, the auditor should also verify whether such accounting policies have been consistently followed by the management during the current year also. Sometimes you may identify that the accounting policy that was followed by the entity in the previous year is different from the accounting policy that is being followed by the entity in the current year. That means the auditor would have observed the auditor would, for this only in the previous session I referred to AS1. Okay. The auditor should, when the auditor identifies that there is a change in the accounting policy, there are some more duties on the auditor. What are those duties on the auditor? When the auditor observes any change in the accounting policy, whether changes are properly disclosed or not, whether the impact or effect of such change has been quantified and reflected in the financial statements. If not, the fact that it is not quantifiable is disclosed in the financial statements or not. These are all dash duties to the auditor when the auditor observes a dash. Additional duties to the auditor when the auditor observes that there is a change in the accounting policy. Followed? So what are your duties? Compare last year financial statements amounts with current year corresponding figures amounts. Check and ensure that the accounting policies that are reflected in the opening. This is the reason why I said to you that that point is a general duty to the auditor. Yes or no? Whether you are performing initial audit, this point is not understandable to everyone. Only this is understandable only for those who listened SF510. I said to you that there are two general duties to the auditor. Whether you are performing normal audit or initial audit engagement, those two duties are general. First one is comparing whether last year amount and current year amount are in agreement with one another. The second one is accounting policies reflected in the opening balances are consistently applied. The accounting policies reflected in the comparative information are consistent with those applied in the current period, or if there have been changes in the accounting policies, whether those changes have been properly accounted for and adequately presented or disclosed. AS1, recollecting what you learnt under AS1 will be very much helpful for you to understand the second part of point B, that is, if there have been any changes in accounting policies. I even explained you that accounting policies are expected to be followed consistently, but you can certainly make changes to the accounting policies when it is required by another accounting standard, when it is required by any law for the time being in force, and for a better presentation of financial statements. Even this point is also reiterated by me, because that may have already been explained by your accounts faculty, and I reiterated that. Okay, done. Next. This is very difficult. What you have observed as the last word in paragraph 8, what is the standard being discussed by us? That is the reason why I said to you that there is in the previous paragraph, we established a link between SA 510 and SA 710. Last year closing balances are nothing but corresponding figures. Last year closing balances are required to be brought forward as current year figures and corresponding figures. So that is a relationship between 510 and 710. Now 560 and 710. You may be able to understand this paragraph, only because I put my best efforts to explain you SA 560. Otherwise, you won't understand even a single word out of it. Okay, ready? If the auditor becomes aware, be careful, if the auditor becomes aware of a possible material mistake, not in dash, not in current year figures or current year amounts and current year disclosures. If the auditor becomes aware of a possible material misstatement in the comparative information, in the dash, in the comparative information, while performing the current period audit, the auditor shall perform such additional audit procedures as are necessary in the circumstances to obtain sufficient appropriate audit evidence to determine whether a material misstatements exists. If the auditor had audited the prior period financial statements, the auditor shall also follow the relevant requirements of SA 560. Read it again. I need someone of you to respond to this paragraph to the extent possible. It's a challenge to you. If you pass this challenge, you are going to complete your CA within 4 years. Within the time, that means it may be 3.5 years. You are all new students, new syllabus students. Within 3 years, done. It's a challenge to you, to your competence, your capability, your understanding, that, this, so on. Not understandable to everyone. Only those students who presented in the class for the last 2 days are able to understand it. I don't want to explain it today, but I will try to show you what has been discussed in SF item first. Once you are able to recollect what is discussed by us in SF item, then understanding this paragraph will become easier. Okay? Ready? This is said to be the specific duty of the auditor, particularly when the auditor is performing an initial audit engagement. Whether opening balances of the current year, this is checking whether closing balance of the previous year are in agreement with the current year. Just a minute. Whether opening balances contains any material misstatements. For that purpose, I divided audit procedures to be followed by the auditor into 2 broad categories. One, when the previous year financial statements were audited by a predecessor auditor, when previous year financial statements are not audited. When the previous year financial statements are audited by a predecessor auditor, what the current year auditor could do? The current year auditor may make an assumption. Current year auditor may make an assumption that current year opening balances do not contain any material misstatements unless during the course of performance of current year audit, the auditor obtains some evidence or information to the contrary. Are you able to recollect it? Initially, in the previous year, debtor figure is 5 lakhs. Current year opening balance is also 5 lakhs. Previous year financial statements have been audited by a predecessor auditor. In that case, as an auditor, you can conclude that this balance is correct. This balance do not contain any material misstatements. However, if during the course of performance of audit, the auditor obtains any evidence to the contrary, for which I have given this example. While going through the current year audit, you have gone through general communication or correspondence file. In that file, you found a letter received by the organization from their debtor. In that letter, debtor says that an amount of 2,40,000 is due by him. In the balance sheet, it was reflected as 5 lakhs. But the debtor is saying that he is due an amount of only 2,40,000. And the organization has given a dash, an acknowledgement. Yes, the balance is 2,40,000. What was the balance reflected as closing balance? 5 lakhs. What was the amount really due by the debtor? 2,40,000. Now can you say that the closing balance of the previous year or opening balance of the current year are correct, or it contains misstatements? Are you able to recollect it? Now I'll stop here because time is not sufficient to explain this paragraph. I will try to focus on this paragraph in tomorrow's session. So we are in the 8th paragraph of SA 710. If the auditor becomes aware, of a possible material misstatement in the comparative information while performing the current period audit, the auditor shall perform such additional audit procedures as are necessary in the circumstances to obtain sufficient appropriate audit evidence to determine whether a material misstatement exists. This is point number 1. You can understand this point in this way. For the previous year, a predecessor auditor had performed the audit, and you are carrying out the audit for the current financial year. In the previous year, audit has been carried out by a predecessor auditor. You are carrying out audit for the current financial year. Current financial year's statements shall also include the previous year's figures in the form of corresponding figures. In the given example, it is said that you are carrying out an initial audit engagement. I repeat, in the previous year, the audit has been carried out by somebody else. That person is called as predecessor auditor. For the current year, you are carrying out the audit. That means you are carrying out an initial audit engagement. When the previous year's financial statements are audited by some other auditor, SA 510 specifies that ordinarily, the term ordinarily was used in SA 510. Instead of the word ordinarily, I used the term generally. Have you remembered it? So ordinarily, the auditor can place reliance on the correctness of the opening balances. Current year opening balances are nothing but previous year closing balances. Previous year closing balances are nothing but corresponding figures. So you can make an assumption that there are no dash in corresponding figures. There are no material misstatements in corresponding figures. However, if during the course of performance of audit of the current period, the auditor obtains some information or evidence to the contrary, then the auditor should not depend on or should not rely on the correctness of the closing balances of the previous year. Closing balances of the previous year are nothing but either dash or dash. Closing balances of the previous year are nothing but either dash or dash. Either opening balances of the current year or corresponding figures that were included in the current year. So usually you can make an assumption that they are correctly recorded. However, now read it. However, if during the course of performance of audit, the auditor gets some evidence to the contrary evidence, for which an example has already been given to you under SA 510. In the previous class, I have shown you that example. I repeated that example. Then, keeping that in mind, try to understand the first sentence of paragraph number 8. So, what assumptions should you make to understand paragraph number 8? You need to make an assumption that previous year financial statements have been audited by a predecessor auditor, and hence you are carrying out an initial audit engagement. Since you are carrying out an initial audit engagement, and since previous year financial statements have been audited by a predecessor auditor, ordinarily you can make an assumption that previous year closing balances do not contain any material misstatements. Hence, current year opening balances also do not contain any material misstatements. Hence, corresponding figures that are reflected in the current period financial statements also do not include any material misstatements. However, if during the course of performance of audit of the current period, if you come across any evidence to the contrary, then if the auditor becomes aware of a possible material contrary evidence is available to the auditor, then the auditor got a doubt. What was the doubt of the auditor? Probably the opening balances contains material misstatements. Because of that evidence gathered by the auditor, which is contrary to the amounts reflected in the previous year financial statements, the auditor got a doubt whether opening balances and dash contains dash. The auditor got a doubt about whether opening balances and dash may contain dash. Opening balances and corresponding figures may contain material misstatements. Very good. If the auditor becomes aware of a possible material misstatement in the comparative information while performing current period audit, the auditor shall perform such additional audit procedures as are necessary in the circumstances to obtain sufficient appropriate audit. Just now you got a doubt. Till now you do not have any doubt. Just now the auditor got a doubt. Are you really able to understand this sentence? Just now the auditor got a doubt. What is the meaning of that? Till now the auditor made an assumption that opening balances do not contain any material misstatements. Till now the auditor made an assumption that corresponding figures do not contain any material misstatements. Taking that assumption, the auditor carried on the audit for the current financial year. While carrying out the audit of the current financial year, the auditor comes across some evidence to the contrary. Because of gathering such evidence by the auditor, now the auditor got a doubt. Previously, there is no doubt to the auditor. Now the auditor got a doubt. What was the doubt of the auditor? Probably dash and dash may contain dash. Probably the opening balances of the current year and corresponding figures that are reflected in along with the current period of financial statements may contain some material misstatements. Why the auditor gets such a doubt? Because he obtains some dash to the contrary. He obtains some evidence to the contrary. So when you get a doubt, you need to clear it by performing some additional audit procedures and by obtaining sufficient appropriate audit evidence. If a student wants to understand this paragraph on his own, it will take not less than 1 to 2 days to understand it. Without taking these assumptions, it is highly impossible or impracticable to understand this paragraph. So be careful while reading to this. Okay, if the auditor becomes aware of a possible material misstatement in the comparative information while performing the current period audit, the auditor, that is the way in which you need to read the paragraph. The way in which you read the paragraph will have an impact on your understanding of the subject. If you do not read the paragraph correctly, you may not be able to understand the soul of the paragraph. So reading the paragraph correctly is also very important. This is the way in which you need to read that paragraph. If the auditor becomes aware of a possible material misstatement in the comparative information while performing the current period audit, the auditor shall perform such additional audit procedures as are necessary in the circumstances to obtain sufficient appropriate audit evidence. Why should the auditor follow additional audit procedures to obtain sufficient appropriate audit evidence? About what? About whether really a dash exists or not. Just now you got a doubt. In order to clear your doubt, you need to gather sufficient appropriate audit evidence. To gather sufficient appropriate audit evidence, required additional procedures are to be followed by the auditor. So till this point of time, you need to make an assumption that you are performing a dash engagement. Initial audit engagement. Followed or not? Now, can you please read the second part of that paragraph and can you explain what you have understood about that second sentence in paragraph number 8? If the auditor means current year auditor, if the auditor had audited the prior period financial statements, what is the meaning of that? You were the auditor for the previous year. You are also the auditor for the current year. What was our previous assumption? To understand first part of paragraph 8, we made an assumption that in the previous year somebody else had performed the audit. But for the current year you are performing initial audit engagement. But for understanding second sentence of paragraph number 8, you should understand that the same auditor performed the audit during the previous year also. Okay. So during the previous year you performed the audit, you have given a clean report or unmodified opinion. That means you were of the opinion that closing balances of the previous year do not contain any material misstatements. Unfortunately, while performing the audit of the current period, the auditor got some evidence to the contrary. The auditor got some evidence to the contrary. Now the auditor got a doubt about whether previous year closing balances are correct or contains any material misstatements. By that time, assume that the auditor had already submitted his audit report of the previous year. I don't know how far you are able to understand it. Yes means you are unable to understand, isn't it? No. Okay. So previous year financial statements were audited by you. Current year financial statements are also being audited by you. In the previous year, you have given an unmodified opinion. That means previous year closing balances do not contain any material misstatements. Hence, the current year opening balances also may not contain any material misstatements. However, while performing audit of the current period financial statements, you come across some evidence which is contrary, and now you got a doubt about whether previous year closing balances or current year opening balances along with corresponding figures contain some material misstatements. After all, it is you who performed audit in the previous year, and it is you performing the audit for the current year. You are not performing an initial audit engagement. Unfortunately, audit report of the previous year has already been issued, and this came to the notice or knowledge of the auditor after submission of the auditor's report for the previous year. That is technically called as facts that become known to the auditor. Facts that, this is the reason why I explained you SA 560 first. Okay, facts that become, without explaining SA 560, I cannot explain this paragraph. Facts that become known to the auditor after the date of issue of the auditor's report, but before the date the financial statements are issued. That is scenario number 1. Facts that become known to the auditor after the date of issue of the auditor's report and after adoption of the financial statements in the annual general meeting. Different procedures were prescribed that are required to be followed by the auditor in those cases in SA dash, in SA 560. Very good. Now read the second part of the paragraph. If the current year auditor had conducted audit of the prior period financial statements also, now you observed a dash in dash of dash and dash of dash or dash of dash. Now the auditor observed some dash in dash and dash of dash or dash of dash. Auditor observed some material misstatements either in the opening balances of the current period or opening the corresponding figures or in the closing balances of the previous year. Unfortunately, you were the auditor of the previous year. Unfortunately, you have given an unmodified opinion in the previous year. Now you come across some material misstatements. In that case, those material misstatements are nothing but dash. Facts. If you come across facts, you need to follow the procedures that were prescribed in SA 560. Very good. If the auditor had audited the prior period financial statements, the auditor shall also follow the relevant requirements of SA 560. What are relevant requirements of SA 560? If these facts were known to the auditor before the issue of notice to the shareholders, then the audit procedures that are required to be followed are different. After the adoption of accounts in the annual general meeting, then the audit procedures to be followed by the auditor are different. So what are all the audit procedures that you have learned under SA 560 are required to be followed if you were the auditor for the prior year as well as the auditor for the current year? Because if you were the auditor of the prior year, it means that corresponding figures have been audited by corresponding figures appearing in the current period financial statements were audited by you only. Therefore, you need to follow SA 560. Now read paragraph number 8 for the last time. If the auditor becomes aware of a possible material misstatement in the comparative information while performing the current period audit, the auditor shall perform such additional audit procedures as are necessary in the circumstances to obtain sufficient appropriate audit evidence to determine whether a material misstatement exists. If the auditor had audited the prior period's financial statements, the auditor shall also follow the relevant requirements of SA 500. Now, going back to the standard again, I don't want to explain anything, but I need every one of you to recollect what we discussed under SA 710 in the previous session so that we can move further in SA 710. What is SA 710? The heading of SA 710 is comparative information. That's it. That comparative information may be provided by the organization in their financial statements by following different approaches. There are two approaches, approach number 1 and approach number 2. Approach number 1 is called as corresponding figures Approach number 2 is called as comparative financial statements. Then we had a discussion about the definition of what is comparative information and what are comparative what are corresponding figures. This is the definition of comparative information. The amounts and disclosures included in the financial statements of the current period in respect of one or more prior periods in accordance with applicable financial reporting framework. That is the reason why every time I refer to company while discussing SS 710. If you keenly observe the discussion that we had in the previous standards on auditing, I never referred to a company. I said that standards on auditing are made applicable while the auditor is carrying out an independent audit. Whatever be the type of audit that you perform, it may be audit of a sole trader, audit of a partnership firm, audit of a company, audit of a charitable organization. Whatever be the type of audit, you are under obligation to follow all standards on auditing. But in this standard, I am referring only to company. Why I am referring only to company? As on today, what is that? As on today, only companies are required to reflect corresponding figures or comparative financial statements. That means only companies are required to provide comparative information. That is the reason why time and again to explain SS 710, I am referring only to dash, only to company. So what is AFRF to the company? Part 1 and Part 2 of either Division 1 or Division 2 or Division 3 of Schedule 3 to the Companies Act. That act requires the organization, the company, to provide dash figures. This is the reason why I keep on telling you from the previous session itself that in India we do follow dash approach. Approach number 1, corresponding figures approach. Then what is corresponding figures? Comparative information where amounts and other disclosures for the prior period are included as an integral part of the current period financial statements and are intended to be read only in relation to, they are provided only for the sake of comparison. They cannot be considered as a complete set of financial statements. I repeat, they are provided only for the sake of dash comparison. They means corresponding figures cannot be considered as a complete set of financial statements. You will never find this terminology in SS 710. However, this terminology was used earlier in the previous SS 710. This 710 is a revised edition. Prior to revision, this terminology has been used by the CA Institute. So, the corresponding figures themselves cannot be considered as a complete set of financial statements. To explain that, I have given you an example also. Okay, right. I don't want to repeat it. Comparative information where amounts and other disclosures for the prior period are included as an integral part of the current period financial statements. Why should the corresponding figures are to be included only for the sake of dash? And are intended to be read only in relation to amounts and other disclosures relating to the current period. The level of details presented in the corresponding amounts and disclosures is dictated primarily by its relevance to the current period figures. To understand this only, I have given you an example wherein in the previous year there is only one head called as printing and stationery. In the current year, the head has been divided into two parts, printing and stationery. In that case, previous year figures will be shown under the corresponding figures column under two different headings. One is printing and the other one is stationery. Corresponding figures are reflected as per current period requirements. Current period figures will not be reflected as per the requirements of corresponding figures. That is what I said to you in the previous class. Next. Audit procedures. What are the audit procedures that are required to be followed by the auditor? Actually, these procedures are to be followed by particularly these first two are required to be followed by the auditor. In respect of, the auditor shall determine whether financial statements include comparative information required by applicable financial reporting framework and whether such information is appropriately classified. These procedures are applicable either for a dash approach or for a dash approach. either for corresponding figures approach or for comparative financial statements approach. What is the first thing that the auditor should do? The auditor should check whether corresponding figures shown or comparative financial statements amounts shown agrees with dash, agrees with previous year financial statements or opening balances. The accounting policies reflected in the comparative information are consistent with those applied in the current period, or if there have been changes in accounting policies, whether those changes have been properly accounted for and adequately presented or disclosed. Then if the auditor becomes aware of a possible material misstatement, that has already been explained. Now let us focus on corresponding figures. What is that? Reporting in respect of corresponding figures. This is very, very difficult. Very, very difficult. If you have heard our discussion on essay 710 till now, you may be able to understand at least 80 to 90% of it under the heading audit reporting, particularly corresponding figures. You should be very cautious and careful while listening to this paragraph. Okay? Till now we had a discussion about what? Audit procedures that are required to be followed. Now we are going to have a discussion about what? Audit reporting in respect of dash and in respect of dash. In respect of corresponding figures, in respect of comparative financial statements. We haven't had any discussion about comparative financial statements. So let us limit our discussion only to dash. Corresponding figures as of now. Right. So you perform dash. Audit procedures. What were the audit procedures that you performed? What were the audit procedures that you have performed? The audit procedures mentioned by dash. Essay 710 have been performed by the auditor. Now the auditor had to make a report. When corresponding figures are presented, this is very important. The auditor's opinion shall not. The auditors, although dash are made an integral part of dash, although corresponding figures are made an integral part of the current period financial statements, auditor should not refer to dash figures in his report. Don't refer corresponding figures in our report. You are submitting our report only on dash. Although current period financial statements also includes dash. Current period financial statements includes current year figures and corresponding figures. But you are providing opinion only on dash but not on dash. Only on current period financial statements but not on corresponding figures. Therefore, auditor's report generally shall not refer to dash. Corresponding figures. I repeat, when corresponding figures are presented, the auditor's opinion shall not refer to corresponding figures. That is easily understandable. Except, what is the meaning of that? Till now I explained you the rule. What is the rule? What is the rule? You are the auditor of an entity. The entity is preparing financial statements or prepared financial statements by following approach 1. That means it followed corresponding figures approach. So current year financial statements not only includes amounts and disclosures of the current period, but it also includes amount and disclosures of prior period as an integral part of the current period financial statements. However, you are supposed to express your opinion only on dash. You are supposed. వింటున్నావా నువ్వు? వినట్లా? లేదా అంతరంగాలు సుడిగుండాలు తిప్పుతున్నావు 2-3 రోజుల నుంచి వినట్లా? ఎక్కడన్నా? So generally speaking, you need to express your opinion only on current period figures. Don't refer to corresponding figures in your report. However, in some exceptional cases, although generally auditor is required to express his opinion on the current period financial statements, although generally auditor should not refer to corresponding figures, in some exceptional cases auditor must have to refer even to dash, even to corresponding figures. Read it. When corresponding figures are presented, the auditor's opinion shall not refer to corresponding figures except in the circumstances described in paragraphs 11, 12 and 14. Okay. First of all, I will go through para A2 because some more explanation for this paragraph may be given in paragraph number A2. So I will go through A2 first. If nothing is there to discuss in A2, I'll come back again. Okay. A2. No reference in auditor's opinion. No reference means what? Dash should not be referred to. Corresponding figure should not be referred to by the auditor in his audit report. This is a general rule. For this general rule, there are some exceptions. What is meant by exception? When exceptions are made applicable, then auditor should not only express his opinion on the current period financial statements, but auditor should also refer to corresponding figures. Followed? The auditor's opinion, this is a general rule. The auditor's opinion does not refer to the corresponding figures because auditor's opinion is only on dash. Current period financial statements as a whole, including corresponding figures. You are not giving any opinion on dash. Corresponding figures. You are just giving an opinion on dash. Current period financial statements, including corresponding. Why the term including corresponding figures is used? If corresponding figures are wrong, current period financial statements will also become wrong. That is the reason why the term including corresponding figures is used. That means you are supposed to express an opinion only on dash. Only on current period financial statements. That's a dash rule. General rule. But that general rule is having a dash. An exception. Good. The auditor's opinion does not refer to corresponding figures because the auditor's opinion is on the current period financial statements as a whole, including corresponding figures. I don't want to read this paragraph now, A3. That is known to you in fact, but it takes some more time for me to explain that. Coming back to the original discussion, exceptions were provided in which paragraphs? Paragraph number 11, 12 and 14. Now let's try to understand 11, 12 and 14. Paragraph number 11. If the auditor's report, even if you read this paragraph 100 times, you cannot understand whether previous year financial statements were audited by the same auditor or previous year financial statements were audited by a predecessor auditor. But for the sake of your clarity, I am telling you that this paragraph is about when previous year financial statements were also audited by the same auditor. You will understand this after say 10 to 15 minutes. Because I don't want you to waste your time, I have given a clue that this paragraph is with reference to dash. Current year, you are the auditor for the current year. You are also the auditor of the previous financial year. This can be understood. This can be understood by reading the heading of paragraph number 13 and paragraph number 14. Please read heading of paragraph number 13. When prior period financial statements were audited by a predecessor auditor. Heading of paragraph number 14. When prior period financial statements were not audited. How many situations are there? Only two situations. One, when prior period financial statements were audited by you, and two, when prior period financial statements were audited by a predecessor auditor or are not audited. Last two scenarios were already covered. So probably this is relatable to dash scenario. First one. What is the first one? You are the auditor of the previous year. You are the auditor for the current year. By that way only you can understand that this paragraph is referring to a situation where previous year audit was also carried out by the same auditor. So what is the assumption that you need to make to understand paragraph number 11? You were the auditor of the previous year. You are the auditor of the current year also. That means dash that are being reflected in current period financial statements were audited by you only. Corresponding figures that are being reflected as a part of current period financial statements were already audited by you in the preceding financial year. Read it. If the auditor's report on the prior period, as previously issued, included a qualified opinion or a disclaimer of opinion or an adverse opinion. What is the meaning of that? The previous year auditor had issued a modified report. Who is the previous auditor? Current year auditor was also the previous year auditor. The same person has conducted audit of the previous year and is conducting the audit of the current year. That means you have given a dash report in the past. You have given a modified report in the previous year. Modified report may be either a dash or a dash or a dash. Have I explained this point to you earlier? Yes. If you have given a modified report, why the auditor would have given a modified report in the earlier year? Initially, the auditor would have decided to issue a modified report. But when the auditor decides to issue a modified report, he cannot issue such report immediately. Instead, auditor had to provide a dash to the dash to dash. Auditor should provide an opportunity to the management to make relevant adjustments or changes to the financial statements. If the management makes relevant changes to the financial statements, then financial statements may not contain material misstatements. In such case, you may even express an unmodified opinion. But before expressing an opinion, auditor must always provide a dash to the management, an opportunity to the management. So in the previous year, you would have provided a dash to the management, an opportunity. Management may not have utilized it. Management may be reluctant to make changes. In that case, there is no other option for you but to issue dash. Therefore, you have given dash. So in the earlier year, you have given a dash report. When you give a modified report, what does it imply? Closing balances of the previous year contains material misstatements. When closing balances of the previous year contains material misstatements, dash and dash will also contain material misstatements. Opening balances of the current year as well as corresponding figures that were reflected as an integral part of the current period financial statements shall also contain material misstatements. Are you able to understand that point? Good. If the auditor's report on the prior period as previously issued included a qualified opinion, a disclaimer of opinion or an adverse opinion, and the matter which gave rise to the modification is unresolved. Already auditor has given an opportunity to the management in the previous year itself to resolve the issue. Thereby auditor could issue an unmodified opinion, but management has not availed that opportunity. That was the reason why the auditor had given a dash report in the previous year, a modified report in the so the matter was not resolved by the management. If the auditor's report on the prior period as previously issued included a qualified opinion, a disclaimer of opinion, and an adverse opinion, and the matter which gave rise to the modification is unresolved, the auditor means current year auditor. Who is the current year auditor? It's you. Who is the predecessor auditor? It's you. The auditor, that means in the current year, shall modify. Why the term modify has been used? In the previous year, you have given a modified opinion. That means previous year financial statements contains material misstatements. That means previous year closing balances do contain material misstatements. That means current year opening balances do contain material misstatements. That means corresponding figures reflected in the current year also contain material misstatements. When opening balances of the current year contains material misstatements, the closing balances of the current year also contain material misstatements. Yes or no? In that case, for the current year also you are supposed to give. Very good. If the auditor's report on the prior period, I know very well that I am repeating it, but still I want to repeat it. Okay? If the auditor's report on the prior period, as previously issued, included a qualified disclaimer or adverse opinion, and the matter which gave rise to modification is unresolved, the auditor shall modify the auditor's opinion on the current period financial statements. I want to ask you one more question. Why the auditor is made responsible to issue an modified opinion for the current year? You are forced. Actually, you are forced to issue a modified opinion. Why? Because dash are wrong. Opening balances are wrong. Because opening balances are wrong, closing balances also became wrong. Because of that only you are giving a modified opinion. In that case, in the basis for modified opinion paragraph, that means basis for qualified opinion or basis for adverse opinion, are you able to recollect it? What are the basic elements of auditor's report? Title, address, opinion, basis for opinion. In the basis for opinion paragraph, you must have to mention why you are giving a dash, a modified opinion. When explaining why you are giving a modified opinion, what should you do? You need to refer to dash, opening balances. When you refer to opening balances, you are it is said that you are already referring to dash, corresponding figures. Actually, auditor is not required to refer to corresponding figures, but in the given case, the auditor is forced to refer to corresponding figures. That is the reason why this is called as dash, an exception. Excellent. The auditor shall modify the auditor's opinion in the current period financial statements in the basis for modification paragraph. When I say this, every one of you must be able to recollect that when the auditor gives a clean opinion, the heading of opinion paragraph should be opinion. When the auditor issues a qualified opinion, auditor need to change the heading of opinion paragraph to qualified opinion. If it is an adverse opinion, change the heading to adverse opinion. If it is a disclaimer of opinion, change the heading of the paragraph to disclaimer of opinion. Similarly, if you have given an unmodified opinion, keep basis for opinion paragraph as it is. If you have given a qualified opinion, you need to make change to the basis for opinion paragraph also into basis for qualified opinion, basis for adverse opinion, basis for disclaimer of opinion. Why the auditor need to make changes even to the headings of the paragraphs? When the reader goes through the financial statements without going through the entire paragraph, the reader should be able or capable of understanding that this time our auditor has given dash, a modified report, without going through that paragraph. Reader, just merely by going through the side heading of the paragraph, reader should be capable of understanding that this time our auditor has given a modified opinion. That is the reason why you need to make changes to the heading of opinion paragraph as well as heading of basis for opinion paragraph, particularly when the auditor is issuing a dash opinion, modified opinion. Are you able to recollect it? Now read it. The auditor shall modify the auditor's opinion on the current period financial statements. In the basis for modification paragraph, in the auditor's report, the auditor shall either, point number 1 is easy to understand, point number 2 is most difficult to understand. Okay? The auditor shall either refer to both current period figures and corresponding figures in the description. Description means in the basis for modification paragraph, the auditor should describe or explain. In the basis for modification paragraph, the auditor should describe or explain why he is giving a dash report, a modified opinion. In that description, the auditor shall refer to both dash and dash. Simply speaking, under the heading basis for modification paragraph, the auditor shall refer to, usually you are not expected to refer to dash, corresponding figures. But in this case, you must refer to not only current year financial statements, but also corresponding figures. Refer to both the current period figures and corresponding figures in the description of the matter, giving rise to modification when the effects are possible effects. I will try to raise a question, and depending on the answer that you have provided, I will assess whether you are really following my discussion for these days or not. Why the terms effect and possible effect is used? Excellent. You are very soon going to complete your CA. When the auditor is able to obtain sufficient appropriate audit evidence, when the auditor is unable to obtain sufficient appropriate audit evidence, when you are unable to obtain sufficient appropriate audit evidence, obviously you use the term possible effects. Yes or no? Very good. So the auditor should refer to both current period figures and corresponding figures in the description of the matter, giving rise to modification when the effects, after all, you are having 18 years of age. I know very well that it is very difficult for you people to understand this language and the meaning of that. But unfortunately, you preferred this course. It is your preference. So you must have to work hard and you must have to digest what is being explained to you. There is no other alternative for you but to try to understand what is being discussed. It is understandable, but it may take some time. That's it. It is only a matter of time. You can certainly understand it. For a person having, say, 21 years of age, he may be able to understand this paragraph just by reading once or twice. You may be able to understand this paragraph by reading 10 times. It's a matter of time. That's it. So, if the auditor's report on the prior period as previously issued included a qualified opinion, a disclaimer of opinion, adverse opinion, and the matter which gave rise to the modification is unresolved, the auditor shall modify the auditor's opinion on the current period financial statements. In the basis for modification paragraph of the auditor's report, the auditor shall either refer to both the current period figures and the corresponding figures in the description of the matter, giving rise to the modification when the effects or possible effects of the matter on the current period figures are material. Are you really able to follow this point? Yes or no? So in the current year also you must have to issue dash modified opinion. Why you have given a modified opinion? That is required to be explained or described by you in a separate paragraph. What is that paragraph? Basis for modified opinion paragraph. In that paragraph you need to mention that since dash contains dash, current year also, for the current year also we are forced to issue dash. Since opening balances contains material misstatements, that means corresponding figures contains material misstatements, we are supposed to issue a modified opinion even for the current year. So auditor is referring to both dash and dash in his report. Both current year figures as well as corresponding figures in his report. Yes or no? Now, I don't want to explain point number B now. I will try to first of all show you an example for this, which has been given as an annexure in the original SS710. Don't try to find this in your material. It is not given in your material. This is an additional point that I am explaining to you. How to describe or how to explain and refer to both dash and dash. Current year figures and corresponding figures in the auditor's report. This is the pro forma that you can make use of as an auditor. If you go through this pro forma and understand this, you will enjoy this pro forma like anything, and you will get some more knowledge about the thing that we just finished. Okay? The following are the assumptions made by the CA Institute. You were the auditor for the previous year. You are the auditor for the current year. In the previous year, you have given a dash opinion, qualified opinion. Report illustrative of circumstances described in paragraph 11A as follows. What I discussed with you till now, paragraph number 11, point number A, yes or no? A report which illustrates the circumstances described in paragraph number 11A. The auditor's report on the prior period as previously issued included a dash opinion. So in the previous year, you have given a modified opinion. The type of modification given by you is qualified. In the previous year, you have given a modified opinion. The type of modification that you have given in the previous year is dash, qualified opinion. The matter giving rise to modification is unresolved. What does it mean? Opening balances contains material misstatements. Corresponding figures also contains material misstatements that was not resolved by the management. The effects are the possible effects of the matter on the current period figures are material and require a modification to the auditor's opinion regarding the current period figures. So in the current year also the auditor wanted to issue a modified opinion. In that case, how to frame your report? That is what is explained in illustrations by the CA Institute. Okay? Are you ready? This is nothing but dash. Good. Independent auditor's report. This is nothing but addressee. Actually, these illustrations were based on earlier SA700. SA700 has been revised now. Earlier also, there was a standard called as SA700. Earlier also, there are some basic elements in the auditor's report. They have been redrafted by the CA Institute by making amendments to SA700. So basis for qualified opinion. In the given example, auditor has given a dash opinion. Why for the current year the auditor has given a qualified opinion? Because dash contains dash and dash contains dash. Opening balances and corresponding figures contains material misstatements. Why opening balances and corresponding figures contains material misstatements? Because closing balances contains material misstatements. Why closing balances of the earlier year contains material misstatements? Because you have given a modified report in the earlier year and management had not resolved that matter. You are forced to issue a modified opinion for the current year also. And while you are giving a modified opinion for the current year, you need to include a paragraph in your report called as dash. Basis for Have you seen that heading? It is not basis for opinion. It is basis for qualified opinion. In that paragraph, you need to describe about what? Why you are giving dash opinion. qualified opinion. Why you are giving qualified opinion? Because of the problem with corresponding figures. Therefore, you need to refer to corresponding figures also. Generally, you are not required to refer to corresponding figures. But in this case, you must have to refer to corresponding figures. Followed or not? As discussed in note number 10, as discussed in note number 10 to the financial statements. It's a very good point. As discussed in note number 10 to the financial statements. Who prepares financial statements? A note has already been included by the management in the financial statements. Now, if you want to highlight that, you should have to include a dash paragraph in our report. Emphasis of matter paragraph. But in the given case, the auditor decided not to include emphasis of matter paragraph, but to refer that in a paragraph called as basis for qualified opinion paragraph. Why? No. Inclusion of an emphasis of matter paragraph is not a substitute for issuing a modified opinion. Have I explained that to you or not? That is the reason why, instead of including this point under the heading emphasis of matter paragraph, the auditor included that point under the heading basis for qualified. If you are able to recollect it, you will enjoy it a lot. Okay? Otherwise, it is not possible for me to repeat it. As discussed in note number 10 to the financial statements. This point has already been included by the management in the notes to accounts. No depreciation has been provided in the financial statements, which constitutes a departure from the accounting standards referred to. In the earlier Companies Act, accounting standards were referred to in section 211. Now in the present Companies Act, they were referred to in section 133. As discussed in note number 10 to the financial statements, no depreciation has been provided in the financial statements, which constitutes a departure from accounting standards referred to in section 133 of the Companies Act 2013. So Act requires providing for depreciation. The company has not provided for the depreciation. It is nothing but a departure from accounting standards referred to in section 133 of the Companies Act. Why the company has not provided for depreciation? Depreciation was not provided by the company for the current financial year. This is why it has not provided. This is the result of a decision. The wording that is used in this paragraph is a little bit confusing. You should be very careful. This is the result of a decision. Taken by whom? Taken by management of the entity. At the start of not the current year. At the start of the preceding financial year. What does it mean? That means dash was not provided not only in the current year. Depreciation was not provided not only in the current financial year, but was also not provided in the previous year. Why depreciation was not provided? Because in the previous year itself, management made a decision about not to provide for depreciation. At the start of the preceding, not the current financial year, at the start of the preceding financial year, a decision has been taken by the management not to provide for depreciation. Therefore, that is the cause because of which we qualified our opinion on the financial statements relating to that year. What is meant by relating to that year? We qualified our audit opinion on the financial statements relating to that year. That means you are communicating to the shareholders that you were the auditor for the previous year. You are the auditor of the current year. You have issued a dash report in the previous year, modified report. You are also issuing a modified report for the current year. Why you are issuing a modified report for the current year? Because in the earlier year, dash has not been provided. Depreciation was not provided, And in the earlier year, I have given a modified opinion, and that matter which raises or which causes issuing a modified opinion in the previous year has not been resolved by the management even in the current year. Therefore, not only previous year financial statements, but for current year financial statements also contains material misstatements, because of which I have given a dash report for the current year also, a modified or a qualified opinion for the current year also. Here the auditor is referring to what? Corresponding figures. Why you are referring to corresponding figures? Because that is the cause for which you are giving a modified opinion for the current year. Followed, read it again. As discussed in note number 10 to the financial statements, no depreciation has been provided in the financial statements, which constitutes a departure from accounting standards. This is the result of not providing for depreciation, is the result of a decision taken by the management at the start of the preceding financial year and caused us to qualify our audit opinion on the financial statements relating to that year. That means you are conveying to the shareholders that you were the auditors for the previous year and you have issued a modified opinion in the previous year also. Based on straight line method of depreciation, in those days, depreciation can be provided by the entity either by following straight line method or by following written down value method. Now you are required to provide depreciation by following a formula. What is the formula? Schedule 2 to the Companies Act deals with the concept of depreciation. According to Schedule 2, depreciation can be calculated by an entity by applying a formula. The formula is like this. Depreciation is equal to depreciable amount. What is that? Depreciation is equal to depreciable amount divided by useful life of the asset. What is that? Depreciable amount. If you apply this formula, the resultant figure is called as depreciation. That is required to be provided by you. Depreciation is equal to depreciable amount divided by useful life. Then what is a depreciable amount? Cost minus residual value. Different terminology is used in different standards. That is the reason why students gets confused. At your intermediate stage, the lecturer will say that that should be called as a scrap value. At your CA inter stage, the accounting standards lecturer says that it should be called as estimated realizable value. The term estimated realizable value was used in accounting standard 10. Whereas in Companies Act, it has been used as residual value. They are one and the same. Whether you call it as scrap, or you call it as estimated realizable value, or you call it as residual value, they mean one and the same. So original cost minus a maximum of 5% residual value. The resultant figure is called as depreciable amount. What is the formula to be used for calculation of depreciation under Schedule 2 to the Companies Act? Depreciation is equal to depreciable amount divided by useful life. Depreciable amount is equal to original cost of the asset minus 5% residual value. That is called as depreciable amount. The knowledge of Schedule 2 is essential for you, because in future I am going to discuss with you a chapter called as Audit of Items of Financial Statements. Under that chapter, I need to explain you about how to check depreciation and amortization. If you do not have knowledge of how to provide for a depreciation, particularly in case of companies, it will be difficult for me to explain you that point. Keeping that point in mind, although I am not responsible to explain you about depreciation, I started explaining you some things relating to depreciation. Okay, so depreciation is equal to depreciable amount divided by useful life. Depreciable amount is equal to original cost of the asset minus 5% residual value. Earlier, we use it to provide depreciation by applying a rate of depreciation. Now Schedule 2 to the Companies Act has not provided any rates. Schedule 2 to the Companies Act provides only useful lives. Is Section 32 completed in income tax? Very good. What Section 32 says? Depreciation on the concept of block of assets. Under the Income Tax Act, you need to provide for depreciation under Section 32 on the concept of block of assets by following WDV method and by applying rates of depreciation specified under Income Tax Act. So for calculation of depreciation under Income Tax Act, rates were specified. Earlier in Companies Act 1956 also rates were specified. But in 2013 Companies Act, rates of depreciation were not specified. Only useful lives were specified. Useful lives. That is the reason why I said to you that formula is depreciable amount divided by useful life. Don't try to apply a percentage, but you can convert it into percentage. It's a different issue. Had that point explained by your accounts lecturer while dealing with AS 10? Yes or no? Very good. Based on the straight line method of depreciation, and annual rate of 5% for the building and 20% for the equipment. Under 1956 Act, rates of depreciation were specified. Under Companies Act 2013, rates were not specified. Only useful lives are specified. This pro forma is based on 1956 Act. That is the reason why they have mentioned rates of depreciation. Now you cannot refer to rates. You need to mention only useful lives. So based on straight line method of depreciation and annual rates of 5% for the building and 20% for the equipment, the loss for the year should be increased. The loss for the current year should be increased by this much amount. In 2021 and in 2020. 2020 is dash. 21 is dash. So loss of the previous year should have been increased by this much. Loss of the current year should have been increased by. Why? Because the entity has not provided for depreciation. Loss of the previous year should have been increased by this much. Loss of the current year should have been increased by. If it is a loss, it should be increased. If it is a profit, it should be decreased. So in the previous year, in the current year, in both the years, the company suffered with a loss. That is the reason why probably dash would have decided not to provide dash. Management would have decided not to provide for depreciation. In the previous year, no depreciation is provided. In the current year, no depreciation is provided. Probably because the organization is suffering with loss. If you provide for depreciation, you need to report higher losses. That is the reason why management has not provided for depreciation. Because of that, loss of the previous year, if depreciation is provided, loss of the previous year should have to be increased by this much. Loss of the current year should have to be increased by this much. And the second effect, property, plant and equipment should be reduced. If depreciation is provided, value of the assets will get reduced by accumulated depreciation of this much in year 2021 and by this much in year 2020. And the accumulated loss should be increased by this much. So now, have you referred to corresponding figures? Yes or no? Where in this paragraph you have referred to corresponding figures? Here. This is the result of a decision taken by management at the start of the preceding financial year and caused us to qualify our audit opinion on the financial statements relating to that year. Relating to that year means previous year. That means you are referring to dash also. Previous year figures are corresponding figures also. Followed or not? That's it. Now coming back to our original discussion on 11A. Now it is better understandable to you, 11A. Please read it on your own, the entire point 11A. if the auditor's report on the prior period, as previously issued, included a qualified disclaimer adverse and the matter which gave rise to the modification is unresolved, auditor shall modify the auditor's opinion on the current period. In the basis for modification paragraph in the auditor's report, the auditor shall either report both the current period figures and corresponding figures in the description of the matter year 2020, year 2021. Both have been referred to by the auditor, year 2020 and year 2021. Both have been referred to by the auditor in a paragraph called as basis for qualified opinion paragraph. That is the meaning of 11a. Now 11b is very difficult to understand. It is understandable only with the help of an example. Otherwise, it is quite difficult to understand. I don't know how far I am able to convey this to you. Let us try to have a better understanding of 11b as well. Okay? That is the reason why most probably nothing has been explained in the material given to you either about 11a or about 11b. What is given in the original standard has been reproduced to you. That's it. You cannot understand just by going through your material. Don't think that everything is material. There is nothing in the material excepting what is there in the standard. You need to understand the standard first. Then only it is possible for you to understand what is given in your material. Okay? In other cases, explain. Who should explain? Auditor should explain that the audit opinion has been modified because of the effects or possible effects of the unresolved matter on the comparability of current period figures and corresponding figures. The word comparability is more important in this point. If you try to focus on the term comparability, it may be possible for you to understand the exact difference between dash and dash, 11a and 11b. 11a is understandable. I know it very well. Most of you people may be able to understand 11a, but 11b is very difficult. In both the cases, the auditor should refer to dash, corresponding figures, in his dash, in his report, under the heading dash, basis for modification paragraph, while he is describing the basis for modified opinion. In other cases, explain that the audit opinion has been modified because of the effects or possible effects of the unresolved matter on the comparability of the current period figures and corresponding figures. Now, reference is given to A3 to A5. I will try to show you A3 to A5. We'll try to explain you to the extent possible. Later on, we'll show you the illustrative format. If we go through A3 to A5 and illustrative format, most probably you may be able to understand the difference between dash and dash, 11a and 11b. Otherwise, it is quite difficult to understand. Let's go through A3 to A5 and illustration. Previously, I read A2 and explained it, yes or no. I said that I cannot explain A3 as of now. Now it is time to have a discussion on A3 to A5. Ready? Again, in the previous year, you were the auditor. For the current year also, you are the auditor. So there is no predecessor auditor to you. You were the auditor of the previous year. You are the auditor of the current period. We are in discussion under the heading 11b. 11 deals with prior period financial statements were also audited by you. It may be either point A or point B. Modification in the auditor's report on the prior period unresolved. modification in the auditor's report on the prior period unresolved. When the auditor's report on the prior period as previously issued included a qualified opinion, etc., etc., and the matter gave rise to the modified opinion is resolved and properly accounted for or disclosed in the financial statements in accordance with the AFRF, the auditor's opinion on the current period need not refer to dash. Auditor's opinion on the current period need not refer to previous modification. I repeat, when the auditor's report, actually for this you need to put side headings like this: resolved, unresolved. Previous year auditor has given a dash report, modified report. Who is the previous year's auditor? The current year auditor was also the previous year's auditor. Previous year's auditor has given a modified report, and the matter that give rise to modification may be resolved or may be unresolved. If it is resolved, what to do? If it is unresolved, what to do? It has to be divided into two headings. I repeat, when the auditor's report on the prior period as previously issued included a qualified opinion, etc., and the matter which gave rise to the modification is resolved. Heading is unresolved, but in the body of the paragraph it was mentioned as dash, resolved. That is the reason why I have given a side heading to this paragraph as dash, resolved. Is resolved and properly accounted for or disclosed in the financial statements in accordance with the AFRF, the auditor's opinion on the current period need not refer to previous modification. When the auditor's opinion on the prior period as previously expressed was modified, the unresolved matter that gave rise to the modification may not be relevant to the current period figures. Actually, you need to understand not A3 but A4. But A3 is also explained to you. What is A3? When previous year modification has been resolved and properly accounted for or disclosed in the financial statements in accordance with applicable financial reporting framework. Auditor's opinion on the current period need not refer to previous modification. A4 is very important. When the auditor's opinion on the prior period as previously expressed was modified, the unresolved matter that gave rise to the modification may not be relevant to the current period figures. Nevertheless, a qualified opinion, disclaimer or adverse may be required on the current period financial statements because of the effects or possible effects of unresolved matter on the comparability of the corresponding figures. For understanding this, let us go through the illustration. This illustration is also very difficult to understand. Illustration number B, example number B, corresponding figures. Both are relatable to corresponding figures. What are the assumptions that were made in giving this illustration? Auditor's report on the prior period as previously issued included a dash. Same assumption was also made in example A. The matter giving rise to modification is unresolved. Same example, same assumption is made in the previous example also. The effects, this is different. The effects or possible effects of the matter on the current period's figures are immaterial. It is material in the previous year, but it is immaterial in the current year. However, but require a modification to the auditor's opinion because of the effects or possible effects of the unresolved matter on the comparability of the current period figures and corresponding figures. The amount is immaterial, but because of that problem, dash is in danger. Comparability is in danger. Because of that, the auditor decided to issue dash in the current year also. Modified report in the current year also. I cannot explain more than this for this point, except explaining you about the basis for qualified opinion given as an annexure. Try to understand this all your doubts will get clarified. Then I will repeat what I said till now. You'll be able to understand each and every word of it. I assure you that you are going to understand each and every word that I have used once you are able to understand dash. Basis for qualified opinion. Very difficult to understand, but remember it. Because we were appointed auditors of the company during 2020. During 2020, we were not able to observe. We were not able to observe the counting of physical inventories. The counting of physical inventories at the beginning of that period. At the beginning of that period, or satisfy ourselves concerning those inventory quantities by alternative means. Since opening inventories affect the determination of results of operations, we were unable to determine whether adjustments to the result of operations and opening retained earnings might be necessary for 2020. Our audit opinion on the financial statements for the year ended 20 was modified accordingly. Our opinion on the current period's financial statements is also modified because of the possible effect of this matter on the comparability of the current period figures and the corresponding figures. Now I will try to explain this. It takes time. Can you spare for another 10 minutes? Done. You were the auditor for the year 2020-21, that is dash year, previous year. You are continued to be the auditor for the current year, that is dash. If you do not understand these things, you cannot understand this paragraph at all. What is the current year? 21-22. What is the previous year? 2021. You were the auditor of the entity for the previous year 2021, and you are continued to be the auditor of the entity for the year 21-22. You are appointed as the auditor of the entity in the middle of the financial year. In the middle of the financial year. Let us assume that you have been appointed as the auditor in the month of July 2020. July 2020. In the middle of the previous financial year, you were appointed as the auditor. You were not appointed as on dash 1/4/2020. Okay? There may be some opening inventories. There may be some opening inventories as on 1/4/2020. The correctness or otherwise of opening inventories and their value will impact the financial statements for the year 2021. Yes or no? Should I repeat the facts of the case? You were appointed as the auditor for the year 2021. That appointment was taken place in the middle of the year. That is, say, in the month of July 2020. There were some opening balances for the year 2021 relating to inventories as on dash date. 1st April 2020. Opening inventories will have an impact on closing inventories and hence will also have an impact on the financial statements for the year 2021. Since you were appointed as the auditor in the middle of the financial year, you are unable to observe. You are unable to observe dash made by dash. Physical count of dash. Physical count of inventories made by dash. Made by management. Management could have made physical verification of inventories on 31st March 2020. Yes or no? 31st March 2020 is the closing date. 1st April 2020 is the opening date. So current year opening inventories are nothing but dash. What is the current year in this example? 2021 is the current year. Current year opening balance of inventories is nothing but closing balance of inventories of the previous year. Closing balance of inventories were physically verified by dash. Management. We are not there at the time of physical verification because we were appointed as the auditors of the entity in the middle of the year. So we are not having any knowledge about the dash of dash. Correctness of opening balances. Since we are not having any knowledge of correctness of opening balances, we are not having any knowledge about the correctness of the closing balances. We doubt the correctness of the closing balances. Hence, we issued a dash opinion earlier. And hence, we issued a modified opinion for the year dash 2021. Are you able to understand this point? If you are really able to understand this point, now half of this point is said to be completed. Read it again. Because we were appointed as the auditors of the company during 2020. For the year 2021, we are appointed as the auditors during 2020, in the middle of the year. We were not able to observe the counting of physical inventories at the beginning of that period. What is the beginning of that period? 1st April 2020. 1st April 2020 and 31st March 2020, they both are one and the same. Yes or no? Closing of one year is the opening of the next year. We were not able to observe the counting of the physical inventories at the beginning of that period, or satisfy ourselves concerning those inventory quantities by alternative means. There are no alternative means also to check whether opening inventories are correct or not. Since opening inventories affect the determination of results of operations, that is profit, we were unable to determine whether adjustments to the results of operations and opening retained earnings might be necessary for year 2020. Therefore, our audit opinion on the financial statements for the year ended March 2020 was modified accordingly. We don't know whether it is correct or not. Hence, we have given a dash report. In the year dash, in the financial year 2020-2021. And everything is clear with reference to financial year 21-22. Why? Because on 31st March 2021, management again may have made physical count of inventory. Auditor could have participated in the physical count of inventory as on dash, but not as on dash. As on 31st March 2021, but not as on 31st March 2020. Now for this year, the auditor is confident. For this year means, for the current year 21-22, auditor is confident that opening balances are correct. Closing balances are also correct. So there is no need to give a modified opinion for the current year. But auditor wants to give a modified opinion because it is not possible to compare corresponding figures with the current year figures. Corresponding figures are not, may be correct, may not be correct. Current year figures are correct. Comparability is a problem. So because of that problem in comparability, if you want to give a modified opinion, you can issue a modified opinion. In that case, you need to express your opinion. You need to describe why you have given a modified opinion for the current year in the basis for qualified opinion paragraph like this. Now, I will try to read the entire paragraph only one more time so that you may have better idea of this. Because we were appointed auditors of the company during 2020, we were not able to observe the counting of the physical inventories at the beginning of that period or satisfy, at least you should satisfy that opening balances are correct by alternative means. Alternative means are not available to the auditor, neither participated in the physical counting. Alternative means are not available for the auditor to confirm the correctness of the opening balances. Since the opening balances correctness is not confirmed, dash balances correctness is also not confirmed. Therefore, the auditor had given a dash opinion in the previous year, modified opinion in the previous year. Because we were appointed as the auditors of the company during so and so, we were not able to observe the counting of physical inventories at the beginning of that period or satisfy ourselves concerning the inventory quantities by alternative means. Since opening inventories affects the determination of the results of operations, we are unable to determine whether adjustments to the results of operations and opening retained earnings might be necessary for 2010. Our audit opinion on the financial statements we are unable to determine whether adjustments to the results of operations and opening retained earnings might be necessary for the year 20. Our audit opinion on the financial statements for the year ended 31st March 2020 was modified accordingly. Our opinion on the current period financial statements is also modified, not because there is a misstatement in dash. Not because there is a misstatement in dash. Current year opening balances, but because it is not possible for comparison. In that case also, the auditor shall refer to dash and the corresponding figures. Have you referred to corresponding figures also in your report? Yes or no? The term corresponding figures is appearing in the report of the auditor. Generally, auditor need not refer to dash, corresponding figures. But in the given case, the auditor need to refer to corresponding figures. This is all about 9, 11A and 11B. If you are having any doubts, feel free to ask me. I am here to clarify your doubts, and I will take another 3 hours time also if you need it, because you must be able to understand SS 710. The problem in the new syllabus is that what are all the things that were discussed at CA inter level may probably not be discussed at your CA final level. A generalized review may be given to you, and the case laws may be focused on at your CA final level. Therefore, you must ensure that you are having a very good understanding at CA inter level only for those standards which are made part of CA inter syllabus. Be careful. Previously, in the previous syllabus, if you miss these standards at your intermediate level, you can learn them at final level, but that is not the case in the new syllabus. That is the reason why I am warning you. Audit reporting corresponding figures. When corresponding figures are presented, auditor's opinion shall not refer to corresponding figures except in the circumstances described in paragraph number 11, 12 and 14. 11 is completed. Now 2 more are pending. 12 and 14. 12 and 14. Okay. Let us have a discussion on that after the break. Now the time is 9:30. Come back by 10 to 10. The definitions part of SS 710 is completed. Objectives are well known to you. Nature of comparative information is also discussed. Paragraph number 7 to paragraph number 13 or 14 are completed. And we are having a discussion on the second topic of SS 710, that is comparative financial statements. Of course, we had some discussion about SA 710 comparative financial statements. I have shown you the format in which the auditor is required to provide a report, wherein the auditor is supposed to provide a report not on 1 year financial statements, but on more than 1 year's financial statements. In such a case, it is technically called as comparative financial statements. And as already said to you, there are 2 approaches to provide comparative information. The first one is corresponding figures. The second one is comparative financial statements. And we completed discussion on corresponding figures. We started having a discussion on comparative financial statements. And in fact, I have explained you about point number 15 and point number 16. But for your sake, I will try to repeat it. Try to recollect what we discussed in the previous session under the heading comparative financial statements, so that we can proceed further. That is, we can have a discussion on paragraph number 17, 18 and 19. Then it is said that SS 710 is completed. It seems most of the students attended the class from today onwards. So for those people who haven't listened SS 710 in the past, it is very difficult for them to understand even a single word out of it. So don't try to understand it. because even if you try to understand it, it is not understandable. Even for those students who are attending the classes for the past 3 to 4 days, it is difficult for them to understand the concept of SS 710. Okay. Now, what are comparative financial statements? When comparative financial statements are presented, the auditor's opinion shall refer to each period for which the financial statements are presented, and on which an auditor's opinion is expressed. When reporting on this point is known to you, and in fact I have shown you the pro forma to be followed by the auditor to provide a report, particularly where the entity under his audit is following comparative financial statements approach. Read it again. When comparative financial statements are presented, the auditor's opinion shall refer to each period. When I read it as each period, you should be able and try to compare this term each period with corresponding figures. Under the heading corresponding figures, auditor is required to express an opinion only one period only financial statements of a single period. Whereas under comparative financial statements approach, auditor is required to express his opinion on each period for which the financial statements are presented. And another important difference between corresponding figures and comparative financial statements is that under corresponding figures, previous year figures were made an integral part, and you are expected to express an opinion only on the current period financial statements, although in the current period financial statements, previous year figures were made integral part. Whereas under the heading comparative financial statements, you need to express an opinion on each and every period for which financial statements are presented and on which an audit opinion is expressed. When reporting on prior period financial statements in connection with the current period audit, if the auditor's opinion, I stopped here in the previous class, if the auditor's opinion on such prior period financial statements differs from the opinion the auditor previously expressed, the auditor shall disclose the substantive reasons for the different opinion in a paragraph called as other matter paragraph in accordance with SS 706. Now I am able to recollect that we had a discussion even on paragraph number 16. After explaining you paragraph number 16, I said to you like this. Previously, you do not know what are the examples to be included under the heading other matter paragraph. Now you know very well about some examples relating to the points to be included under the heading other matter paragraph as per SS 706. So now I am able to recollect that we completed a discussion not only on paragraph number 15 but also on paragraph number 16. But for your sake, I will try to explain paragraph number 16 again. You were the auditor for the year 2021. You were the auditor for the year 2021. You have been reappointed as the auditor for the financial year 2021-22. And the organization under your audit is following approach number 2. What is approach number 2? Corresponding financial statements. So along with current year financial statements, previous year financial statements, a separate set of previous year financial statements were provided, and you are made responsible to express an opinion not only on dash but also on dash. Not only on current period financial statements but also on the previous year financial statements. And remember, you were the auditor for the previous year also. Assume that in the previous year you have given a dash report, unmodified report, but now you are of the opinion that previous year financial statements contains some material misstatements, and hence a modified opinion is appropriate. What was your previous opinion? What is your present opinion on previous year financial statements? I repeat, what was your previous opinion on previous year financial statements? they are reflecting a true and fair view. What is your opinion on the previous year financial statements now? It is necessary for you to issue a modified opinion. That is the meaning of this sentence. If the auditor's opinion on such prior period financial statements, what was the original opinion of the auditor? Unmodified. Differs from the opinion the auditor previously expressed. Opinion the auditor previously expressed is unmodified opinion. Now, in the current year, the auditor wants to express a dash with respect to dash. A modified opinion with respect to previous year financial statements. In that case, the auditor shall disclose the substantive reasons for the different opinion in an other matter paragraph in accordance with SA 706. The next 2 points are very much similar to the points that we discussed under the corresponding figures approach when prior period financial statements were audited by a predecessor auditor. If this point is very important, be careful. If the financial statements of what is paragraph number 16 and 17, what is the difference between 16 and 17? In 16th paragraph, prior year financial statements were also audited by you. In 17th paragraph, a predecessor auditor has conducted audit of previous year financial statements. Now you are made responsible not only to express your opinion on dash, but also to express an opinion on dash. But also to express an opinion on previous year financial statements for which audit has been conducted by a dash auditor, predecessor auditor. In that case, if the financial statements of the prior period were audited by a predecessor auditor, in addition to expressing an opinion on the current period financial statements, the auditor shall state in the other matter paragraph that the financial statements of the prior period were audited by a predecessor auditor, the type of opinion expressed by the predecessor auditor, and if the opinion is modified, the reasons therefore, and the date of that report, unless the predecessor's auditor's report on the prior period financial statements is revised with financial statements. In fact, this point was also explained to you. You are the previous year auditor. I am the current year auditor. I am made responsible to express an opinion not only on the current period financial statements but also on the previous year financial statements, otherwise called as comparative financial statements. During the course of performance of audit, I concluded that the opinion that has been given by dash is okay. The predecessor auditor is appropriate. In that case, there is no need for me to express a new opinion again on dash. Prior period financial statements, excepting in situations where I concluded that the opinion given by the previous year's auditor is inappropriate opinion. Simply speaking, when the previous year auditor has given, say, an unmodified opinion, but you are of the opinion that he should have given dash opinion, modified opinion, in that case you must have to express your opinion both on dash and dash, both on current period financial statements as well as on prior period or comparative financial statements. However, if the previous period auditor has given an unmodified opinion, you are of the opinion that such opinion given by the predecessor auditor is appropriate. In that case, there is no need for you to express a separate opinion on dash, prior period financial statements. In that case, it is sufficient if you refer to dash. If you refer to the auditor's report of the prior period, the date of that report, etc. And this point, please leave this. Probably this would not have been included in your material. If it is included in your material, I will then try to explain it. Then, is it included? Done. If the auditor concludes, this point is also very well known to you. If the auditor here means current year auditor, concludes that a material misstatement exists that affects prior period financial statements on which the predecessor auditor had previously reported without modification. What is the meaning of this? Previous year auditor had given a dash report, but during the course of performance of audit of the current period, you have identified that previous year financial statements contains some material misstatements because of which previous year auditor should have given a modified opinion but has given an unmodified opinion. If the auditor concludes that a material misstatement exists that affects prior period financial statements on which predecessor auditor has previously reported without modification, the auditor shall communicate the misstatement with the appropriate level of management and those charged with governance and request that predecessor auditor be informed. If the prior period financial statements are amended and the predecessor auditor agrees to issue a new auditor's report on the amended financial statements of the prior period, the auditor shall report only on the current period. What is the meaning of this? Anybody can provide an explanation for this, and remember, you can provide an explanation for this only when you are having knowledge of dash. SA 560. Have you observed any relationship between this paragraph and SA 560? What is that relationship? You are the auditor of the current year. The previous year financial statements have been audited by a predecessor auditor. That auditor has given an unmodified opinion. You are made responsible to form an opinion not only on the current period financial statements but also on the previous year financial statements. Generally, when previous year when the opinion given by the previous year's auditor was found to be appropriate, you will just refer to dash previous year's auditor's report along with the date of the report. You won't express any dash on previous year financial statements. Opinion on previous year financial statements, although they have been provided along with the current year financial statements as dash comparative financial information. However, sometimes you may have identified that previous year auditor had given a wrong report or inappropriate report. Why the current year auditor may have concluded that previous year auditor has given a wrong report or inappropriate report? Because during the course of performance of audit of the current period financial statements, the current year auditor may identify some misstatements in the prior period financial statements which could have been detected by the previous auditor but have not so been detected by the previous year auditor. Therefore, you are of the opinion that dash given by dash is dash. The opinion given by a predecessor auditor is wrong or is inappropriate. In such case, what should you do? You need to express an opinion not only on dash, not only on current period financial statements, but also on previous year financial statements. Apart from that, you must communicate this aspect to dash management or to those charged with governance. Now please read paragraph number 18 again and you will certainly have some more understanding on paragraph number 18. If the wording that has been used is very difficult, but there is a condition prevalent to this. In that case, first of all, what should you do? You need to communicate the same to the management. Asking the management to communicate the same to the previous auditor. Now, management communicated the same to the previous auditor. Previous auditor decides, the previous auditor made a request to the management to make amendments to the financial statements of the previous year. The financial statements could have already been issued to the third parties, but dash made a request to dash. Predecessor auditor made a request to the management to make changes to the financial statements. That means predecessor auditor made a request to the management to reopen the financial statements and to recast the financial statements. When I said this, you must be able to recollect the provisions of section 131 of the Companies Act. What is section 131 of the Companies Act? Reopening of accounts or recasting of accounts voluntarily by company. Have I explained that to you? I do remember that I have explained you section 130 and section 131. Section 130 deals with reopening of accounts and recasting of financial statements and on an order made by tribunal. In that case, it becomes compulsory on the part of the company to reopen their accounts and recast their financial statements. Sometimes the entity may decide to reopen and recast their accounts voluntarily. In such a case, entity has not been given liberty to do that. In that case, entity had to make an application to the tribunal. If the tribunal allowed the entity to do that, then the entity can reopen and recast their financial statements, and this is allowed only for a period of 3 years. In case it has been directed by tribunal can direct the entity to reopen accounts for a period of 8 years. Whereas under 130 it is 8 years. Under 131 it is only 3 years. Have I explained that to you? So even when dash are approved in dash or adopted in dash by dash, they can be reopened. Even when auditor's report and audited financial statements have been approved in the annual general meeting, then also you can reopen accounts. So an opportunity is given by dash auditor to dash auditor to dash. An opportunity has been given by current year auditor to the predecessor auditor to make changes to the financial statements as well as to the previous year's auditor's report already issued. In that case, what the predecessor auditor will do? Predecessor auditor will make a request to the management to dash to reopen the financial statements and to recast. Of course, the terms reopen and recast were used in Companies Act, whereas the term amended is used in SA 560. Both are correct. So the previous year auditor would have made a request to the management to recast the financial statements or amend financial statements. When management amends financial statements and a new set of financial statements are approved by the management, thereafter if the predecessor auditor has given a new auditor's report, there would not be any problem to the current year auditor. In that case, it is sufficient if you express an opinion only on dash. Very good. I am very happy that some of you people are able to follow this. Okay, so in that case, there is no need to express an opinion on dash. So in two situations, you are not required to express an opinion on the previous year financial statements, particularly when the previous year financial statements have been audited by a predecessor auditor. What are they? One, when the predecessor auditor has carried out audit of previous year financial statements and has given a report, and in your opinion, such report given by the predecessor auditor is appropriate, then please refer to the predecessor auditor's report. That's it. You are not expected to express any separate opinion on the previous year financial statements. It is sufficient if you express your opinion only on the current year financial statements. Situation number two, when the existing auditor is of the opinion that the opinion given by the predecessor auditor is inappropriate, first of all, the same should be communicated by the existing auditor to those charged with governance and asking them to communicate the same to the predecessor auditor. Then the management will communicate the same to the predecessor auditor. Then the predecessor auditor would have decided to request the company to make amendments to the financial statements. When the company made required amendments to the financial statements by taking required permissions from tribunal, and when the previous auditor has revised his report, that means the report given by the predecessor auditor is right. In that case, there is no need on the part of dash to express a dash on dash. There is no need on the current period auditor to express an opinion on the preceding year's financial statements. Followed or not? Now read it. Otherwise, if predecessor auditor has not made any changes, then you need to express an opinion not only on dash but also on dash. Now please read paragraph number 18 on your own. If the auditor concludes that a material misstatement exists that affects the prior period financial statements on which predecessor auditor had previously reported without modification, the auditor shall communicate the misstatement with the appropriate level of management and those charged with governance and request that the predecessor auditor be informed. If the prior period financial statements are amended and the predecessor auditors agrees to issue a new auditor's report on the amended financial statements of the prior period, the auditor shall report only on the current period. At least by now, you must be in a position to understand about the reason why I explained you SA 560 before starting the discussion on SA 710. Unless you have an understanding of SA 560, it is quite difficult for the student particularly to understand paragraph number 18. There is a relationship between this one and SA 560. Then this is easy, and this is having a link with SA 510. Prior period financial statements not audited. When prior period financial statements are not audited, and when you are made responsible to carry out audit of the current period financial statements, in that case it is said that you are carrying out dash an initial audit engagement. Very good. If the prior period financial statements were not audited, the auditor shall state in the other matter paragraph that the comparative financial statements are unaudited. Such a statement does not, however, relieve the auditor of the requirement to obtain sufficient appropriate audit evidence that opening balances do not contain misstatements that materially affect current period financial statements. That's it. This is the end of the discussion on SA 710. I don't even want to read what is given in our material, because by now you would have identified that what is given in the original standard has been reproduced in our material also. Of course, anybody can do the same thing. Nobody can give the material in their own words. If we give our material in own words, it will dilute what is given in SA 710, so that you may not be able to get more marks. Therefore, it is always necessary for you to read the standard as many times as possible. If you want to by heart it, you can also do that. But before by hearting a particular thing, ensure that you have some generalized view about the standard. First of all, get conceptual knowledge. Then read the subject as many times as possible. Then only you would be able to reproduce this wording in the examination. If you are able to reproduce the wording in the examination, you are supposed to get more marks. This is about SA 710. So where SA 710 is there in our material, page number 24. Done. ఒక పేజ్ అటు ఇటు నో ప్రాబ్లం, వెతుక్కోగలను దేవుడి దయ వల్ల. So now it is said that SA 710 is also completed. Yes or no? Everything given in the material is completed. You can just check it. If something is not discussed, please bring it to my notice so that I can complete it. Question number 25. Define comparative information and its objectives. That is completed. Question number 25 is completed. Which question? Question number 26. Discuss about audit procedures regarding comparative information. That is also completed. Yes or no? Okay. So question number 25, 26, 27, 28. What does comparative financial statements refers to, and describe the procedure reporting the same. They are completed. That's it. Only CRD questions are pending for discussion. Yes or no? Done. When reporting on comparative financial statements, an auditor ordinarily should change the previously issued opinion on the prior year's financial statements. When reporting on the financial statements, an auditor ordinarily should when reporting on comparative financial statements. That means this question is not on dash but on dash, not on corresponding figures but on comparative financial information statements. When reporting on comparative financial statements, an auditor ordinarily should change the previously issued opinion on the prior year's financial statements if the prior year financial statements are restated to conform with the generally accepted accounting principles. Auditor is a predecessor auditor who has been requested by a former client to reissue previously issued report. Prior year's opinion was unmodified and the opinion on the current year financial statements is modified due to lack of consistency. Prior year financial statements are restated following a change in reporting entity in the current year. You can straight away say that point number B and point number D are irrelevant. Yes or no? Then you can choose between point number A and point number C. Before proceeding further into the question, try to read the question again. Try to go through comparative financial information, particularly paragraph number 1 under the heading comparative financial information. When reporting on comparative financial statements, an auditor ordinarily change the previously issued opinion on the prior period financial statements. Now, the answer for this is given under the heading when reporting on prior period financial statements in connection with the current period audit. If the auditor's opinion on such prior period financial statements differs from the opinion the auditor previously expressed, the auditor shall disclose the substantive reasons for the different opinion in an other matter paragraph in accordance with SA 706. After reading this, you can say that prior year's opinion was unmodified and the opinion on the current year's financial statements is modified due to lack of option C, that is said to be correct in my opinion. Next, comparative financial statements include prior year's statements that were audited by a predecessor auditor whose report is not presented. If the predecessor auditor's report was unmodified, the successor auditor shall add an emphasis of matter paragraph, no, express an opinion only on the current year financial statements and make no reference, no, indicate in other matter paragraph that predecessor auditors expressed an unmodified opinion on the prior year's financial statements. That is correct. This is point number C. So I cannot explain anything about CRD questions. Why? Because if you are really able to understand the standard, it is easier for you to answer them. If you do not have an understanding of the standard, even if I try to explain these things, they are not understandable. Try to read them on your own, and if you are having any doubts, feel free to ask me. If I have been offered another class to take up, a proposal has been received from Masterminds to me asking me to take up another class. In that case, what should I do? Question number 1. Or else I'll reframe my question like this. If you were in my position and if you are asked to take some other class, say for ICWA final, will you give your acceptance immediately or will you check something before taking a decision about whether to accept that proposal or not to accept that proposal? Certainly you need to check some important things before taking a decision. If you were in my position, stepping into my shoes, please tell me what aspects do you consider in that case. First of all, the available hours. Whether I am capable of taking more and more hours. Whether I am competent to take that. In fact, I don't know whether it can be given as an example to you or not. Very recently, Masterminds has introduced CMA final also. And they made a proposal to me to take up the CMA final auditing subject also. But I denied it for the simple reason that I am not conversant with the cost accounting standards, cost auditing standards. There are some standards issued by CMA Institute called as cost auditing standards. They are just like standards on auditing issued by ICA. Every chartered accountant in practice is required to follow standards on auditing. Like that, every cost accountant is required to follow standards on cost accounting, cost auditing standards. And there are almost 20 standards or so, cost accounting and cost auditing standards. And I felt that I may be able to understand them. If adequate time is there at my disposal, I can certainly go through all those standards, and I know that I am competent to understand them and to explain them to the students. But the unfortunate thing is that I am not having ample time, adequate time to prepare and to deliver. So considering the time required, considering the competence required, considering other things, I decided not to take up that class. Similar to that, if you are a practicing chartered accountant, if somebody has made a proposal to you asking you to take up some other assignment, in that case, what aspects do you consider? Whether you are having time or not, whether you are having resources or not, whether you are having competence or not. For example, till date, although I am having an experience of 25 years in conducting audit, till date I haven't performed audit of central statutory audit of a bank. Central statutory audit of a bank. Now a banker came forward and the banker proposed to appoint me as their central statutory auditor. In that case, should I accept the audit immediately, or should I consider some important aspects? I know very well that till date I am not having experience in conducting that type of audit. So I need to consider my time, my competence, my experience, my other resources, like whether adequate number of adequate number of article students are available or not for carrying out this task. Like this, you need to consider several aspects. Then only you need to accept the appointment. Don't try to accept the appointment proposal received from your client instantly. That is what they want to explain to you under the heading acceptance of client relationship. What is that? Acceptance of client relationship. You can accept a relationship with the client provided you have considered several things before taking such a decision. Not only that, you should also focus on the integrity of the management. If the auditor is having a doubt about the integrity of the management, for example, you are proposed to be continued as the auditor. That means you are about to carry out a dash audit. You are proposed to be continued as the auditor. That means you are carrying out a dash audit, a recurring audit. In the last year you were the auditor. For the current year you are again proposed to be reappointed as the auditor. In that case, obviously you will have some knowledge about the management, its policies, its honesty, etc. If you find in the previous audit that management is dishonest, would you like to continue the existing audit assignment? If your answer is no, what factors forced you to say no to that? You are having some issues with the dash of management, integrity of management. If the auditor is having the doubt on the integrity of the management, in what way it affects the work of the auditor? When the management's integrity is in doubt, there is a high probability or possibility that management may have tried to involve in more and more number of frauds. In that case, the risk of material misstatements in the financial statements would be very, very high. When the risk of material misstatements in the financial statements going to be audited by you is very, very high, obviously the auditor may decide not to accept the audit. At the starting itself, you are anticipating a very high level of risk of material misstatements, and you are having a fear that you may not be able to mitigate with it. and in that case, the auditor may decide not to accept the audit assignment. So whenever the other party made a proposal, don't try to accept it immediately. Before taking a decision about whether to accept a particular audit assignment or not, you are required to consider several things. What aspects should you consider have been given both under SQC1 as well as under SA 220. The wording may be somewhat changed, but the meaning is almost one and the same. So, a firm, before accepting an engagement, should acquire some information about the client. What sort of information would you like to get about your client while taking a decision about whether to accept a particular audit engagement or not to accept a particular audit engagement? Instead of this question, this is more easy to understand. The audit firm shall perform acceptance and continuous procedures. The audit firm shall perform acceptance and continuance procedures before they accept an audit comment. A firm, before accepting an engagement, should acquire some vital information about the client. Such information will help the firm to take a decision about. You need to get some information. Such information obtained by you will help you in deciding about the level of the integrity of the client. If you are having even a small doubt about the integrity of the client, you won't accept the audit assignment, yes or no. So, in order to check the integrity of the client, what factors or what information is required to be obtained is again given in SQC 1. If you go through the original standard, you will find some points under the heading integrity of the client. All those points are nothing but information that is required to be collected by you. So, if you have been proposed to be appointed as the auditor of, say, a company called as ABC Limited, before accepting that engagement, the practice unit shall have to acquire some important information. Why should they obtain important information? To take decisions about dash integrity. Why should you take decision about integrity? Ultimately, based on that only, you need to decide whether to dash or to dash, whether to continue the audit assignment or not to accept the audit assignment. That means whether to establish relationship with the client or not is a thing that you can understand just by going through the information relating to the integrity of the client. If you are interested, after completion of what is appearing in your material, I will try to show you the original SQC1 also. Under that heading, you will find several points relating to integrity of the client. So after getting all such information which is available under the heading integrity of the client, you need to assess and evaluate whether your client is reliable or not. The level of integrity of your client. If you find that your client is more reliable, then you can accept the audit engagement and continue with the same. If you are having even a slightest doubt about the integrity of your client, don't try to accept that audit. Why? Because even before commencement of audit, you know very well that there is a high risk of material misstatements in the financial statements. And if you fail to detect all such material misstatements, you will end up in giving a wrong opinion. When the auditor ends up in giving a wrong opinion, there would be an increased risk to the auditor. From day one onwards, I keep on telling you that as an auditor, you should always try to reduce your audit risk. In the given case, if you accept the responsibility or accept the relationship with the client, obviously there will be a high pressure to you. Therefore, before accepting an audit assignment, you need to assess some points like integrity of the client, etc. To assess such points, you need some information. So, firm should establish, every practice unit should establish. I know very well that it is becoming easier for you to understand the discussion than in the previous session, because you were not used to the wording in the previous session. Now you are used to the wording that is given in SQC1. That is the sole reason why you might be having some more understanding than in the previous session. Okay. So every practice unit or every firm must establish dash quality controls. Every practice unit must establish quality controls. As a part of establishment of quality controls, the firm should try to acquire information, and the information so acquired by the client shall have to be by the auditor, shall have to be used by him for the purpose of assessing and evaluating dash and dash integrity of the client, his competence. Whose competence? The firm's competence, including capability. You know very well about competence and capability. For example, let us assume that I passed my CA in the year 1953. Let us assume I'm the first batch student who passed CA in the year 1953. I don't know what the computer is. I don't know what is computer accounting and so on. Unfortunately, I have been proposed to be appointed as the auditor of a company which is maintaining all its books and other related records only in computers. For example, the Indian unit of, I am proposed to be appointed as the auditor of Indian unit of Amazon branch. Indian unit of Amazon branch. They do transactions only through computer and there is no manual record available. I don't know what the computer is, but now I am supposed to carry out audit in a computerized environment. Originally, when we are pursuing CA course, there was a particular chapter in auditing subject called as EDP audit. Later on, the name of the chapter as well as the contents of the chapter has been changed to audit under CIS environment. Later, the name has been changed to audit under automated environment. Now, the name is changed to digital audit. They four are one and the same. What is the logic of all these four? Whenever a client maintains books and other related records not in physical form but through electronically, you may not have. Being a chartered accountant where I do not know what is about computer etc., then in that case I may not be competent enough to carry out the audit, particularly where the books and other related records are maintained only in computers. So I need to check my competence. I need to check my capability. The difference between the terms competence and capability were already explained to you under SA 500. Capability will come from experience. So try to assess the integrity of the client. Try to assess your own competence and capabilities. Apart from that, whether you are having adequate time to spend on the audit, as well as whether you are having physical resources to spend on that audit. Physical resources means available staff. If adequate number of staff are available, is it possible for you to perform the audit with effectiveness? Certainly not. Therefore, when a proposal for audit is made to you, what aspects do you check as an auditor? One, you must have to check, a system should be introduced, thereby you must have to check the competence of you, the capability, the time available with you, as well as the resources that are required to be deployed to perform the audit engagement. If adequate resources are available to deploy, you may accept the audit assignment. Otherwise, don't try to accept that assignment. This is point number 2. And the third one is most important one, which is easily understandable, is compliance with ethical requirements. So, as a part of compliance with ethical requirements only, in the previous point I told you that when an article student is able to establish either a dash or dash, a business relationship or a personal relationship. It is affecting its independence, and hence it is in that case I said to you that the article student is required to make a report to the engagement partner, and engagement partner shall in turn make a report to the practicing unit. That is what I told you under the heading 11 ethical requirements. Coming back to the discussion being done by us, a firm before accepting an engagement should acquire vital information about the client. Explain. The points are very much similar. I'm having a discussion on SQC1 now. Once we complete this, I'll try to focus on 220 also, the same point. A firm, before accepting an engagement, must check the following. A firm, every practice unit should establish a system whereby before accepting an engagement, it should have to obtain some information. The information so obtained by it shall have to be used for the purpose of taking some decisions about the following. 1. The integrity of the client. 2. Competence, including capability, time and resources to perform the engagement. And the third one, which is well known to you, is whether you are really capable of complying with ethical requirements like integrity, objectivity, independence, due professional skill and care, professional behavior, most importantly, confidentiality. These are all nothing but ethical. So if you are having confidence about the integrity of the client, if you are having confidence about your own competence, your own capability, time available at your disposal, and other resources available at your disposal. And finally, you should also obtain information relating to compliance with the ethical requirements. When a person is frequently failing in complying with ethical requirements, what does it mean? When a person is frequently failing in complying with the ethical requirements that are made applicable to them, what is the meaning of that? They are not giving importance to law. They know very well that they are violating the law, but still they prefer to do that. That means the person's attitude is not right. When a law is made applicable to you, what should you do? You need to follow it. But in the given case, although the entity knows that a particular law is made applicable to them, the entity has not cared to comply with that law or ethical requirement. In that case, the possibility of involvement of management in fraud would be high, and hence the risk of material misstatements in the financial statements would also be high. That is the reason. So what do you understand by this? Can any one of you please tell me about what you have understood this up to this point under the heading acceptance and continuance of client relationships? Before accepting a dash made by dash to dash, before accepting a proposal made by your client, you must have to assess or evaluate the following things. 1. Integrity of the client. 2. Competence, capability, time and resources available with you to perform engagement, and compliance with ethical requirements. With regard to the fortunately some of the points were given. As I said earlier, I want to show you original standard wherein you may find some of the points under the heading, some of the information to be gathered by the auditor under the heading integrity of the client. Fortunately, the same are given in our material. With regard to the integrity of a client, what matters that the firm shall consider? Why should the firm consider matters? Why should the firm consider the following matters? The following matters is generally considered as dash by the auditor. The following matters are generally considered as dash by the auditor. Information. Based on that information, auditor need to take decisions about what? The integrity of the client, the competence, the capability, time and resources available to the auditor to perform engagement, and to check whether compliance has been done in accordance with ethical requirements. Now, with regard to integrity of the client, what matters or what information? With regard to integrity of the client, what matters or what information the auditor should consider? The auditor should consider one, business reputation of the client. If the client is having very good reputation in the market, obviously client will always try to continue with the same reputation in the market. So once you reach topmost position, you are forced to stay there. Nobody will ask you to stay there, but since you have reached the topmost position, you want to stay there. In order to stay in the topmost, reaching the topmost position is not that much difficult. But once you reach the topmost position, maintaining it is very, very difficult. Why? Because there will be constant competition. Therefore, if the client is having a very good reputation in the market, then you cannot, there is no doubt, there should not be any doubt to the auditor with regard to dash of the client. There should not be any doubt to the auditor with regard to the integrity of the client. So, in order to collect information relating to, taking a decision about whether to accept a particular audit engagement or not, you need to evaluate three things. The first one is integrity, second one is competence, and the third one is compliance with ethical requirements. So, the identity and business reputation to the clients, principal owners, key management, related parties, and those charged with the governance. The nature of clients' operations, including its business practices. For this only, I have explained you an example wherein you have been proposed to be appointed as the auditor of non-banking financial company, or say even a bank. You haven't conducted any work relating to any audit relating to NBFC or branch audit, but you are proposed to be appointed as the auditor of NBFC or banks. In that case, considering the nature of clients' operations and considering your expertise, you need to take a decision about, if I accept this audit, can I actually perform this audit with quality? I don't have some knowledge about NBFC. When the auditor is not having the concept of or knowledge of NBFC, how it is possible for the auditor to decide whether to continue with the client's engagement or not? Therefore, before taking a decision about whether to accept the audit assignment or not to accept the audit assignment, you need to gather some information. Such information shall have to be used by you for the purpose of assessing these three things. Once these three things are assessed by you, then you can take a decision about whether to continue with the same person or to take a break from that person. నేను మాట్లాడుతుంది అర్థమవుతుందమ్మా? This is about the nature of clients' operations. The third one, information concerning attitude of the client's principal owners, key management, and those charged with governance towards such matters as aggressive interpretation of accounting standards and the internal control environment. If the client is having a tendency to interpret accounting standards aggressively, what may lead to aggressive interpretation of accounting standards? What may lead to aggressive interpretation of accounting standards? A new accounting standard came into force. Several new points were included under the heading definitions. under the heading definitions. Now, management need to follow accounting standards while preparing their financial statements as per the requirements of Section 133 of the Companies Act. If for a company Division 2 is applicable, then that company has to follow NDAs. If for a company Division 1 is made applicable, then you need to follow normal accounting standards. This is not a new point to you. This was already explained. So, information concerning attitude of the client's principal owners, key management, etc. towards such matters as aggressive interpretation of accounting standards. If you find that your client interprets accounting standards very aggressively, in that case, there is a high chance that client may there is a high chance that dash may end up. The dash may end up in preparing dash. The client may end up in preparing wrong or incorrect financial statements. In other words, in that case, risk of material misstatements would be very, very high. Therefore, you need to get, if still there are some persons in you who are unable to understand anything about this point, I am here to explain you the point again within just 1 minute to 2 minutes. If you were the auditor of the previous year, if you have been appointed or if you are proposed to be appointed as the auditor of the current year also, you need to either accept that proposal or decline that proposal. Before accepting the proposal or declining the proposal, what you need to do, you need to collect some information. Based on that information, you need to evaluate things like integrity, competence, and compliance with ethical requirements. What data do you require under the heading integrity of the client? That is what I am explaining to you. In order to decide about whether to accept this audit engagement or not, what information do you require? Information relating to integrity of the client. You need to assess the integrity of the client. To assess the integrity of the client, the following aspects need your consideration. The identity and the business reputation of the client, that was already completed. The nature of client's operation, already completed. Information concerning the attitude of the client's principal owners, key management, and those charged with governance towards such matters as aggressive interpretation of accounting standards and internal control environment. The next one is whether the client is aggressively concerned with maintaining firm's fees as low as possible. This point is very difficult to understand. In what way this point is may affect auditor and auditee relationships. I know very well that instead of the explanation being given by me, the questions being asked by me are more difficult to understand. I know it. So question part is more important for you. If you are really able to understand the question, it is not that much difficult for you people to understand the answer. So be careful while I am asking the questions and try to understand the question correctly. Then you can provide an answer if possible. Whether the client is aggressively concerned with maintaining the firm's fees as low as possible. In the previous year, you have been paid a fees of only 3,000 rupees for a company having a turnover of 100 crores. You accepted that. For the current year, they want to continue you as their auditor. In that case, should you continue your audit assignment or not? Generally, no. Why? Why? Because the client wants to maintain the fees at a low level. What happens to the auditor when the client wants to maintain the fees at a low level? At one point of time or other, the auditor may get vexed with the strategy being followed by him. Auditor will try to balance between the cost and the profit. Cost benefit analysis is required to be performed by everybody including the auditor? Yes or no? Including the auditor, cost benefit analysis is required to be made. At one point of time, the auditor may feel like this. After all, the fees being given by this client for this audit is only 5,000. In that case, while I'm getting a fees of just 5,000, why should I verify each and every aspect? Why should I verify each and every aspect while conducting audit instead of verifying each and every aspect in detail? Because the fees that I'm going to get is very, very low, I will try to eliminate some important aspects from my schedule, my plan, and will try to focus only on few things. Only on few things. That means the points that should have been checked by the auditor may not have been checked by the auditor, for the simple reason that auditor identifies that management is willfully maintaining fees payable to the auditor as low as possible, so that vexed up with the management at one point of time or other, the auditor may not check the entire things. In that case, if fraud, if any, perpetrated by the management could not be detected. So these are all the problems when management is maintaining firm's fees as low as possible. The next one is easily understandable to you. Indications of an inappropriate limitation on the scope of audit. So in the while you are conducting audit of the previous year, you encountered an experience with your client whereby you encountered an experience with your client whereby your client had tried to impose several restrictions either on your rights or on your duties in the previous year. So my name is A Limited, your name is X, you were the auditor of the previous year and you have been proposed to be appointed as the auditor of the current year. While carrying out the audit of the previous year, I know very well that management had tried to establish some limitations or restrictions on me. And in that case, will you try to accept the current year audit assignment? You may accept it, but in that case, you must be more careful, yes or no. So when the client is keeping the fees at the lowest possible level, it may not be possible for the auditor to extend his scope of audit. In that case, auditor may fail in maintaining the quality. That is the reason why it is a deterrent for continuing the audit. And hence, in such case, it is better for the auditor not to continue with the audit assignment, particularly where the client is very much particular about maintaining a low fees. That is the relationship between maintenance of a low fees by the client and not accepting the audit engagement or not continuing the audit engagement by the auditor. The next one. Indications of inappropriate limitations in the scope of work, that is also known to you. Indications that the client might be involved in money laundering or other criminal activities. In that case, obviously, the possibility of risk of material misstatements would be very, very high. Don't try to take that risk. In that case, you may decide not to accept the audit engagement or not to continue with the audit engagement. In that case, you are cutting the relationships with your client. The reasons for the proposed appointment of the firm and non-reappointment of previous firm. Why previous firm has been changed and why the new auditors have been appointed or why the management wants to appoint a new auditor in place of the previous auditor, where previous auditor may have been removed by the entity prior to expiry of the tenure of office or term of office of the auditor. If client is unable to provide any genuine reasons, you may suspect the integrity of the client. So these are all the things that should raise a doubt to dash on dash. These are all the things that should raise a doubt to the auditor about the dash levels of the management, integrity levels of the management. If you are having any doubt about the integrity levels of the management, don't try to accept that client relationship. The firm should obtain such information as it considers necessary in the circumstances. where issues have been identified and the firm decides to accept or issues are identified but the firm decides to accept or continue, it should document how the issues were resolved. There may be some issues with regard to honesty of the management, but still the firm may have decided to accept the client relationship. In such case, in audit documentation, the auditor is expected to record the details about why the auditor accepted the engagement, although there are some issues, and how the auditor is able to remove or resolve such issues. These things are required to be documented by the auditor. I suggest every one of you to go through the material as early as possible immediately, so that if you are having any doubt, I'll be able to clear the doubts immediately. If you try to read this material after 2 to 3 days, you may not be in a position to recollect at least one word out of it. So as early as possible, please try to read it, and if you are having doubts, ask me. If there is any conflict of interest between the firm and the client, it should be properly resolved before accepting the engagement. Enough. This is enough. Try to read only first 3 points. That is enough. So these are all the things that are required to be considered by dash while accepting dash. While accepting or continuing with the client relationships, the auditor or the partnership firm or the practice unit had to gather some information to assess or evaluate integrity of the client, competence. Nothing is explained under the heading competence and compliance with the ethical requirements. I don't know whether they were explained in some other point. Additional explanation: reviewing financial statements and credit rating of the proposed auditor. If the credit rating of the proposed auditor is too low, what does it imply? If the credit rating of the proposed client is too low, what does it imply? Probably the organization is not up to the way in which the organization is performing or maintaining is not up to the mark. That is the reason why credit rating has been downgraded. It is a negative indication, and hence in that case, the auditor may decide not to accept the audit engagement. For example, you are proposed to be appointed as the concurrent auditors. You are proposed to be appointed as the concurrent auditors, and the previous concurrent auditor has given a negative report for almost 12 months, for continuously 12 months. Now in his place, you are proposed to be appointed as the auditor. In that case, if you were the proposed auditor, will you accept that proposed appointment? Yes or no? No, certainly not. Why? Because a negative comment has been made by the previous concurrent auditor on the banker for a continuous period of 12 months. That means the previous concurrent auditor is not having confidence over the integrity levels of the management. In that case, how do the proposed auditor accept that audit assignment? So don't try to accept that audit assignment. So these are some more additional points that you may consider while evaluating the integrity of the client. Inquiring the third parties. This is a good practice. Inquiring the third parties as to the reputation of the proposed client. Evaluating firm's ability to service the clients properly. What is meant by firm's ability to service the client properly? If you are having adequate competence, very good. If you are having adequate capability, if you are having adequate time, if you are having adequate resources, then only your firm may be able to provide dash services to the client, good services to the client. So if you are having confidence that your firm is having ability to provide good services to the client, then only accept the audit assignment. Otherwise, don't try to accept the assignment. That's it. Enough. These are all the aspects that are required to be considered by the practice unit before accepting an engagement.